only mode.
You're live.
All right. Hey, everybody, I'm just getting situated right here. Hope you're doing well. We're not officially starting right now, but you should be able to hear me. If you can, say hi. It's good to have you here. Welcome to the event. Greg said I needed to welcome you guys more. So I want to say thank you for coming. You look great today. And it's good to have you. I'm glad you came. So let's go ahead and do this. Hello, Vincenzo. Good to see you. Let me pause this over here. Greg, we're going to give away a little bit of a prize and answer some questions and that kind of stuff. If you're joining us on YouTube, hello. Make sure to like and subscribe. But the way that you get on the prize list is if you come over and register. It will get you. You just have to register once. You don't have to register for every single day. Just register once, but it'll get you on the prize list, and we begin giving away tons of prizes. In fact, I'm kind of curious. We've given away so far 17 prizes. So we're going to go ahead and kind of kick off the day, though, with another prize. And I think we'll start again here with Technical Analysis of Stocks and Commodities magazine. So what we're going to do for the drawing, usually Greg gives me a number. Sometimes I actually pick somebody that's been chatty based on a random chat. Sometimes I pick somebody that's just in attendance. It just kind of depends. But usually I have Greg pick out a number. He's got a random number generator. And so what we're going to give away right now is a subscription to the magazine Stocks and Commodities magazine. It's an $89 value. It's a one-year subscription. If you're here in the US, they'll actually mail you a magazine and you'll get a digital copy and you'll get access to all of their archives, like there's 17,000 articles on there. So Greg, let's go ahead and do a number. The number that I need from you is anywhere between 1 and 7319. 1 and 7319.
All right. The number is 1807.
And tell me, okay, this is a gentleman in Australia. So
good day.
I think it's about 12 hours maybe to Australia. So they might actually be watching live, but it's Sanjay T with the Gmail address. So let me go ahead and make a note of that. And congratulations on winning the prize. Kirby says, great. Good morning, guys. Conference has been great so far. Thanks for coming, Kirby. I have noticed you've been here every day. It's good to have you. I'm glad you're back again for day 4. Let's see. We got a couple minutes. Couple questions that always come up. So if you want to know how to get the recording, Greg, why don't you tell them how to find the recording?
Well, that's easy. It's currently being recorded as we speak on YouTube. So if you just go to youtube.com/metastock, you can watch the recording as well. We will be sending an email to everyone. It's on our email database right at the end of the day that will share a link to a recording.
And it says the audio is perfect. So I won't touch anything.
Don't touch anything, Jeff.
The other questions that we sometimes get are, I'm trying to think of other common questions. When am I going to get my prize? If you just won a prize, like Sanjay did, we'll send it to you automatically. What'll happen is next week I kind of organize all the lists and say, okay, here's who won the TAS prize. And then Technical Analysis of Stocks and Commodities will actually reach out to you. So
another question we get is, who's the speaker? Who's the next speaker? What are the times of the speakers? If you go to metastock.com and select the banner at the top and go to our schedule, you see that as well. I got a little wise and started sending that information on the daily emails I send out in the morning that talks about the schedule. So if you are on our database, you would have received an email this morning that talks about this event and tells the times of today's speakers.
Who's our first speaker, Greg?
Our first speaker, if I'm on, it's Silas Peters.
Yeah, that's right. Correct. Cool. Very good. Shall we kick off? It's 8 o'clock.
I will let you go, my friend.
All right.
Break a leg.
All right. Thanks for the assist this morning. I'll see you again a little bit later.
See you soon.
Thank you, everybody, for coming today. It's great to see you. I hope you're doing well. Welcome to day 4 of the conference. I love these conferences. It's been a lot of fun. It's been going well so far. So as we go through the day, if you have questions, make sure to type them in the questions box. or in the YouTube chat if you're watching us on YouTube. If you are watching us on YouTube, a like and a subscribe will go a long way. We only have one like. That's mine. Make sure to like and subscribe. All right, very cool. Let's go ahead and get started. And the first thing I need to do is talk about the legal disclaimer. Today's demonstration is designed to instruct you on using Metastock and accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentations today should be construed as investment advice or the solicitation to buy a security. So there you go. Big thanks to all of our sponsors. I'm going to go through them all real quickly here. AAII.com is how you can find the American Association of Individual Investors. They've been a big supporter of the Metastock conference for a few years now. You can find them at AAII.com. They do a lot of research reports. They do a lot of analytics. They have an active investor division. Ray Rondo came in earlier this week and talked about them. Great organization, AAII.com. Technical analysis from A to Z, one of our longest running promoters of the conference. I remember when we did our very first Trader Summit, a single day event, I called Stocks and Commodities. I was like, here's what we're going to do. We're going to invite all these guest speakers in, and we're going to just kind of have fun with it. And we want you to sponsor. They've been sponsoring it since our very first conference. And it's also a great magazine. 17,000 articles in their archive, 1.3 million subscribers, publishing magazines since 1982. A year's subscription to get a magazine in the mail costs about $89. Go to www.traders.com and go ahead and sign up. They do a great job. The Traders Forum, if you haven't joined it yet, you should. TheTradersForum.com is where you can get to that. If you go up there, there's nothing that you can pay for up there. You can chat with traders. You can learn about the markets, learn about candlestick patterns. It's designed to be a community of traders hanging out, helping other traders, giving other traders ideas about what they want to trade and that kind of stuff. So www.thetradersforum.com. Very cool. And then CMT Association. I want to say thank you to them. CMT Association is a great organization. Another nonprofit. If you are managing money, if you're interested in trading professionally, if you want a designation of CMT at the end of your name, all of those things can be helped very, very much by the CMT Association, www.cmtassociation.org. So, all right, that's all of, and us, we're Metastock. We're going to talk about Metastock all day. Metastock.com/conf promo. If we've talked about how Metastock can help you identify trades, how it can help you test trade ideas, how it can give you our patented forecaster with that statistical cloud, real-time commentary, alerts, signals, all that good stuff. Starts at $69 a month. You can get that and all of the offers at metastock.com/conf promo. Satish, thanks for saying good morning. It's good to see you too. Sean, good to see you today. Kirby, good to see you, and thank you for the compliment. I'm glad you're enjoying the conference. I really am. Okay, so let's go ahead and kick off. Our first presenter today is Silas Peters. Silas Peters is going to talk about his 3S code model and kind of how it works and kind of give you some ideas underneath the hood for it. Silas is a good friend of mine. I've known him for a number of years. I was going to say he's a very tall man, which is true, but he's also a great presenter and a great technician. And let's go ahead and get this started. Silas, let's go. How are you doing today?
Doing great. Thanks for having me on. I hope you're doing well.
I'm doing very well. Let me go ahead and make you the presenter here.
All righty. Let's see here. All right. Can you guys see my screen?
Yes, sir.
All right. Audio is good?
Audio sounds great.
All right. We ready to rock and roll then?
It's all yours. Take it away.
All right. Thank you so much, Mr. Gibby from Metastock. Thanks for having me on again. I always enjoy these events. Great crowd. great crew, well-organized event. I'm sure you guys are learning a lot, have been learning a lot this week. So appreciate you having me on once again. And I'm going to let me see, pull up the question box here. Feel free to ask questions as you wish throughout the course of the presentation here. I do want to teach you something educational, something actionable. So I'll try to get to those questions at the end, but the audio is good. We're going to go ahead and get rolling here. Lots to cover. My name is Silas Peters from Trades Trending, as Jeff said, and it looks like the audio and visuals are good. Let's move quickly to the risk disclaimer. Take a quick moment, read this from our friends at the regulatory governing bodies. Past performance is not necessarily indicative of future results. Only risk capital should be used to trade. There is substantial risk of loss associated with trading and investing. So now that you understand the risk, let's go ahead and move right into things. I'm going to ask you, what do you trade? What does everybody trade? I'd like to kind of get a feel for the audience here. Do you guys trade stocks, options, futures, maybe Forex? What is everybody trading here? So what I'm going to share with you is a unique strategy. It's what I call my 15-minute trading blueprint that I've been using for almost 20 years now to trade the following markets here, and it continues to crush it. And the best thing about what you're going to see and what you're going to discover is its simplicity. This is a mechanical, stress-free, emotion-free trading method that can be applied literally on any market or time frame. So we've got equities and options traders. We've got futures, stocks, options. Gotcha. So the great news about all of these responses here is that what I'm going to share with you is highly accurate, works in all those markets, all time frames, and it's 99% mechanical. And most importantly, it is simple. Now, this is perfect for small accounts to large accounts. I've used this strategy with $2,000 accounts to $20,000 accounts, even $100,000 plus accounts, and in every market situation, from the 08 financial crisis to roaring bull markets, traded through debt crisis, government shutdowns, elections, flash crashes, you name it. From scalping and intraday trading to swing trading for a few days and position trading for weeks and or months. And you can do this with small or large accounts, and it can take as little as 15 minutes a week if you wish. Now, before we dive into all this, I'm going to introduce myself, who I am, maybe why you should listen to me. Other than that, I'm a simple dude. I'm a family man who thoroughly enjoys being a two-girl dad. I've got a strong passion for the markets, strong passion for golf, cooking, the outdoors, and Alabama football. But this is where it all started, the great city of Chicago. This is here where I cut my teeth in the commodity markets right out of college, working at the Chicago Board of Trade. Very quickly, I found myself working the Asian, European, and early New York session trade desk, trading across the CBOT, the Merck, NIBOT, NYMEX, various London and Asian exchanges, trading for a hedge fund, banks, commodity trade advisors. We're talking like really large size, 300 lot bond orders, 400 lot big S&P orders, 100 lot gold option orders, 250 lot Japanese government bond orders, and really such an eye-opening experience to see how the biggest traders and funds and market makers were trading and making decisions. And so I did this for a while, soaking up everything I could, any and everything market related, acquiring multiple futures and securities licenses. I was literally a market sponge. And then my college sweetheart and now my wife of nearly 20 years, she taught me into coming home to settle down and start a family. So we headed back down south and I immersed myself into the quieter side of finance. Here where I helped manage portfolios and did some investment consulting for a $2.5 billion family office. And then during this time, I managed to stay in the markets, specifically the commodity markets, running and owning some brokerage units, and then finally starting my publishing brand in 2016. And it's here where I found my real calling. It's here where I teach students across the globe different ways they can generate the skills necessary to trade, manage portfolios, and turn their trading around in the right direction. And today I want to help you do all this too, but let's quickly get back to the journey. My journey wasn't always easy. There's a learning curve, several obstacles to the path on where I am today. The first step, obviously, learning. School does not teach real life experience in the markets. Made money in the beginning, substantial amount. Was I lucky? No, but ignorance and greed cost me my profits. I blew up an account and others in what I like to call revenge trading, which I'm sure we're all familiar with. And these were all very humbling experiences. I almost gave up, almost quit. Nothing seemed to work. I seemed to always be on the wrong side. But guess what got me back in the game? I was in a dark place, but I went back to the very first trading setup I learned almost 20 years ago. And guess what? I got back on track. Started banking wins again. I'd gone off the reservation looking for that elusive holy grail, but my journey ultimately led me back to where I first started. So went back to my roots, worked my repeatable process to find consistency. Now, let me ask you in here, is anybody a victim, or have you been a victim of paralysis analysis, the state of overanalyzing or overthinking a situation so that a decision or action never taken, in effect, paralyze the outcome? So I'm raising my hand. I've been there, done that, got the t-shirt. I think we've all been there. You've done all the research analysis you thought you could. You've got your finger on the mouse ready to pull the trigger, and then, what happens? You've got some line crossing this line, or some analyst on TV says you should be buying instead of selling, whatever it is, and then you freeze up and then you miss out on the opportunity. So yeah, I mean, a lot of us have been there, and my agenda and promise to you is this, that we're going to eliminate paralysis analysis. We're going to learn a simple and mechanical setup together that is repeatable regardless of the market or time frame. Now, we know that a market doesn't go straight up or straight down forever. Markets move in waves over different time frames, and there's been millions and literally billions or trillions of dollars have been made by people recognizing these ebbs and flows in the market, and people think that they knew what they're looking at, get it wrong. And so I'm going to show you how to get on the right side in a smart way. I think the most powerful thing that can be done is show you proof. As they say, proof is in the pudding. So let's learn about this exciting strategy right now. I'm going to show you how we can easily and mechanically identify moves like this in GE. One trade to the long side, one trade to the short side. I'm going to show you how we can identify trades like this in Barnes Group, short trade here, long trade to the upside. Bank of America, these types of moves, they start to add up. And what the great thing you're going to see and realize is that we can simplify the process, and we can get our own selves out of the way, meaning we take that emotion and stress out of the trading. So this is a 4-hour chart of gold futures. I mean, this is an $1,800 move followed by a $900 move to the downside. Here we are on a 5-minute chart of the S&P for those that like to day trade. This strategy is perfect for those trading intraday and for swing and position trading. So there's a lot of potential here depending on what it is you like to do. Currency, Forex traders, Aussie yen on a daily chart. We're starting to see this reversal pattern that I'm showing you mapped out with very clear objectives. And so, all these examples I showed you, can it be this simple? Now, we know trading is not easy. It's not easy at all, but we can simplify the process. You see, when I got started, I was probably a lot like you, sifting through hundreds of different strategies, system setups, you name it. I tried all kinds of stuff, and a lot of it was garbage. But the single most important part of this journey was when I learned to keep it simple. Once I got rid of the clutter, the fancy, blinking gizmos and indicators, and started focusing on price action, following one simple pattern, that's when it started clicking. And so if you're sitting here as a new trader or a struggling trader or even an experienced trader, I'm about to teach you a foundational go-to strategy that got me from a struggling trader to a winning trader. And I'm telling you right here, right now, that this is a simple mechanical setup that anyone can learn. And you will keep this in your trading arsenal for years to come. And what I'm going to do is essentially make you an offer you can't refuse. How you can join my team with a specific set of tools and a plan that will help shortcut not only your learning curve, but also the time you need to spend looking for quality setups. So let's get right to it. The price action pattern we're going to be discussing today is, drum roll please, the 1, 2, 3 pattern. So who here is familiar with the 1, 2, 3 pattern, or the 1, 2, 3 top and bottom? Probably a lot of you see a lot of yeses, a couple of no's, but this is one of the most fundamental technical patterns in the textbooks. Okay, but highly, and I mean highly, overlooked by most traders. Now let's talk about what this setup is. It's price action based, and guess what? Price action is king. And speaking of king, did you know that McDonald's and Burger King have different ways of choosing where to open new restaurants? McDonald's does tons of research. They look at maps and population counts, traffic patterns, competitive analysis, all this stuff until they find the perfect location for a new store. Now, Burger King approaches it differently. They wait to see where McDonald's opens up a store, and they open one up across the street or down the block. They get the same result with a lot less time and effort. And so when we relate this to trading, we can let all the Wall Street traders and large institutions do all the research on which markets to buy or sell. But all we need to do is look at price action, which takes into account all of those fancy processes. Basically, we're the Burger King to Wall Street's McDonald's. And so this setup happens when we have a low and then a higher high and a higher low, and then a break of that higher high when we're looking to go long. Inverse if we're going short. It anticipates a change in trend from up to down on a break below the 2 or B point, or a change in trend from down to up on a break above the 2 or B point. Now, the strategy usually occurs at the end of trends and swings, can be an indication of a change in trend, can also be found within a trading range. And I will say that it works extremely well when these patterns set up at significant areas of support and resistance, or other technical patterns like head and shoulders tops, bottoms, double bottoms, and more. So let's break down and take a look at the mechanics. So let's start with identifying 1, 2, 3 bottoms. Now, when we look for 1, 2, 3 bottoms, we are bullish. We are expecting that market, that whatever we're looking at, to go higher. We're looking to go long. We're either looking to buy that stock or buy call options, expecting it to go higher. And so when we get this pattern, we have the market kind of breaking down, and then when we stop making lows and pull up, we get our number 1. Market trades higher and we get a retracement, that gives us our number 2. And as the market trades lower and then pulls back up, that gives us our number 3. So we're looking to get long on breaks or closes above the number 2. Now, for 1, 2, 3 tops, same pattern, but in inverse. This is where we are bearish or looking to short that market. We're looking to short that stock or buy puts, expecting to go lower. So here it's inverse, where the market is pushing higher, and once we pull down, we get our number 1. The market retraces lower, pulls back up, we get our number 2, and as we stop printing these lower highs, we get our number 3. 1, 2, 3, and we're looking to short on breaks or closes below the number 2. Now, one of the great things about this setup, or these setups, is we don't really have to be too concerned about the first 2 legs, legs 1 and 2. We don't have to be glued to our screen unless maybe you're hyper scalping or something. But all we need to do for these setups is spot when price is about to trade through that number 2. It's that simple. Okay, so let's take a look at some chart examples, because seeing is believing. We'll start with the 1, 2, 3 top. Okay, so You guys and girls can read all this over to the right, and I'm going to look at the chart. So here we have price push up and make a new high. Now, we call it's a 52-week high. It doesn't have to be a 52-week high or 52-week low. We'll talk about ways in a bit where we can dial it down a little bit lower to find more opportunities. But for these example purposes, we'll talk about a 52-week high. So we have a new high here. Market presses down, retraces back up. That gives us our 1 and our 2 and our number 3. Now, price could have come all the way up here as long as we didn't take out the number 1. So we know exactly what we're looking to do well in advance. We're looking to do what? We're looking to sell on breaks or closes below the number 2. Now, what about the other important ingredients of the recipe? Like, okay, where's my risk or my stop? Where are my targets? All great questions. So we know we're looking to get short below the number 2. Our initial risk needs to go above the high of the 1. Our initial target is the distance between the high of the 1 measured to the low of the 2 measured down. So you can see that it's a 1-to-1 risk reward right off the bat. That's okay, but we can do better. Okay, it's very important to let the market materialize in its anticipated direction before we start adjusting stops. So as we start breaking down here, we can then move our stops where? To above the high of the number 3. So we quickly cut our risk down by 50, 60, 70%, and we end up hitting target. Let's look at another example. This one on Walmart, we have a new number 1 point. Why? It's a 52-week high. We have our 1, we have our 2, and our 3, and we know in advance everything that we are looking for in this setup, where 98% of other traders are going, well, where do I get in? Where do I get out? Where's my stop? Where are my targets? We know we're looking to get short on breaks or closes below the number 2. We know initial risk is going above the number 1 high, and we know our target is the distance between the high of the 1 to the low of the 2 measured down, which is about $5 in this example. We come down and hit target. Let's look at 1, 2, 3 bottom examples. Now, this is a 15-minute chart of the E-mini S&P. So if we're looking at a 15-minute chart of the E-mini S&P, does it make sense to look for a 52-week high or 52-week low? No. So here we're looking for what we call a session high or a session low. That means wherever you start your trading day, futures and Forex are trading around the clock virtually. So wherever you start your trading day, whether that's 3 a.m. European session, maybe it's the 9:30 Eastern New York Cash Open, maybe it's the lunchtime, maybe it's the last hour of the day, you're only looking for new highs or new lows from that point. So in this chart here, we have a new session low. We have a 1, 2, 3 pattern, and we know that we're looking to get long on breaks or closes above the number 2. And you can see that if you put a buy stop, a tick or 2 above the number 2, you're triggered into the trade. Now, an alternative entry method that I prefer is to wait for what we call a second pass or hook. So here we bump up into the trade. I like to wait for the market to retrace and then give me a second or additional confirmation. Okay, so here's where we could get long right there. Sometimes if you wait for this, sometimes the market will roll over and roll over or just bust up to profit target and you miss out. But what can also happen is sometimes if you wait for, sometimes we get faked in and then the market rolls over and you get stopped out. So I like to wait for this extra confirmation. All right, so here is a weekly chart of Apple. This is a great way to catch some kind of longer term position type moves. Here we have a new multi-week low. We have a 1, 2, 3 bottom, also a double bottom, and then we break out above the number 2 here on this large bullish candle. Okay, so we go sideways for a few weeks, we come back and retest and trade back higher. That is our cue or our call to get long. How? We can buy Apple stock, we can buy call options, sell bull put credit spreads, whatever your flavor or style may be. Now let's look at what a failed trade looks like. Sorry to burst your bubble, but we're all grown men and women here. We know that nothing is 100% in trading or in life. This trade I probably took in my account. You've got the market grinding higher. We put in a new session high. we get a 1, 2, 3 top. Now, these aggressive traders may have got long there on the initial break, or you waited for the hook or second pass, you get short here. You're up a couple points. Now, if you waited for, if you sat on your hands and didn't do anything, you would have gotten stopped out above the number 1 high. If you exercise some money management principles, as we started breaking lows here, you would move your stop from the 1 to the high of the number 3, and you get stopped out here. But guess what? We actually get another setup. This high is greater than this high, so we actually get a new 1, 2, 3 top, and then we end up having a trade that goes into profit. Now, this is what I call a no trigger trade. It's an avoided trade. It's neither good, bad, nor ugly. And so I'm going to tell you why I really like these setups. So what happens here is we have a 1, 2, 3. We're looking to get long, but the market decides to go lower, taking these lows out, so we get a new count. New 1, 2, 3. We're looking to go long. Market says I'm going to go lower, take out that number 1, and then here we have a new 1, 2, 3, and we're able to get long this third attempt. What is likely happening in this situation right here? What is likely happening? Does anybody want to take a guess at what's happening when we have price making lower lows? If we added an oscillator, if we added some type of oscillator here, such as an RSI, MACD, stochastics, whatever, we likely have this. So we have prices making lower lows, but oscillator making higher lows. What is that called? That is called bullish divergence. Apologize for the handwriting there. Bullish divergence. So that adds a little bit of extra, flair or meat on the trade, if you will. So we like when that happens. All right, so let's talk about 1, 2, 3 pattern trade management. Again, the confirmation of entry is on a break above the 2 or B point for a long, or a break below the 2 or B point for a short. Exit strategies, if you're only trading, say, one contract, one option contract, if one futures, Forex, whatever it is, one share of stock, I'd say go for the distance between the 1 and 2 as your first target. Okay, so you have this setup here. Here's your 1, 2, 3 pattern. It's uncanny how more often than not, price will come up and hit target 1 almost to the T and then reverse. So this is where I say, hey, take, if you're trading multiple shares or size or positions, this is where I say, hey, take a third, a half, 2/3 off here at that initial target, and then you can jack your stop up and then manage your trade or trail your trade with whatever works for you, whether that's through a trend line or two bar backs, moving averages. I mean, they come in dime a dozen. You got to kind of figure out what works best for you. All right. Now, I've showed you this setup works in any market, whether it's pips and Forex, Pepsi stock, potash or pot stocks, pork bellies, or the Polish zloty. Works on any time frame, whether it's a tick trader, 5-minute, 15, 30, hourly, daily, weekly, and more. For position traders up to the higher time frames, and on any trading style. So what is your trading style in here? I kind of want to see, are you guys position traders? Are you scalpers, swing day, tick traders? What is everybody trading? So we've got day and swing, we've got swing, intraday, scalper, day and swing, not trading yet. And the reason I ask that is that you ultimately have to figure out what your bread and butter is, okay? These are some of my favorite time frames for this pattern. I like the 1 and 2 as well for on intraday, and then the daily and weekly work excellent. But I'm not here to say, hey, this only works on a 5-minute chart of NASDAQ or a daily chart of Alibaba, because it doesn't matter. We're trading price action, and it can be applied to tulips and tea leaves if that's what you trade. So you kind of have seen the proof. Let's look at some real trade examples. Not to say that what we've been looking at were fake examples. They're real examples by all means, but let's look at some examples we've utilized in some of our services. So this is a daily chart of crude oil. And again, you guys can read all this stuff on the right. I'm going to look at the chart and kind of break this down together. So we're going to start left, and what we have here is a new number 1 point. Why? That's a 52-week high. Okay, so we have a new number 1 point, and we have a 1, 2, 3 pattern. Now it's small, but it's still valid nonetheless, okay? So we know in advance that we're looking to get short on breaks or closes below the number 2. We know our target is the distance between the high of the 1 and the low of the 2 measured down. So we quickly meet our $3 or $3,000 per contract price objective. Then the market goes sideways. And I get asked a lot, Silas, does this thing work in ranging and consolidated markets? And the answer is yes. You can see we have little 1, 2, 3 patterns here, and a nice trade to the upside, but I'm looking for new highs or new lows. And we get a new high right here. That gives us our new number 1 point. This high is greater than this high here, so we get a new number 1 point. Okay, so we have a new 1, 2, 3 top. Market breaks below the number 2, gives you about 2, 3, 4 days of retest here, giving you an opportunity to get short. And I love this setup right here. I love this setup because not only the high probability nature of the 1, 2, 3 pattern that we've been discussing, but because from a seasonal perspective, we are at a time of the year where crude oil and energies in general typically trade to the downside. This was an absolute perfect marriage in this setup. So we got short, we meet our $4,000 first initial contract objective. The trade absolutely melts down another $20,000 per contract. And all we're doing is we're trailing the market until we either get stopped out or until we get a potential reversal. We have a potential 1, 2 here, a potential 1, 2 here, but notice that we never break above the number 2. We make a new low, then we make a new low. We sell off another $10 or $10,000 a contract before we find that bottom right here, 1, 2, 3 bottom, and then we now flip the trade to the upside and we meet our $5,000 per contract objective. Okay, and if you look here, look at how this is plotted beautifully with the entries here and your target 1 and your target 2. All right, let's look at gold. Now this is actually GLD, the ETF that tracks gold futures, but here we have a nice 1, 2, 3 pattern. We break down, we reach our $4 per contract price objective, and now we're looking to flip to the long side. So, everybody out there trying to guess and speculate, where's the next price of this? What's the next price of that? Who cares? Trade price action, guys. And so now we get a new 1, 2, 3 bottom here. We reach our $2 price objective. Now, some people will say, well, what about all this stuff in the middle? Now, remember, I'm looking for new highs or new lows, but here we have a little 1, 2, 3 bottom here. Here we have a 1, 2, 3 top here in the middle. So, if you want to trade those range bound 1, 2, 3s, then pat yourself on the back. There's opportunities there. But now notice that we start making new lows. Since we start to get new 1, 2, 3 counts. These lows lower than this low. So we have a potential 1, 2 here. This low is greater or smaller than this low. So we have a new 1, 2, 3. We gap higher 2 days in a row, come back, retest, hook back up. That's our confirmation signal to get long. We buy gold futures, we're buying GLD, call options, selling puts, whatever, again, your instrument or style may be. And here we are on gold again. This is a $10,000 per contract move. Look at Delta Airlines. I think you guys are probably seeing what I'm seeing. It's just it becomes a rinse and repeat process. Delta Airlines, whether you trade stock or options, it doesn't matter. Okay, 1, 2, 3 bottom. We make a $4 move and go higher. Now we flip to the short side, 1, 2, 3. Notice that we get a gap below the number 2. I personally don't really trade those gaps, but we've got members and students that will aggressively trade these. We get another opportunity here. 1, 2, 3 top. We sell off aggressively below the number 2, and then we flip now to the long side. 1, 2, 3. Goes higher, pulls back, hooks back up, and then we rip to the upside. So I know this might be coming redundant by now, but I'm just trying to show you the power of how this happens over and over again. It does become rinse and repeat. Delta Airlines, check this out. Imagine all this being plotted onto the chart for you. Look at the CAD Swissy for the Forex traders. Market is grinding down. Instead of trying to guess, you wait for a 1, 2, 3 pattern. Market gets trades aggressively above the number 2, or you wait for the retest or hook back up. You get your 70 pips of profit. Are you trying? What are you doing now? What are you doing now? You're waiting. You get a potential 1, 2 here, market goes higher. A potential 1, 2 here, market goes higher. Potential 1, 2 here, market goes higher. We finally get our 1, 2, 3 top over here. Smaller one, but it reaches your 40 pip profit objective, and then we're done. Okay. Now, there's example of CAD Swissy on a 4-hour. Day traders in here. Any day traders in here? 5-minute chart of the NASDAQ session low, 1, 2, 3, right? We trade above, we come down, we hook back above, we hit our 13-point profit objective. New session high, 1, 2, 3. We break down, market goes sideways, we might have to pop some tums, then the market reaches our 20-point profit objective. New session low, gives us a new 1, 2, 3. Breaks above the number 2. If you're lucky enough to get filled on that retest, you reach your 30-point profit objective in about 2 or 3 bars. Okay, and this is whether it's a 5-minute chart, 2-minute chart, 1 minute, maybe a tick chart, it just works. Okay, now why are you here? You're here to learn a mechanical done-for-you strategy for all markets and all time frames. Have I shown you enough proof? This is where I'm gonna ask, have I shown you enough proof? You know, I'm not sure if it gets any more mechanical, simpler, easier. There's no guessing when to get in, no guessing where the market is likely headed, no guessing where to get out. If we had 100 traders looking at the same chart, we should have at least 99 see the same thing, right? There's always going to be one person in here that tries to make things complicated or try to overanalyze what I just shared with you. I mean, this isn't rocket surgery, guys. This isn't rocket surgery. Now, wait, hang on, but wait, there's more. Do you remember the recent case studies that we just went over, that we literally just went over? Crude, gold, Delta, NASDAQ, and so on. Now, what if I told you this strategy was automated? What if I told you that the strategy was plotted onto a chart for you? And what if I told you the trigger entry targets were drawn for you? And what if your platform could scan the markets for you and tell you when there is a pending setup? I don't know about you, but I would say that's pretty freaking amazing, pretty amazing. So if we go back and look at those case studies and examples, now you have this magical, beautiful 3S code plotted onto your chart. We saw those on the Metastock examples earlier. Now, when we break below the number 2, you're going to get a entry level, a target 1, a target 2, and your risk. Okay, you break above the number 2, you're going to get your entry, target 1, target 2, and your risk. Notice that we have these green arrows here. These are new number 1s. Remember, we are tracking crude down, tracking crude oil down. We never break above the number 2, never break above the number 2. Therefore, we have no signals. Look here at this example of gold. Remember gold. Here we have the pattern. Target 1, target 2. We're not getting anything here because we're looking for new highs or new lows. New lows, the green arrows are telling us we're making new lows, and then our arrows start to plot, which gives us a very visual heads up that we're looking for a potential pattern. Okay, here we are. We hit target 1, target 2, and now over on the right-hand side, we're looking for a new potential 1, 2, 3 top. It's amazing. Delta Airlines, there is your long, your short, your long setup, and then the 5-minute NASDAQ. Remember 5-minute NASDAQ chart here? There's your short, hits target 1, hits target 2 to the tick, which also happens to be a session low, so now we get a new setup. Entry, target 1. We don't quite hit target 2, but it's close enough for government work. You shouldn't have lost any money on the trade. And then we get a new session low. This low is lower than this low. So market just peaks its little head there above the number 2, which triggers entry, risk, target 1, target 2. We hit target 1. we start to make session highs, which warns us that, hey, get ready, we may need to short. We hit target 2, we do get a final 1, 2, 3 here, we break below, we come back up, come back down, hit target 1 and target 2. So is this training for you? I mean, you and only you can answer that question. You know, if you're new to the markets and want to jumpstart your success, if you're an experienced trader and want to add another arrow to your trading quiver, if you're tired of all the noise, the indicator overload, the paralysis analysis, if you just want to simplify your process, maybe you're already successful and want to add another winning strategy to your toolbox, or if you need a very specific mechanical step-by-step plan that you could do part-time, then this training could be for you. It doesn't matter if you're a swing day scalper, it does not matter. If you look at these setups that occur over and over again, like this here on Cardinal Health, okay? If you look at this on Google, tell me, could you have sold the stock? Could you have sold bear call spreads if you like selling credit spreads? Could you have bought put options? Answer is yes, yes, and yes. 4-hour chart of the Canadian dollar. 4-hour chart here. You have a long, you have a short. 233 tick chart of the E-mini S&P. The 233 tick and the 610 tick charts. I love these charts for this setup. Now, why do all the work when we can let technology do the work for us? I used to do all of this by hand. Now I load the scanner. I say scan for tops across the Russell 1000, only stocks that are optionable. And what used to take me hours to do by hand and filter through is now done in seconds with the click of a button. And you can see the scanner, an indicator has been built for Metastock, Thinkorswim, TradeStation, NinjaTrader 8, Wealth Charts, and even TradingView. Now, there's no scanner for TradingView because they do not have scanners, but if and when they do, that will become part of it as well. MetaTrader 4, MT4. Now, we know there's no real crystal ball in the markets, but I like to view this as one that provides me with a process. I use this tool to scan the markets, locate my setups, I go to my platform for entry, and then I manage to trade through the exit. And this becomes a rinse and repeat process every single day. And you can start doing so today and profiting from these predictable patterns with what we call the 3S code. Now, here is the offer you simply cannot refuse. We have opened up 25 spots where you're going to get the 3S code indicator, the 3S code scanner, the 3S code optimizer, access to our weekly strategy and scan sessions, and access to our private Telegram room. You're also going to get our 25 top option strategy guide, chart pattern principle guide, and trading the 3S code quick start guides. You can get started today for a one-time lifetime payment of $397. You can go to metastock.com/code, or you can call 1-800-882-3040. The offer is metastock.com, and I'll put that into the chat there for you. Metastock.com/code. This is a one-time lifetime fee, guys. You get access to all of the platforms we mentioned. Now, those platforms, once again, Metastock, Thinkorswim, TradeStation, Ninja 8, TradingView, MT4, and Wealth Charts. Now, you're going to get the indicator and scanner for these platforms here. The only one that does not have a scanner is going to be TradingView. Now, you're also going to get access to our live weekly strategy and scan sessions. These are held every Thursday at 11 a.m. Eastern, which, guess what? That's in 15 minutes. So congratulations for those that hop on board with us today. You're going to get an invite to our session here in 15 minutes. And this is where we cover We go into detail of the 3S code, strategy, and setup. We scan live markets, looking for live opportunities across stocks, options, ETFs, futures, currencies, and much, much more. You're also going to get access to the indicator and scanner with multiple entry settings depending on what you want to see, what you want to do, what your styles and preferences are. You're going to get a visual plot of those 1, 2, 3 top and bottoms with your entry, exit, stop, and targets. If you want to change it from pink to yellow, from orange to green, whatever the case may be, you're going to get access to edit those settings. You can customize for multiple look back periods. Let's say you want more opportunities, you're going to dial that in. Let's say that you want to scan for setups only or trigger only. What does that mean? Setups mean that those are in the process of setting up. They have not triggered, meaning that it would look like this: 1, 2, 3, prices here. Your scanner would scan for those. You can also set it for what we call a trigger, meaning that price is already triggered through the number 2. Very customizable. You can scan for intraday setups, swing setups, across stocks, ETFs, futures, Forex, and much, much more. Very flexible. Now, you're also going to get access to the 3S code optimizer. This is where you can now take the mechanical 1, 2, 3 top and bottom strategy and then create and run multiple back tests against various inputs and settings to find the best optimization parameters that fit your trading style. This is me running a 3S optimizer in TradeStation. Here we are in TradingView. Here we are in TradeStation, where you get all of your stats and all of your results based on your settings. Here we are in Ninja 8. You can add and edit all kinds of different variables, again, that meet your style preferences. Now, with this 3S Code Pro package, I'm throwing in additional bonuses. You're going to get the chart pattern principle trading manual and guide, 90+ page PDF, how to read charts, identifying trending and range markets, additional strategies and setups, option and options volatility, seasonal market trends, order types, and so much more. This training will help jumpstart you by teaching you how the market works, why markets move the way they do, who the players are, and how to look at and understand the market the proper way, including bonus setups, how we use the power of seasonality to trade this pattern. You're also going to get access to my 25 top option strategy. Now, this is great regardless of your knowledge of options. I include this guide because I believe options are a powerful trading instrument if you know how to use them properly. It's important to me to include this so everybody can take advantage of options if they wish to do so and do it the right way using the 3S code strategy. You're also getting access to our private Telegram room. This is where we cover stocks, ETFs, futures, commodities, currencies. Every day I'm posting setups in that Telegram room that gives you an opportunity to take fish while you're learning to fish on your own. And guys, there are testimonials and success stories that come in all the time, and this is what makes it worth it, because people are taking action, right? They're taking action, and that is the way you're going to see results. You're not going to see results if you're not taking action, and these people are, and they're having success. So if you're ready to get started, ready to join the team today, you can go to metastock.com/code, or you can call 1-800-882-3040. And we do offer or limit this to 25 spots today. We like to control the user experience. We want to make sure you get onboarded properly, you get everything locked and loaded. You can reach out to our team. You can reach out to Metastock's team if you need assistance on installations and that kind of stuff. And it is yours for life. And any other enhancements or tools or widgets that we may add to 3S Code, all of that is part of your lifetime package, and you do get access to all of those platforms. So go to metastock.com/code. Call 1-800-882-3040. And what I'll do is turn it back over to Jeff and the Metastock team try to keep you guys on track for your conference. I know you got a lot going on there. And once again, I appreciate everybody's attention and your interest. And thanks again to Metastock for having me on. I hope everybody has a great weekend, and we'll see you next time. Take care.
Right on. Thanks, Silas. Do you have time for just a question?
Yes, absolutely.
Oh, okay. I know you have your other thing that you're running to. Sri wants to know, what's the difference between this and the Bokaski 123 trend change indicator? I'm not familiar.
I saw that question, and I don't know. I don't
okay.
know. I've heard of a lot of indicators and things out there in the indicator world, I guess you could say, but I'm not familiar with that one.
Okay, cool. Well, I'll take it from here then. Thank you very much for coming in. Great presentation. I love that pattern.
Yeah, thank you so much, guys. Have a great day.
All right, very cool. Let me go ahead and do this. And I just want to, one of the things I like, let me go ahead and make me the presenter, turn on my webcam, et cetera, et cetera, et cetera. One of the things I like about kind of the Metastock integration is really how. Parag, there was quite a number of different platforms. Parag asks, I don't have Metastock, can I still use this? There's quite a number of platforms that are available for, so if you have some platforms, it'll work. But I would encourage you to use the Metastock one, and we will throw in a free trial to Metastock. What I kind of just want to talk a little bit about is how easy this is to actually identify the patterns and kind of how automated it is and how customizable it is as well. So right here, you've got the automatic pattern identification. It's going to automatically show you where 1, 2, and 3 is. It's going to show you where that entry level is, where your stop loss is, where your targets are. That all gets put on a chart. It's all automatic. It works very, very well for you. In addition to that, with Metastock, you get the commentaries. So for example, when you get a setup, it's going to go ahead and give you the full commentary on the system. It's going to tell you how many days are remaining in the trade, where your targets are, all of that kind of stuff, just listed out for you. And we use plain English because we know when you're learning a new methodology, we want to keep that as simple as possible for you. But most of all, I just love how easy it is to kind of just scan through things. And it's a scanner you can run right now. Like, for example, I'm going to show it to you. I'm going to talk a little bit about kind of what I feel like is part of the Metastock advantage, and that's just your ability to scan through markets, whether that's US markets, UK markets, Indian markets, futures, like whatever it might be. The thing is with Metastock and the place where we get our data, it has all of the exchanges that are available for you, and it's super easy to do. And it's actually relatively quickly too. So let me go ahead. I'm going to type in 3S right here. And I'm just going to we'll look for a long setup. So you've got long setup right here. You've got a long signal. We've got short positions, short signal. There's a number of different scans that you can run. And it's all pretty self-explanatory in terms of what you're doing. Let's look for actually a long signal. Okay. And what I'm going to do down here is I'm going to come down here and I'm going to identify, let's go ahead and do the Dow Industrial, the NASDAQ 100, the S&P 500. Let's kind of put those all in a basket. Now I could do all the optionables. I could do all the ETFs. I could do the whole NASDAQ and New York Stock Exchange. You can do really whatever you want. I'm going to just kind of limit it to this because it'll run really fast. You can also run this on any markets that you want because we get our data from basically Refinitiv, London Stock Exchange Group. It's the old Reuters feed. This will be basically available anywhere in the world. Now I ran these a little bit in the wrong order. It's running a different type of scan first. I can run multiple scans, but it's gone through those 520 stocks very, very quickly. And it's going to kind of bring back a kind of a list of the stocks that kind of hit those parameters. You can run multiple scans as well. Now, there's a few things that I want to talk about in terms of this exploration. It's not like a lot of the other scans that are out there. It just ran it. It didn't have the results from the scan it ran yesterday sitting on a server somewhere that it's feeding to you. It's actually going through. And if I'm running a scan right now, I want to know what's active right now. And this will do that for you. Takes a minute or two. I mean, it's taken actually 57 seconds, But out of those S&P 500 stocks, if this is kind of, I want to find stocks that are entering long off of that 1, 2, 3 pattern. Well, out of those 520 stocks, the one that we're going to look at is Bath and Body Works. And how easy is that to do? Just puts it there for you. So I love the scanning. If I wanted to go in and open up this chart, I'll go ahead and do that real quick. And let me go ahead and apply the template for the 3S code, just so I can kind of show you the commentary again too. Let's go ahead and just do this, just apply the template. We're going to have that 1, 2, 3 identified. So you see 1, 2, 3, here's where it's entering. Had a 1, 2, 3 here, hit the first target, stopped out here, I think before it got to the second target. But if I just wanted to, and you can see how well this is actually worth. You got a 1, 2, 3 at the top here in entry, went right down to the target levels here, turned around 1, 2, 3, went up to the target. This actually looks really, really good on the chart. What I'm going to actually show you though is that commentary. So let me go ahead and go into view expert commentary. And this is another thing that I think is very, very unique. It's special to Metastock. If I kind of click on open in this window, it's going to say, okay, right now we've got the 1, 2, 3. Here's your stop loss, here's your initial target, and here's your second target. And it just kind of spells it out. It explains it to you. So I just love the integration in Metastock. I think the way that we do things is why Metastock has been rated #1 in its price category for basically 31 years straight. So as part of this, you'll get the 3S code. You're going to get access to that private Telegram room. You're going to get the user-defined parameters, all the bonuses that Silas talked about, the VIP support to help you get started. If you need Metastock, you haven't used it before, you do get access to all of the platforms as part of the purchase, but we will provide a trial to Metastock. And even if you're using like TradingView, for example, I would recommend you do take advantage of that trial to Metastock, because what you're going to find is the scanning is so nice. The ability to take 520 stocks and get one has a good opportunity that's actionable. How much time is that going to save you as opposed to just looking at charts? 519 out of them don't have any type of an opportunity at all. So the conference special that we're doing here at the event is $397. It'll include a 30-day money-back guarantee, access to all of the stuff that Silas actually gave you. We'll throw in a trial to Metastock real time if you need it. Go ahead and go to metastock.com/conf promo, metastock.com/sales chat, or give us a call at 800-882-3040. That's a great software program. People love it. I love the fact that for $400, basically, you get 12 months access to that Telegram channel and all the hand holding. And I love how, that's what the direction things are going. Everybody's providing really, really good support. And Silas obviously did a great job. So give it a go. $400, one-time cost. You own it forever. 30-day money-back guarantee. So there you go. We are, of course, Metastock. Greg, we're going to really quickly. Oh, where'd my price sheets go? Sheets. Okay, hold on. Greg, we're going to go ahead and quickly do a prize so we can keep on time. Let's see. Oh, this is the last one I have of this. We're giving away the Mad Hedge Fund Technology Newsletter, a 1 year, value of $2,500. Gives traders access to John Thomas's research, the news, all the stuff that he does. And it's basically highlights the important developments in tech. You get emails, texts, alerts every time that there's something new that's in there. 1 year, $2,500 value, and hopefully you're feeling random. All right, what I need from you, Greg,
I am feeling random.
I feel random. Dude, I won a random prize from the gym the other day. It was awesome. I felt so random. It was good. Let's see. What I need from you is a number between one. Gosh, sometimes it gives me these numbers and sometimes it doesn't.
7319.
That was the last number. Yeah. Let's go ahead.
Oh, that's right. We adjust every time.
No, I haven't updated it for yet. So if you haven't registered yet and you're watching on YouTube, go do it. I'm going to pull a new list right now.
I'm sorry, you ready for the number?
I'm ready.
1485.
Oh, normally we don't give first and last names on the internet because like Kelly doesn't like it. But I don't think Mr. Trader would mind.
That is not random. That feels very specific.
All right, that's all I have. It's a Yahoo address. Okay, I'll put you on the list. You don't necessarily have to provide full names when you come in here and do it. I don't have a country either. So if you registered as Trader, you're not the only one. But it does give you a chance. You might have been random just now. If so, what'll happen next week is John Thomas will reach out to you. Greg, thank you for the assist.
Thank you, sir.
Appreciate it. All right. Of course, for Metastock, you can get all of the offers that we're talking about today at metastock.com/conf promo. You can go to metastock.com/sales chat. You can call us 800-882-3040. If you're watching on YouTube, do me a favor right now and go ahead and hit that like button. Subscribe to the channel. I hope this has been valuable for you. And I'd love to see you at new events. And that's a great way to make sure that you see them, is to subscribe to the channel. So before we switch to the next speaker, I want to say thank you to the American Association of Individual Investors, nonprofit, help independent traders. They do the AAII investment surveys. I'm sure you've heard of those before. They do a lot of research and analytics. They do a lot of fundamentals. They also have an active investor division. If you go to AAII.com, you can find out more about those guys. So our next speaker is going to talk about gaps. I just learned a whole bunch of stuff on gaps, and so this is going to be really interesting. Melissa does such a good job. I like the strategies that she uses around gaps and the way she talks about them. And we've had, well, Melissa, how long have we had you on here? I think you've probably spoken a dozen times or so. So anyway, we love to have her in here. I love the strategies that she implements around gaps. Gaps are something a lot of people get really frightened of, just simply because, is it an exhaustion gap? Is it a breakaway gap? How do you tell? All that kind of stuff. Gaps are an important key to investor sentiment, and they tell you they're telling you something. And Melissa's going to help us understand that. Melissa, let's go ahead and get you started. How are you?
Good. Good morning. Can you hear me?
I can hear you. Yeah.
Beautiful. Let me know if you can.
And I can see the screen too. All right, we're batting 100 today, or 1,000. We're batting 1,000. Okay. I'm not really into baseball or sports really in general, but I think I got that right. It's your turn. I'll get out of the way. Thanks for joining us, Melissa.
Wonderful. Can you see the slide?
Yes, ma'am.
Good morning, everyone. It is a rainy day here in New York City. And as Jeff said, my name is Melissa Armo. I own my own company called The Stock Swoosh, and I live in New York. And the amazing thing about trading is that you can trade the US stock market and you don't have to come to New York or be in New York. Everyone wants to come down to see the stock exchange, which is all the way down at the end of the island, but you can actually trade the US stock market from everywhere or anywhere in the world. So all you need is a live feed platform and you can trade. And actually today we're going to talk about trading. We're going to talk about trading on the side of institutional money. I can look and see the questions as we go along today. There is Sean. Good morning. How are you? And anyone else that has any questions, you can just plop it in the room. So I also appear on TV. I talk about the stock market. I talk about the economy. We're less than 2 months away from the election, which is really, really hard to believe. So we're going to continue to see volatility. We saw the rate hike last week from the Fed. And now there's all kinds of talk about what's going to happen into the end of 2024. Are we going to get a rate cut last week? Are we going to get another rate cut? Or are we going to stay? And again, the market has been expecting all year, very bullish, made lots of new highs this year, but the market all year was expecting rate cuts. And then we didn't get anything until last week when we had the 0.5 point cut at the end of September. So I think the market was anticipating that, but the fact is we're at new highs again today in the SPY, and you can't disagree with what's happening here when you're seeing so much strength coming into the market. And for me, what I do, we're going to talk about today, which is gaps. But if you have questions, you can feel free to reach out to me. You can email me at melissathestockswoosh.com. You can call me at 929-3200-GAP. You can follow me on Twitter, Facebook, YouTube, or Skype when I'm on TV. I try to put my hits when I'm going to be on Twitter and on YouTube. So I have in here the stats. This actually doesn't have the last week and a half, but I have in here the stats from the trading room. I run a live trading room every single day, Monday through Friday. Opens at 9 a.m. We trade between 9:30 and 10 a.m. Eastern time. And so I call day trades in the room. I'm day trading on margin when I'm doing the trades in the room, which means you need a margin account. These are not options. I have an options newsletter. I'll show you the stats in a minute, but my average risk per trade for the day trades is $3,000 per trade. You can risk more, you can risk less, but you need a margin account to day trade. So my results for the year so far, over 650,000. And again, I have to add in here the last week or so, but for options, same strategy, trading gaps, I'm just risking more in my options trades. I'm risking an average of $8,000 per trade. You can risk more, you can risk less, you could do one contract if you want. And again, my results are roughly around between 70 and 75% win ratio for my trades. So all the losers are in parentheses, and then the winners, these are the stats for the options newsletter this year. So over 2.6 million. So for the year, and not including the last, like I said, 2 weeks, over 3 million for the year. So I'm mostly short, which we're going to talk about today. We will talk about one long, but the fact is that I do mostly short. So it seems kind of, ironic that I'm shorting in a very bullish market. And yet that's exactly what I've been doing. Now, sometimes I do go long. There are some trades we do go long. We did NVIDIA calls. That was a long this week. But the fact is that I'm mostly shorting. So every once in a blue moon, I will go long. And if I go long, I say it's really, really good because I rarely go long. Again, NVIDIA had a beautiful bullish gap up on consecutive days and went over the 125 number, got over to the target, and even looks higher. Even though today, right now, at this moment, it's selling off, NVIDIA is actually still looks great on the chart. But getting to what I was saying about trading, getting these types of results, how do you get them? Again, you need conviction. So you need conviction to make money, and you get that from understanding why. So as I said, I live in New York. I actually had my first live class this past weekend in New York City, where people flew to New York to meet me, and it was Friday, Saturday, Sunday, and it was interesting because I never did a live class before, but the feedback from the course was very, very good. People really got the concepts, and I projected on a 68-inch screen my charts in the class and was pointing and explaining things. And again, every time, I'm explaining something, they say, oh, I get it. I see what you mean. If you're taking a trade and you don't understand why the stock's going to fall if you're short, or why it's going to rally if you're long, it's very difficult and very hard for you to stick your money behind the trade. I see some questions here. Let me just kind of back up a little bit. Forex, I do not trade Forex. For that market is a different market. And again, the US market has a close and open. So I'm not doing Forex. Forex is currency pairs. So you're only trading the currency pairs, whereas with stocks, I have hundreds and hundreds and hundreds of things every day I can look at to trade. So it's very, very different. And also the hours are different for that market as well. So for me, I'm focused on stocks, trading the US stock market. But getting back to what I was saying, when you have conviction in something, you could take the trade and put your money on, and you won't sweat a bullet if it moves against you a little bit, or kill it, or get in quick, or get out quick, or second guess yourself. It's better if you understand why, okay? And again, we were talking about the US election. It's in a few weeks. I have no idea what the outcome of that's going to be. Like if I said to you, you have 100% conviction, who's going to win? You don't know. You have no idea. It's a 50-50 crapshoot at this point. So again, the market, I can tell you this, what I do have conviction in about the election is the market is going to have a reaction, but I don't know who's going to win. And then I also don't know what the reaction will be. I was on TV, I was on Fox Labor Day, and I said, I said it on the hit, 2016, if you bought the market, the QQQs are the SPY, I said the market, but it's the ETFs of the S&P. You bought the market the day after the election, 2016, you're up like over 400%. So The market's going to have a reaction. We don't know what it will be, and we don't know who is going to win. But volatility equals profits if you know how to trade. So in other words, there could be a lot of opportunity going into the election to actively day trade, again, do options. And then there also could be a huge opportunity after the election to take possibly long-term positions in your IRA, or in swing trades even, or active day trades. So again, you want to take advantage of these opportunities because that's how you're going to make money. And sometimes opportunities like this don't come along every second, every day. So how can you earn a living trading? Number one, you need a winning strategy. Number two, you need a supportive mentor, which I try to be for people. Again, my class every month is usually online, and I allow people to call me, email me, ask me questions after the class. That's a good thing. I want to be here for people. I want people to be successful and make it. If they are, they will stay in the program, and then they will refer friends and family. So it benefits me if people understand and grasp the concepts and do it. So I do my best to teach. And then you also want to become an expert in one thing, which is what I've done. I've made a whole career out of trading nothing but gaps. And specifically, like I said, I focus on shorts, which we're going to talk about today, but I really am only doing gaps no matter what. So again, how do you make money in the market? You have to be able to predict the direction something's going to go. So if you're able to do that, you can make money. So I'm not taking the trade before the gap occurs. And again, I'm going to explain what a gap is in a minute. But if I see the gap and I can predict that it's going to go down, for example, then I can short it and I will make money as the stock drops, okay? Because when you're shorting something, you believe the price is going to drop. Same thing in the reverse. If something's gapping up, I look at it and say, do I think this is going to move higher? Is it going to get bought? And if I do, then I go long, like I just said about NVIDIA this week, okay? So it's all about the control. The control is very important. In fact, there's nothing more important. So if you're on the right side of the control of who's controlling the stock, you're going to be able to profit. Now, it may or may not be the case that your trade goes this second, right away, this minute. Sometimes it takes time. But if you have 100% conviction in the control purpose of where the stock's going to go or the market, you will be able to make money. So it's about determining who is in control. And again, this is many times where traders get it wrong. They're in the opposite side, okay? So you need to focus, okay? And my focus is gaps, and particularly shorting, which we're going to talk about. So why do I prefer to short? What are the benefits of shorting? Stocks just drop faster than they rally. We shorted Visa the other day. Again, that was a news gap. Okay, actually, there's the DOJ is going after Visa, but the fact is it fell off a planet for 2 days straight. So panic will come into a stock very fast, very quick, won't even look back. And so I like fast trades. I mean, if someone could say, well, you can make $1,000 in 5 minutes, or you can make $1,000 in 6.5 hours, I would say 5 minutes. Okay, so I always want the fast trade, always. Okay, and any questions, you can put it in the room. So let's talk about what is a gap. A stock gaps when the opening price today is different than the closing price of yesterday's trading. A gap is a break in price action from one day to the next. Simple. Okay, so here was the Visa. I was just talking to you about this. So Visa gapped. So take it out. Again, we're going back here. It was 3 days ago. Stock closed here, gap down, open, dropped. So what is a gap? A gap is the difference between the close and the open. So Visa here closed at 4 o'clock this one night when the market closed. Stock market always has a close at 4, and then gap down at 9:30. Again, always has an open approximately 280 and fell. The stock actually within the 2 days came all the way down, broke 270, came all the way down. I forget the low, it was like 268 and change. So again, this was a gap down, okay? So if you bought a put here, if you shorted it, which we did, you would have made money. So again, I rated this gap to determine if it was going to fall or rally. And I determined, ooh, it is going to fall. And then that's how we did the setup. So how do I do that? I have a rating system. It's a checklist. And this is what like I said, I've taught in the live class here in New York this past weekend. I go through the checklist 1, 2, 3, 4, 5. I go through all the 26 points. If I get 20 points or more, I will take the stock in the direction of the gap. If I don't, then I don't do it at all. So I never flip it. So again, a lot of people that are trading the market want to do things as gap fills. Gap fills do not work consistently as a way to make money trading gaps. Every once in a blue moon, something will do what people term or could qualify and say is a gap fill, is really not doing anything at all. But for every one time that works, 30 times it loses. So it's not a strategy that anyone should apply or use in the market to have consistent profits. Again, one of the reasons the stats are so good for the win ratio that I have, which I showed you at the beginning, is because I'm consistently looking for the same thing. And again, I'm looking at it in the points, but it's basically in the daily chart, So the rating system helps me determine who is in control. And this is the most important thing. Like I said, if you actually knew who was going to win the election, oh my God, can you imagine what you could do with that information? Of course, no one knows. But the point is, it's the same thing with a stock. If you actually knew what the earnings were going to say for Costco, for example, Costco's out tonight. Costco's very expensive. It's crazy. It's over $900 a share. I don't know if we're going to do any trades in Costco, but Costco has earnings tonight. If you knew what the earnings were going to say, if you knew how it was going to react after the earnings, that would be able to be very helpful for you to make money. But we don't know those things. But we do know Costco has earnings. I'm going to watch it. Costco's probably going to gap. Whether or not it is a good bearish gap or bullish gap or good long or short, I won't know until after I see it. And then I apply the system and the criteria to be able to figure it out, okay? So it's all about the consistency, because if you're consistent, you're gonna be able to make money. So again, stay on the right track, When I started trading, I was all over the place and I didn't know what I was doing. Again, it was a long time ago, 16 years now. I was not making money when I first started. I took one class. I didn't learn how to make money in that class, but I knew that there was something to trading. I knew I could make money trading, and I knew I had to figure something out. And I gravitated towards gaps because I saw the power of gaps, and particularly the power of shorting. And then I focused on that, and I never really veered off of it. And then it took me 3 years to develop my system. I think one of the classic mistakes that many traders make is they get caught up in again, the excitement of making money and profiting in the market, but then they never really stay on top of one strategy. Now, not all strategies work. That's a fact. But some do, okay? And if you're consistent with something that does work, that is where you're going to be successful. And then a lot of times people blame themselves. They say, well, my discipline and this and that. Listen, you can make money even with horrible discipline if you do the right thing. So it's just like a lot of times just people are all over the place because they just don't have a good strategy. So one of the cornerstones to everlasting trading success is consistency. It's so important to stay consistent with what you're doing. Without this, it is hard to stay in the market for any length of time. You will lose money, make money, refund your account, and be all over the place. In order to be consistent, a person needs proper focus on what counts. And for me, I focus on stocks that are being moved or controlled by institutional money. And how do I determine that? Again, I rate the gap. Okay, first, I'm not predicting the gap. So I like Visa. I didn't know the DOJ was going after Visa and was going to do that a couple days ago. I wait, it was Tuesday actually, and I see the gap, and then I apply the criteria. So gaps happen in the market on a regular basis, which makes it a good strategy also to trade. Because if you're looking for something, again, where you have to have something that it's like a couple times a month, it's going to be hard for you to make money. You got to have trades to look at almost every single day. I mean, sometimes we take a day off, but for the most time, we have gaps to look at. And some gaps are just better than others. Some gaps are nothing gaps, and some gaps are very powerful displays of institutional money. The most important gaps in the market are gaps that signify a change in direction or a bigger move in the same direction. Understanding which gaps are meaningful and which gaps are not meaningful in the market will help you to know what to do, which is very important, and then when a change is occurring. Because again, nothing goes straight up forever, nothing goes straight down forever. And that is how you know when the power of money will flow to pay you. Because again, if you take a position in something and it just moves a couple of pennies or 5 cents, 10 cents, it's going to be hard for you to make a lot of money in the market or any money. You're the stops that you take, okay, are never going to be covered by the wins. And then you need some big winners too. So you need to have more winners and losers. And then you also have to have some big winners. So again, we were talking about gaps. I'm going to go back to the day after Labor Day. This is the SPY. So this, we had Monday, the market was closed. And then the 3rd was the day after Labor Day. And the SPY gapped down. So it closed here at 4 o'clock Friday, gapped down here on Tuesday, opened, dropped, fell. So this was the week, actually, first week of September, the market sold off. This was before we had the Fed lowering rates that 0.5 point last week, which really had a small little baby reaction from that. We didn't have a big reaction from that in the market, in my opinion, last week. Like I said, it was expected. But anyways, this was a move to the downside. You could have bought puts, okay? Could have shorted the market here, and it fell, boom, okay? So we gapped down here. We were right under 560, came all the way down. So in a couple of days, we moved down 20 plus points. That's a big move. So what happened in that particular week with the market? Again, we're looking at the SPY. It got dumped. Okay, what do I mean by institutional money? Big players on the market, hedge funds, big traders, banks take positions on and off in stocks on the overall market. And again, that was all before the Fed lowered rates. So again, that's been expected all year, but that was a sell-off prior to that Fed meeting. But every time I'm looking at a trade, I'm looking for institutional money. So becoming a successful trader and investor requires becoming a specialist. Like I'm a specialist. Look at something and say, this is going to rally or this is going to fall, okay? I look at Visa, 6 o'clock in the morning, 7 a.m. I said, this is going to fall today. And then lo and behold, it does. So I'm a specialist, but I'm able to predict where the stock's going to go before it does it, or the market. And how do I do that? By charts, okay? So it's technical analysis. It's very important to have charts, and you got to have good charts. Learning advanced technical analysis is required. If you don't understand anything about charts, you've got to get good at charts and chart reading. It means reading the price action in charts. This is the only thing that you have. If you're looking at, again, economic news or data, they're revising it all the time. If you're looking at the Fed to do something, they're changing their mind. They're not doing things when they say. It's very unreliable, anything other than the price. But the price right now, today, the 2nd, 11:22 on Thursday, if you looked up the price of the SPY or the Qs or NVIDIA or anything, we'd all have the same number, okay? So this is split-second delays when we're getting the data. Comprehending how to read, define, and trade with this power will have a huge positive impact on your profitability as a trader. Because again, that's how you're gonna make money. Elevate yourself, your trading, and your profits to a higher level of consistency and success by learning how to read the footprints of institutions trading in the market. And there's a lot of them, okay? Every stock we trade has volume. The market has volume. And again, we're gonna see that going into the election period, into fall. Earnings season begins in 2 weeks. Big, big time to trade. It's the week of Columbus Day. Again, Tuesday is October 1st. It's hard to believe. But 2 weeks from now, we start earnings season, and institutions will put positions on, take positions off during earnings season, and we will get a lot of gaps. It's a very optimal time to trade. It's the time that you want to be active in the market. You want to do options. You want to do calls, puts, everything. You want to be looking for the footprints of institutional money that are coming in that are, again, buying stocks or selling stocks, okay? Any questions here so far? How are we doing? So let's talk about NVIDIA. So again, interestingly enough, like I said, we did calls in NVIDIA this week, but we did do puts that one particular day. NVIDIA fell, the market fell. NVIDIA helped the market fall. This was that same day on the 3rd at 10:35 in the morning. I sent out the options newsletter to buy the NVIDIA 110 puts. It was a good trade. It was cheap. $1.70 was one contract. You could have bought one. An advanced trader risk, you could have risked 8,500, made 22,750. If you took around 1,000 average risk, you could have taken 7 contracts, risked 1190, made 3185. This is a good trade. This is not even holding this the entire way down. This went almost to 100, got to 100 something, and I got out of it before then. It was a 268% return on investment. This was a really nice trade. So let's take a look at it. It was, again, this day here on the 3rd, NVIDIA gapped, stock closed here, gapped down, fell off a cliff. So this is a good exit here or here the next day, but look where it went, take it over. It almost came all the way down to 100. Really nice sell-off, really nice sell-off here. And again, you're up over 100%, 200+%. I think you get out. But if you held this, this never went anywhere up from this original gap, okay, which was September 3rd. So when I'm doing options, everyone always asks, I'm trading momentum. Momentum. So in the case of snow, we did a put. This was snow that actually fell and expired on the 30th, okay? So this, again, cost $3.50 and 100% turnaround, sold at 7. Return investment was 100%, 4 contracts, you could have risked 1,400 and made 1,400. Let's look at the snow. 822, again, beautiful gap in the snow. Snow was earnings. Stock closed up here around 135, gap down here around 121 and change, open, rallied, dropped. Again, see where the snow went. So how do you do options? Again, I called the 120s. The stock fell all the way down to 115 and broke. Again, beautiful sell-off, beautiful trade. Again, trading momentum. You want a big fat red bar. If you're in a put, if you're in a call, you want a big fat green bar, okay? And again, this was an earnings gap in snow. Someone's asking a question. Let me see. Is the golden gap a specific type of gap? Yes, it's a gap that rates 20 points or more per my 26-point rating system. If it gets a 17, 18, 19, the rule is not to do it at all. 20 is the cutoff. So yes, it is a specific gap. It is a gap that has so many criteria. 20 is a lot. You don't have to get 26. You don't have to get a perfect score. But if you're rating, say, 3 things, 4 things, 5 things, I put them in order. So the higher the rating, the better the gap. Okay, so I may do a day trade and a put, which we did in the snow. It's really, really good. Okay, now as far as what if it's like rates 15? I'm not going to do it at all. So again, the criteria is telling you this has so many things in the snow, for example, or even the Visa, that this is telling me this stock is going to fall. You know, I don't know exactly that it's going to go to 115. I have my targets on the day, but I know this is going to go down. The other choice is it could go up. Now, it didn't go up. We were talking earlier, people do things for gap fills. A lot of times people will look at this and say it's going to rally and fill the gap. That's a wrong way of thinking. And what I've found in teaching people for as many years as I've had the stock swoosh, okay, like 12 years going on 13, like people will trade gaps for gap fills, lose a lot of money, and then they don't want to ever trade gaps again, but they're just doing the wrong thing. You can't buy every bearish gap for a gap fill, and consequently, you cannot short every gap down to fall. So that's why I have 26 criteria. It is not that simple. A classic mistake, again, that traders make as well is they just want to look at one thing or 2 things. They want to be very black or white. It's not like that. You're learning it. You're grasping the concepts. You're gaining the skills. You're understanding each of the points. And every time I'm going through and rating all of the points, I'm getting more conviction in snow, or maybe I'm getting less. Maybe I'm getting less conviction. I say, oh, I don't want to do it. But a lot of times what traders do is they wait till the open, might have a watch list, don't even know what they're doing, jump into a trade, maybe don't even do anything till after 10. And a lot of the times, I'd say 95% of the time, stocks will go with the overall market, whatever the market's doing in the day. And the market's very unpredictable. And even if you tried to rate the market gap every day and predict it, you wouldn't be right that often. The market does a lot of things sometimes that have no control. It could be news, it could be Fed. You had people talking from the Fed today, which is one of the reasons you're seeing a lot of volatility in the market this morning. So anyways, I'm sometimes in and out of the trade before anything even happens, you know, later in the day. But using a 26-point checklist helps me stay on target to take good trades, make the money, not ever trade, take the profits, get the momentum. And when you think about it intellectually, like, okay, this totally makes sense. I can apply the system, use the criteria. I'm looking for high odds. There's no 100%. Again, I have the stats earlier I showed you. I have the losers in there. There's no 100% anything, okay? So the reality is you have to look for trades that have a high possibility, high chance of working, that you want to risk your money or hard-earned money, however you saved it or scrimped or saved or worked hard for it, that you open up your trading account. You want to take that money and expand it and grow it. And there's no way that you can take every single trade and make money. And I think people start out trading and they want to do it and they think they're automatically going to take every trade that works. It's just not reality. So it's about taking and using a system, applying it every day, using the criteria, and then having more winners and losers. And then when you have a loser, it's not the end of the world, because you know the next 10 trades or 20 trades or whatever are going to win, because you believe in the system and you understand it and you think it through. And there's always forces at play sometimes that are things that are out of control. And that's what makes the market. And that's what makes both sides of the market, obviously, okay? And when you think about it, it totally makes sense. How do you make money? You've got to trade on the side of institutional money. They're the ones that are moving the market. They move the market up to new highs. They're the ones that are moving stocks, okay? I'm not trading penny stocks or low float stocks. You can't make this kind of money trading that junk, okay? And it's very risky. You have to take too much size. And also institutional money isn't trading any of those stocks either. So if you learn how to read the footprints of big position players before the momentum occurs, you can take the position in the right direction and then get out after the move happens for profit. But you have to understand how to trade with the side of power, and you need to know how to find it. So knowing how to read what institutional money looks like is just essential to becoming a successful trader, and you can win big trading on this side of power. And then that's how you can have a career out of it. That's how you can do this for a very long time. Again, I've been trading now for more than 15 years. But gaps are the most powerful show of price action in a chart. And again, having charts is extremely important, but you got to understand them. So for me, again, I go right to the gap. I go right to the gap, and my eye just does that because I've taught myself how to read gaps on a chart. So a lot of people are looking at all kinds of indicators and things to make decisions. If any one indicator or combination was the be all end all of making decisions to go long or short a stock, it would be very easy to trade and no one would ever lose. Again, trading is not black or white. You have to analyze it. You have to look at lots of things, and you use that information to make a decision. And then if you do that, you will be right more than you were wrong. And then all you have to do is determine your size, how much size you want to take, small size or big size, and then where do you want to get out. So gaps have large moves. Gaps can move up or down. Again, like we're talking about, but I prefer the shorts. Some of the biggest momentum moves, though, in a daily chart come from a gap. Okay, so again, if you look at the SPY, and again, I'm just going to go back to this week here, this is a big move for the SPY. It was a 20-point move that happened in 1, 2, 3, 4 days. The market wasn't even open the whole week, because remember, that was the Labor Day week. So again, the biggest moves happen from gaps. And again, this was the instigator here that started it all on the Tuesday morning, closed here, gap down, and then boom, just sold off. So I was talking earlier about the Fed and how they cut rates last week. Surprising, you didn't see something crazy happen with the market with that, because again, we were expecting it. But if you look at fundamentals and you want to read up about stocks with snow earnings like Costco tonight, you say, what are they going to do? That's great. If that helps you take the trade, fine. But you shouldn't be looking at that for active day trading, okay, short-term options to make decisions about doing stocks, because it will never add up to what you want all the time. You could have great fundamentals, good earnings, the stock could sell off like a crazy person, or the opposite, the reverse. So you just don't know. It's not reliable as a way to take a trade. And again, you're making money, you're taking your own account. You've got to get the move, got to get in, get out quickly, okay? Any questions here so far? How are we doing? Okay, I'm gonna keep going. So a big flow of money going in a certain direction is what moves the market. Stocks creates momentum and sets the trend in charts. When you're looking for institutional money, you're really reading the side of power in a stock, okay? You wanna be in the side of power in order for you to make money trading. Institutional money is in charge of the market and stocks at all times. And even if you think it's not, it actually is. That's the crazy thing. It is. Even if you think it isn't, it is. Like right now, the market is, or was this morning before I logged in here half an hour ago, the market was selling off. You say, oh my God, ooh, let's short it. No. Institutional money right now is in charge of this market, and it's strong. So the market, even though it's red, or was this morning, even if it is right now, I would not be short this market today, okay? So again, you got to focus on one thing, hold on to whatever you're doing and stay with it, stay with that exact same thing. Again, someone's asking about this morning. You know what I think? I think the market is going to move up. So again, we could flip today, go green today, or gap up again tomorrow and push up into next week. That's my 2 cents on the market today. So again, traders get caught in that. So they get caught in this, but you're against institutional money at this very moment at 11:35 if you're short this market. It's irrelevant if you made money even trading it out of the gate. It doesn't matter. It's the wrong thing to do. Like I said, if I read something and I get a rating and the rating is low, you know, under the 20 cutoff for my criteria for 26, I don't flip it. I don't ever flip it. Okay. So again, like I said, I taught the class live this weekend where I was standing in front of people, and then I was standing in front of a chart, which usually I'm just pointing, like today I'm pointing at charts here with the pointer. You know, if I'm standing in front of you and I'm explaining things to you or pointing at a chart, and it's like a window into my mind, what I see before the thing happens, you know, where I'm saying, this is what I see here. Like my brain has a way that I look at things. And I've been doing this for so long. So there's people that are trading and doing other things that are trading maybe longer than I'm alive. But the fact is that they're doing many different things. The experience and expertise that I have gained on doing nothing but gaps for the last 16 years has really given me an edge to make money, which is exactly why I do. And I have a successful business for this long. Why people flew to New York here to meet me this past weekend. You want to become an expert. That's it. That's all you need to do. And then whether you have a small account with $2,000 in a beginner options account, or you have $2 million in an active day trading account, or you're trading your retirement account, because you can buy puts and calls in an IRA. It's just taking it and growing and building it up if you're good at one thing. It's like, think about sports. It's football season. I don't get into football. Like, you know, I watch the Super Bowl or whatever, but that's it. But like you have people that are playing football. That's it. They're really good. They get paid a lot of money to do that one thing. They're not trying to play baseball and tennis and this, that, the other thing. They're really good at being a quarterback or whatever position they play. You understand what I'm saying? It's the same thing in any career in life. I don't know why traders think that they can become a jack of all trades and actually make money in the market. You're never going to get good at it. And when push comes to shove and you're trying to make split-second decisions about trades, or you're trying to make a decision on the direction of something, whether to get in or get out or even do it at all, you will inevitably make the wrong decision more than you will ever make the right decision, because you will never have that sixth sense. I have something that's like an overlay. It's like the 27th point or whatever you want to call it. If you're in the room with me and I read something and I'm saying to do it or saying to get out, that's something that I cannot impart on people because it's experience 16 years. So again, when you are doing something for a very long time, you will really get good at it. And if you're all over the place doing different things, you're never going to get good at anything, because you only need one thing to get good. And everybody wants to make a lot of money. I get it. But you're never going to make a lot of money if you never get good. You just won't. Like, I'm just telling you, you just won't. And you might be making some money, or maybe some years you are, some years you're down. It's the application of doing something consistently and becoming an expert in it that's really going to put you head and shoulders above many of the people who are trading the market. Because a lot of people are after the money, but they're all over the place. And they always think the next thing is going to be the get rich quick thing that's going to make them $1 million and have all the losses of every trade that they ever took for the last 20 years and every class that didn't work, that they want their money back. And they jump around from thing to thing to thing. Sometimes people sign up for very cheap classes, $500, $1,000, and then they lose, 50 grand trading a terrible system. You have to be like normal. I hate to say it, but in normal real world, it's totally doable to make money in the stock market. We know that people can do it. You wouldn't be here if you didn't believe that, okay? It is not the real world to be able to jump all around, never get good at anything, and to think that you're going to become successful. You're just not. You're just not. I mean, it's just like, that's just not reality. Whether you have a small account or a big account. People say, well, if I had more money, I could do it. No, if you had more money, you would just lose more money if you don't know what to do. I mean, that's just reality, okay? So as soon as you get grounded and understand that getting good at something is going to move you forward into the end of 2024, into 2025, you're going to be where you want to be. You may be struggling at this for a while or not where you want to be for 2024, not be up for the year as much or not even at all. Maybe you're down. But as soon as you get on the right foot and start to move forward and get in a good path, you'll be amazed at how fast it can happen for you, and it will all come together. Because once you're in this la-la land, it's just never going to come together for you. But like I was saying, it's about working smarter, not harder, which is focus on the open. Okay, so again, here, this is just what I was talking about, become an expert. In order to become successful in the market, you have to become a specialist in one specific strategy. A strategy that reads institutional money is what I do. It's gaps, and it's power money in the market. This brings momentum and opportunity. Every trader on every level must learn this skill set, and it can be acquired through education. And I think that's extremely important because, again, you want to do well. So I'm going to go over here 1 week of trades. This was the week before Labor Day. This was an average risk of $3,000 per trade. We did BA in the 26. We did the Qs. We did 2 Amazons, Foot Locker, no trades on Thursday. We did Dell twice. One was a loser and then 1 winner. I'm going to go over all these trades here really quickly. So 826, here's the BA. So again, we entered this here at 173, got out of this here at 172.50. Again, here's the 26, take it up, stock close here, gap down, dropped. I want to point out, because we also did this here, that the BA fell on the 3rd. I don't have that in here, but you could have bought a put in the BA then on the 3rd, but we did this back before, okay? Actually, you could have just been short that, and you would have gotten that drop in there then a couple days before. Then we did the Qs. This trade was up, but I stopped on it break even. I didn't get out right. I was focused on the Amazon. I was doing too many things that day. This was here. Stock closed here, gap down. I was up in this tail and I didn't get out of it. But anyways, this was a profitable trade. I killed it break even. Then we had the day here where it fell off the planet, boom. Then this was again the week before. This was the one I was involved with, this Amazon-y thing. This was the 27th here, closed here, gap down. I did 2 trades in this. Was a nice little short, okay? Again, almost got $1 out of it, shorted at 174.10, got out at 173.25. This is a day trade. And then I did a second time, was trying to squeeze it down to 172. Again, this was the same day here on the 27th. And then Foot Locker was a big one. This closed here, gap down. Foot Locker was earnings, rallied, fell off a cliff. I got out of this at 28.65, but I just want to show you here, this went all the way down to 27. So I could have made another $1 out of the Foot Locker, but I played this in the morning, got out. Again, it made 3,900, and then we did no trades on Thursday, and then Dell was hard. We took a stop at the Dell, went long as 1 minute on Dell, got stopped in Dell, got back into it, got the move up, got the rally. Again, longs take longer to go. It's just a fact, and that's why I prefer to short. But this was a good long. This was a bullish gap up, and I did do the Dell, and this was the big trade that we did in the afternoon. Then again, it went up into the lunchtime period. It worked, but I took a stop first. And again, I use stops. It's a limit order stop. It's a hard stop. Again, this was an average week. We didn't trade the 1 day. We had a loser. So again, on average, you will be doing trades with me if you come in the room 1 a day. This was an 86% win ratio. Some weeks were a little bit higher, some weeks were lower. But again, on average, you should look to expect, I would say 75% on average through the whole year, like of the winners versus the losers. But every time I'm taking a trade, I'm chunking it out. I get in, get out, I'm booking the money. And again, shorts move so fast. Like again, the Visa was crazy the other day, just fell off the planet. And again, I prefer to short. It's just the panic that comes in. And even if you're doing an option, if you buy a put on a Monday, no one says you have to hold that trade to the Friday. Like I didn't do that on the Nvidia. You can get out of it the same day if it falls. You can get out of it the next morning. No one says you should hold something to the last day if you're up. Certainly if you're up more than 100%, you're running up against the time of the expiration and you will run out of time, and you also lose time value. When I'm doing options, similar concept where I'm going after the gap, where I'm trading the momentum in the gap, okay? So again, how do I find which gaps to trade? I rate them, and I'm looking for institutional money. It's power money that's going to come in and move the stock. How do you find golden gaps? You can find gaps anywhere. It's rating them and picking them and qualifying them. That's what you're going to learn from me. But it's easy to find gaps. Like I said, there could be hundreds and hundreds of gaps every day. You will come into the class from me if you want to learn it, You will learn how to rate them with the checklist. They have to be qualified. You can't short every bearish gap, and you can't go every long every bearish gap, and vice versa, like we were talking about the SPY this morning, which actually gapped up. Okay, the checklist tells you what to look for in the price of the stock. And again, I'm doing all of this on the daily chart. This was another one here. This was last week. This was FDX. Just want to show you, I called puts in this. Again, the stock closed up here at 300, gapped down in the morning, just totally tanked. Gap down here, fell. You could have bought a put in here, and you could have made money, done, boom. Could have shorted that as a day trade as well. That was Friday the 20th. Fell all the way down, almost got to 250, okay? This was an earnings gap. We're at the tail end of earnings season. Like I said, Costco is tonight. But, you know, if we didn't have power money, it'd be hard to even get any movements at all in the market. It'd be hard to even trade the keys of the SPY. We want power money to come into stocks, and that is going to help us make the determination what we're going to do. So a lot of people say, oh, they screwed us, they did it. No, you're not reading it right. If you're in a trade and you get hurt in something against the market, or if the market happens in something with the stock, you're just not reading it right. They're doing whatever they're doing. They don't even know you're there, okay? They're just buying stocks and selling stocks. And again, institutional money can short stocks, okay? So one of the reasons I like to short is you're getting shorting, and then you're also getting selling, okay? But it's always the gap for me. I'm always focusing on that piece of information, because gaps will set the trend. They will create the trend. They will make the trend. And they will further the trend in a bigger move. And we're just looking to get paid with that. And again, whether you want to do a put, or whether you want to do a call, or whether you want to do it as a day trade is totally up to you. I like to do both. I find that the options allow me to hold trades overnight, which I'm not doing with my day trades because I'm trading on margin. So again, you can do this from anywhere in the world. You can trade from home. And if you decide you want to come and learn from me, you will learn how, what, and when. You will learn how to trade this strategy to be successful every single day on gaps. You will learn what to look for in the rating system, the 26 points. You will learn when to trade them. You will learn the entries and the exits. And this structure will help you stay consistent. You will not be all over the place. You will hopefully just be done in the morning. You can set your orders out in the options to fill you. If they fill, they fill. If not, you're in them overnight. You don't have to sit and stare at your screen all day for 6.5 hours. That would drive me nuts if I was doing it now, and I wouldn't get anything done. And you could be in a trade, and like I said, waiting for it to go. You're not going to push it. You're not going to move it. You focus on the gap and the rating, and that's what gives you the conviction to let the trade play out. Any questions here? Let's look over. Any new questions? We go.
I don't see any. You're
Okay.
doing great.
Thank you. So anyways, how do I know ahead of time where the stock will go? I rate it. That's what you're going to look for in the class when you learn from me. And I'm looking for, number one, a high probability of directional bias for hopefully the whole day, a big move in the day. That's what I always want, like the Visa, early confirmation of the bias in the move between 9:30 and 10. Try to get it early, and precise entries with follow through and a good risk reward potential. Because again, I'm looking for 1-to-1. If I'm risking $1,000, I'm trying to make 1,000 in a day trade. If I'm risking 1,000 in an option, I'm trying to make 1,000. So that's what I'm always trying to do, turn it over once. People that scalp, or they're getting in and out of 5 cents, 10 cents, I just don't think that that is enough of a move to warrant the risk, okay? So, you know, we were talking about getting good and becoming an expert in something. It's about leveling up. Maybe you ever heard of this? This really just applies to everything in our life, not just trading. So many people trade, and they're just trading on the fly, okay? And they're really not interested in learning. They're not interested in actually getting good. And then, of course, they're losing money, okay? Getting good is the only way you will ever make money. You got to take it to the next level, whatever that is for you, okay? You only get conviction if you're good. Otherwise, you have no conviction. I mean, everyone would say, well, I have conviction. This is going to happen. Yeah, if you take the trade and it's up right away, but what if it reverses against you? And then what if it goes? And if you kill it and it goes on to work, then you're mad at yourself too. You know, I would love every trade to go the second I take it, but that's not reality. Sometimes I'll get in a trade and it will reverse against me, and then it will go the next day. And a good example is Crowd. I don't have this chart in here, but Crowd had a gap that we bought puts in. It was a huge trade. It went the next day. So again, you have to understand what's going on. And like I said, you really have to level up. It's the only way you're really going to get to the point where you're good. Someone's asking a question. The Golden Gap strategy works for all markets. It works for the US stock market. I'm not trading Forex. You only have one gap because it only closes once a week. So it would not work for the Forex market. Okay. So this is for the US stock market, but you can trade ETFs and you can trade stocks using it. Like you could do GLD, and we talked about the QQQs and the SPY. So you also need a plan of action. Again, for me, it's trading only golden gaps that rank for the 26-point system, get the best entry, get in, get out, and then have a money management plan. You choose your risk. It should be based on the size of your account, of your cash. Ask me if you want to know what I think, but you have to have a plan. What are you going to do? When are you going to trade? How many trades are you going to do a week? Are you going to follow me in the room? Are you going to do day trades and options? What are you going to do? I do my best, okay? I do my best to be supportive with people and to try to help them. Yes, you can do indices. Like QQQ is an ETF. The SPY is the ETF for the S&P. So the SPY has a daily chart, okay? And yes, you can apply the system, the 26 points for the SPY, for example. So yes, you can use it for indices and for stocks, both. So you can use it for ETFs, but I find that I have, you know, I'm doing more gaps in companies, like we just talked about today, than I am in the market. I'm not trading the market every single day, okay? So getting back to what I was saying, having a mentor helps you, because if you get to a point and you have questions and you want to go to somebody, again, it's good that you can call somebody. It's good you can go to somebody. You can say, well, I don't understand this one point. Let me go back. Again, I teach it in the class. I invented it. I created it, and I've been teaching it, like I said, for 12 years going on 13. So the system I find is really what I do and apply myself. I never skip it. I'm not like, oh, I'm just going to trade on the fly. No, I go through the process. I rate the gaps. This is something that you would learn and do if you want to do it. So empower yourself today. If you decide you want to learn to trade, it's a complete system to trade the market. You learn the entries, the exits, and the 26 points in the Golden Gap course. It's a full course on how to strategically find, pick, and play stocks that are professional bearish gaps. The next class is October 19th and 20th, 9 to 5. Class is online. The tuition is $69.99 at $7 grand. If you want to sign up, you can sign up. I do have people already registered for October. Now I'm doing an option special. This is not a class. This is just a newsletter. This is only going on through tomorrow, through Friday. I'm doing $2,000 off the newsletter, which you would just get the options trades. You got to know how to do options. This ends, however, tomorrow. The options newsletter is normally $69.99 for 12 months. The fall sale is $49.99. This is a good deal. You get in, you can start to trade with us. You can get in, start to get the earnings season trades. You could sign up today and get tomorrow's trades. I don't know what we're doing tomorrow. Again, Costco is a question mark for me, but this ends tomorrow. And then I'm doing a Murder, She Wrote package. This is one of my favorite shows. Actually, Sunday is the 40th anniversary of Murder, She Wrote. Does anyone ever remember watching Murder, She Wrote? It was on every Sunday night. It's the 40th anniversary. So I'm doing a huge special for this. And this is running through October 4th. So if you signed up for the Golden Gap course bundle, you would get the Golden Gap course, the trends class, the gap options course. And then the special for the Murder, She Wrote is the market report, trading room, and newsletter free through the end of 2025, which is actually really, really huge. And this is $89.99 US dollars. This is going on for a week. And they're going to have some kind of marathon on TV. I've seen every episode. Let me see here. We have a couple questions. The Indian Nifty 50, don't know anything about that, what that is at all. Please give us 5 or 6 or 26 points. No, that's what I teach in the class. People are paying me for that information, and I couldn't even do that now in 5 minutes, nor would I. So, you know, again, we were talking about earlier, if you want to learn it, you will pay me to learn it and get the information. It's worth it. It's my time, it's the information, and then you were going to use it and apply it to trade for the rest of your life. I have people that are trading with me for more than 10 years. They did the class 10 years ago. They are still trading with me. So that really is a testament, because they would not still be in the room every day if they weren't making money. So I've had the business for that long now. Like, people come and they're there because I have, like I said, that extra 6 cents, but they could do it on their own. They rate the gaps in the morning. They come in, they want to hear what I have to say. but I would never have that kind of staying power with clients if they weren't making money with me. So this is a huge offer here because you're getting all of my trades through the end of 2024 and all of 2025. But again, if you just want the options, this is a good special going on through tomorrow. Any questions? And I'm done right on time for Jeff.
Great job. Appreciate that.
Thank you so much.
All right, very cool. So that's Melissa at the Stock Swoosh. Greg, if you would, will you put that in the YouTube chat for me? I've got it in the GoToWebinar chat. And I do remember the gold, well, Murder, She Wrote. I was going to say the Golden Girls, but I looked at Golden on your screen. All right, very cool. Thank you, Melissa. Much appreciated. All right, I'm going to do this. I'll make myself the presenter here. And go over here, share screen. Okay. Oh, hello, guys. I can see already. We'll be right with you. All right, very cool. That's John and Jack Kosar. They're the next presenter. Before we get to that, though, do want to remind you we are running the specials on Metastock. All of the conference promotions for the products we're selling here are on special. You can get them at metastock.com/promo. You can also go to metastock.com/saleschat. You can also call us at 800-882-3040. I want to say thank you to Stocks and Commodities Magazine. Stocks and Commodities Magazine has been rated, well, actually, this is the wrong thing, but a great sponsor of us. They've been making magazines since I think it was 1982. They've got 17,000 articles that you can have access to if you're a subscriber. And if you want to be a subscriber, you can become a subscriber by going to www.traders.com. So I also want to talk about joining the Traders Forum. If you go to www.thetradersforum.com, there's a lot of lessons up there. There's live market chat with other users. You can learn about the market. It's a community of traders helping traders. www.thetradersforum.com. Craig, do you know what time it is?
It's giving things away time?
It's prize time, yeah. It's prize time o'clock.
Well, I'm in Texas, so it's prize time o'clock +1.
Yeah, all right. So the next prize we're going to give away is Silas Peters' Price Action Weekly Playbook.
Awesome.
With this weekly price action alerts, you'll read the top trade of the week, so you can avoid hours of research in the market, daily market analysis, etc., etc., etc. Silas just talked. He started us off today, and he does a great job. I'm going to be one of the winners, I think, when it's all said and done. Should I sneak your name on there too, Greg?
Sure.
All right, cool. Don't tell Silas. All right, let's see. So what I need from you, Greg, is I just need a number between 1 and 7,319.
That number is 6922. 6,922.
That does sound truly random.
Oh. According to Google Random Number Generator, it is.
Stephen B. First name Stephen, last initial B, with a Outlook.com email address in the USA. Just won that prize. So
I noticed that the John and Jack just went away. I hope I didn't scare them off.
And I think they're like, well, it's not my turn yet.
Oh, that makes sense.
I think that's what they said. But it is almost their turn. So they do a great job. Let's see. Okay, that's all taken care of. Big thanks again for the assist, Greg. Appreciate it.
You're welcome.
And I would say,
I'm here if you need me.
All right, cool. I would say if you haven't done it yet, free membership, www.thetradersforum.com. You can sign up. There's the live market chat. I'm in there right now talking about trades and stuff. Well, right now I'm working, but you can learn about the markets, learn about candlestick patterns. Great community. A new adventure for us. Thetradersforum.com, a partner company. All right, very cool. Yes, Stephen, that is you. Congrats. I love it when the prize winner is in the room. Very good. Silence. Okay. Our next presenter is John and Jack Kosar. They run Asbury Research. I like bringing them in. They have kind of more of a macroeconomic view on things. Hey guys, I was going to make you the prize, but then you went away. So anyway.
Didn't want to feel the prize winner's thunder.
There you go. Well, I was just going to make you guess a number. In any case, Stephen, you don't need to do anything. He wants to know what he needs to do to the prize. Next week when I'm sweeping up after the conference, I'm going to send your information to Silas. He'll contact you. They'll get you all set up. You don't need to worry about it. If you don't hear from him, you're welcome to email me. But check your spam folder, because usually that's where it goes. So, John, let's go ahead and get your screen share going. Let's see. Let me make you the presenter.
How we doing?
I can see you guys as Mark. I can see it. It went on the wrong screen for me, and then I promptly got rid of it. But I can see you. You guys are coming through. The audio is good. Good. I'm gonna get out of the way. Yeah.
Can you see the Asbury screen with the Board of Trade right there?
Everything looks great.
Lovely. All right.
It's all yours. If you need me, I'm here.
Yeah, I'm just gonna rearrange some of the windows here so I can see my own presentation.
Okay.
And let's see. I'll slide this over a little bit, maybe. This. And I think we're clear. So if you're ready to go, we are too.
It's all you. Your turn. Go.
All right, great. So what we're going to look at today is whenever we get to this time of the year or this time of the quarter, whatever it might be, I think the markets get overwhelmed with what's the Fed going to do? What did that guy say? Who's going to win the election? And it's just a never-ending dialogue of people trying to determine things that are really impossible to determine as far as I'm concerned. So our approach is let's look at broadly, let's look at the money that is moving around the financial space. And what's the money telling us? Because whether we get the election right or we get the Fed right or how many times they cut or what day they cut, the only thing that really matters as investors is how the market interprets that and what the market does. So our approach is very much data-driven, rather than try to figure out what all of these news items all kind of mean together as they're being thrown at us from the financial press. We follow the data, and then by looking at the data, we can kind of backfit into how that would, in other words, instead of using all of these guesses that we hear coming out of our TV and out of our financial media stuff that we read, we watch the data, see what the data is doing, and then we kind of can figure out what that means in terms of what the market's expecting. So we kind of go at it backwards, so to speak. We look at the data to figure out the fundamentals and the econ and the environment rather than the other way around, which to me is kind of a fool's errand. It's just something that we really don't know. So what we're going to do today is we're going to look at how Asbury looks at markets. It's different. It's much different than when I started in the business 43 years ago. And hopefully this will give you just another idea on maybe how to look at markets a little bit differently. If you like our approach, obviously, you could use us as a kind of an educational supplement to what you're doing. We sell research and we manage money, but at the least, you should be able to walk out of here today and just have some new ideas about your research and what you're looking at and how you're looking at markets. And I hope you do. I hope you can get something out of this that's a little bit different. We're not your average market technicians. We do things a little bit differently, and you'll see that as we go into the presentation. So a little bit about us. Basically, Jack and I build financial markets together for fun, like some father and sons might go golfing or go fishing. you know, we like to play with numbers and we're very interested in markets. So we build models. We'll show you how we do that in just a little bit. I started out on the floor of the Chicago Mercantile Exchange in 1980. I didn't know anything about the markets. I was in a gym lifting weights with a guy who turned out to be a broker, a filling broker on the floor of the CME. It was actually in the cattle pit, which is kind of an obscure place to begin my career. But I got the job because I was lifting weights at the time, and the guy thought that I would probably be able to handle myself in the pit, bumping heads with 50 other guys. And it turned out I watched the guys that were making the most money back then were all the guys that were walking around the trading floor and knocking heads because they had their head down and they were filling out the point and figure charts. There were no computers on the floor back then, but they were making their charts. I very quickly got interested in charting. I used to make my own charts by hand like everybody else did back in those days. Spent 17 years down there. And during those 17 years, I learned that I can't forecast the future. It took me 17 years to understand that forecasting is great if you got a nice suit and you want to be on CNBC and you got an outrageous forecast, you probably get on there. But now everything that we do has to do with numbers. I launched Asbury Research in 2005. Jack's been with me really part-time for a decade, maybe. Something like that. He's full-time here now. He's the legacy for the business. So I'm the old guy that has used a lot of these tools and know what works, or think I know what works. And Jack's the guy who quantitatively tells me what's working, and we're able to really put a sharp edge, sharpen our pencil, so to speak, and really come out with some definitively answering the question, how does this work? You know, what's the risk involved in this? Jack's, I'll let him tell you his background, but his is the academic one that I never had. I'm the street kid that went on the trading floor, and Jack did what I wasn't able to do, and he's got the academic side of this.
Yeah, I've been in the financial industry for now about 10 years. I've bounced around in various operational roles, but I went and got my master's degree in Master's of Science Finance from Illinois Institute of Technology, really kind of focusing on corporate finance and portfolio construction, and you know, have the added benefit of been watching charting, various charting packages, including Metastock, for quite a long time. Yeah, I do my best to take the experience of someone that's been in the markets for 40 years and apply some new technologies and portfolio methods to make what we're doing here at Asbury.
I should get a gold watch for Metastock. I think that was my first charting package that I started looking at maybe in the late 80s. Yeah, so I've been using Metastock for a long, long time. Robust tool. You can do a lot of stuff with it. Anyway, let's go to the next slide. So basically what I tried to do is distill what we all want to know as people who invest in the markets. And I think there's two things. Should I be invested? And how much, I guess? And then the next question is, what do I buy? So a lot of the models, a lot of the tools that you're going to see us talk about today, try to answer those two questions. Try to get down to the heart of it, right? So that's what we all want to know. You know, the market is up 20 today. It's at all-time highs. We have an election coming up. Do I want to be in the market? How much do I want to be in the market? Do I want to be half in? Do I want to be all in? And then what do I buy to take advantage? Ideally, you're in the market when it's going up and you're in the places that are outperforming the S&P 500. So that's kind of a twofer. You know, you're in the market at the right time and you're in the places that are outperforming the market. Flip side of that is the market goes down or your indicators tell you to be out. How much should you be out? Should be a third out, a half out? A lot of that has to do with your own personal style. Some people never get out of the market 100%, but that's kind of what we do. We try to simplify that into those simple things. And the way we do this is we build models. We're building more models now. We've built a handful of models, excuse me, over the past 10 years or so, and we use the models to tell us to answer those questions. The reason I like the models now is because since I left the floor many moons ago, the market's different. The market didn't used to be this crazy where in the morning it's down 50 and at lunchtime it's up 50 and then in the afternoon it's down 30. You're seeing that more and more frequently, and for most people, myself included, it was forcing me to make a lot of mistakes. I'd do my research, I'd think the market was good, I'd buy it, I'd wake up in the morning, it'd be down 50, and I'm right away thinking, what did I do wrong? I didn't do anything wrong. The algo guys are playing with me during the day and forcing me and you and everyone else to make mistakes, get out of a good idea, and then they run the market up so we have to buy it back at a higher price. That's conspiracy theorist I may be, but I think that's what's going on now. I think what I used to see the locals doing in the pit at the CME in 1989 is now being done by guys with a lot more money, and they could do it stealthily, and there's no pit committee to keep these guys from pulling a fast one on us all. Okay, so we've got 5 different models. We're going to look at them all. Our CPM model is simply risk on, risk off. Should I be in? Should I be out? Our Asbury 6 model is a risk management model that we're going to look at. And what I built the Asbury 6 is I got tired of getting faked out by that very situation that I was telling you about. I bullish the market, market opens down 50, I get spooked out, and the next thing you know, I'm buying the market 3% higher 4 days later and kicking myself. This tells me what's going on under the hood of the market. I'm going to show you exactly the 6 metrics that we use for the Asbury 6 and how they help keeping me getting faked out of my stocks by trying to chase the tail of the S&P 500. Our CEF model is our alpha generation model. It's for sector selection. It's a sector rotation model that uses, Jack and I developed an algorithm, let's call it a methodology, that measures the velocity of money moving around the 11 sectors of the S&P 500, which if you put them together, it's the entire index. We look at it in multiple time frames. Over the past 7 or 8 years, it's on annually average annual outperformance since the middle of 2018 of about 9% a year versus the S&P, with slightly less risky risk characteristics than the S&P 500. A lot of the people we manage money for use all or part of their portfolio as CEF. CEF allows them to be in the market all the time. CEF never gets out of the market. It's in the market 24/7, but it's only in the market for the places where the money is going, and it avoids the places where the money is coming out. Our CARP model tells us domestically what's outperforming. It answers that question, where should I be invested? Should I be in large or small cap? Should I be in growth or value? Should I be in high beta stocks or low volatility stocks? And finally, our US versus the world model is for global asset allocation. I don't know if anybody trades overseas markets. Our model tracks 25 global markets. Right now, we're in 6 or 7 of them that have outperformed the S&P 500 by 6-7% since the middle of August, while the S&P is making all-time highs. That doesn't happen very often, but I mean, this is a way for us to be able to find times during the year where it's worth it to take some of our equity allocation and move it overseas. We don't get married over there. We don't stay there forever, but when opportunity knocks, this model tells us which parts of the world that we want to be invested in. So everything we do is back tested. some people say, well, hypothetical backtesting doesn't mean future profits, and it doesn't. Nobody knows what the future is. But I mean, there's a parade of guys in $3,000 suits that are going to tell you where the S&P is going to be at the end of the year. Do they know? No. They got a great suit and nice hair, and they probably work for a big firm. I would rather look backward and take my idea and see how it did in the past. Now, we like to go back about 6 or 7 years. We think if you go back too much farther than that, you start picking up different environments, different interest rate environments, different economical environments. Things change over time. So, you know, going back 100 years to when people were riding horses down the street, to me, doesn't make a whole lot of sense. I want to see relative to the condition. So we go about 7 years. So here's our CPM model. CPM is correction protection model. It's either risk on or it's risk off. The goal of the CPM is to give older, more risk-averse investors an opportunity to be in the market with a lot less risk. So you can, so here's year to date, here's CPM, and here's SPY. So you can see year to date, we're trailing by about 3.2%. We're trailing the S&P about 3.2% in a year where the market's effectively gone straight up. This is a defensive model, but you can see our maximum drawdown has only been 5.8% year to date instead of 8.5 for the S&P. Standard deviation for CPM is lower. Beta is 0.69 versus 1. So we're trailing a little bit year to date, but we're not day traders. I don't have systems here that make money every week. This isn't like getting paid for your job. This is what I'm interested in. This goes back to the end of September of 2017. Now you can see the annualized total return for CPM is 12.33 versus 12.5, about the same. It's pretty much stuck with the S&P 500 like glue, but here's the salient part of this. Maximum drawdown in the S&P was 33.9%, 34%. It's during COVID when everyone's hair was on fire and the market dropped like a rock. I remember being in a restaurant with a couple of colleagues and nobody can eat, right? Because we were looking at our phones, we were watching the market drop. CPM was only down 20% instead of 34% during that period. So the same performance, about 40% less drawdowns. And what does that mean to have less drawdown? It means that your starting place to make money was 14% better than it was in the S&P 500. That means you get back to even faster, and that means you start to make money faster. That's why limiting drawdowns is such a big deal. Standard deviation, only 12.1% for CPM versus 17.1 for the S&P. Our SEAF model, that's a sector rotation model, which we're going to get to. For the year, we are trailing by 1.4%. S&P up 18.6, SEAF rather, up 18.6. S&P up 19, let's call it 20%. Our max drawdown was only 5.7% instead of 8.5% for SPY. Our beta is 0.54, almost half of the S&P, but look at it going back historically to the middle of 2018. It's outperformed the S&P 12.64% annualized since that date, 21.19% for SEAF. So we've outperformed by about 8.5% a year historically going back to 2018. Maximum drawdown was a little less than the S&P, 29.4 versus 33.9. Beta is less, and a pretty respectable Sharpe ratio of 1.8, almost double what SPY is. If you don't know what Sharpe ratio is, let me recommend Investopedia.com. It's a great glossary of financial terms, but if you can get a model that's over 1 in terms of Sharpe ratio, it's a good model. I mean, look on the internet, see how many ETFs, see how many methodologies out there have Sharpe ratios better than 1. It's you know, it's a pretty slim crowd. So point being here is we back test our stuff. I either want to have S&P like risk with better performance, or S&P-like performance with a lot less risk. So that's kind of what we look to do. We're not gunslingers. We don't trade crypto. We're not doing elaborate option strategies. What we're trying to do is trade the markets with less risk. So the next part of this is I went through kind of the steps that we do to do an analysis of the markets outside of what we're doing with the models. So maybe you can see what we're doing and see if any of this resonates with you, and see if you can pick up any new ideas from us, which I hope you can. So this is a summary of what we see right now. The market is currently at a tactical decision point. Tactical for us is monthly, or 21 business days, from which it's current strategic, which is quarterly for us, or 63 business days uptrend, which began in January 23. So the market's at a tactical decision point, and we're going to show you why with a lot of charts, where it either needs to kind of have a liftoff here, which so far so good. Today we're up about 15, we were up 30, 40 earlier today. Either the market begins another leg higher from here, or it's in trouble. That's kind of the short version. There's more indications now that the market is going to move higher from here than not. A lot of breakouts in a lot of different indexes that, if they hold, they suggest that, as crazy as it sounds, I just read the data, we could go another 6 to 17% higher from here over in the months to come. I know it sounds nuts, but I have learned to not keep my opinion out of it and read the data. And in the wake of a 50 basis point cut earlier in the month, and the market's figuring that we're going to have 2 more 25 basis point cuts by the end of the month, don't fight the Fed. That could be part of the fuel for that. Size and style. We have been overweight large cap and value for much of the past 6 months. Those trends are tepid. You're not really making a lot of money there. We work with a lot of money managers, a lot of RIAs that want to know size and style. Where are you guys on that spectrum? So we're still overweight large cap and value, but frankly, those trends have been not very dynamic. They haven't made a lot of money. Being in the size and specter or size and style space this year has not made you a lot of money. You're basically a market performer. Next, domestic asset allocation. What to buy here? So we've got a model called CARP. It stands for Cross Asset Relative Performance. We're going to look at it briefly, but that tells us what's going on underneath the hood of the market. So the latest relative relationships, according to CARP, are still, believe it or not, in an overall defensive mode strategically, which means out the quarter. However, the model is slowly starting to move back to an offensive risk-on status in its shorter term time periods. Its trading time period, which for us is a week, tactical is a month. We interpret this as an indication that investors are cautiously adding risk back to their portfolios for the first time in 2 months. They've been parked in defensive places for the past 2 months. Why? I think anticipating some kind of a correction going into the election, going into the Fed, whatever it might be, that's going away now. Slowly you're seeing more or less risk aversion from a relative performance standpoint. Global relative performance. 8 of the 25 global equity indexes that are represented in our US versus the world model, or about a third, are outperforming the S&P 500 on a tactical and a strategic basis, which is less than half of the 18 outperformers that we had 2 weeks ago. That suggests 2 weeks ago, there's a lot of money going all over the globe into different equity indexes, probably to hedge against some kind of a stall or a pullback in the US. That's going away. There's still some great outperformance in some of these countries here, which I'm going to show you which ones a little bit later. But right now, the past 2 weeks, you've seen this kind of swing back from defensive back to offensive relative performance in our markets. Sector selection, rotation, our CEF model, which I just talked about, currently favors consumer staples, industrials, and real estate. We're going to look at that a little closer. Jack's going to take that part of it because Jack is much more on top of SEAF than I am. Sector rotation has been very erratic for most of this year, indicating market indecision on the sustainability of the 2023 advance. If you just look at a chart of the S&P, you might think, oh boy, this was a cakewalk this year. It has not been. For most managers, there's been a lot of cross currents underneath the market that those of us who do this for a living, have been noticing. So let's look at some charts, which is why you're all here, right? This is the SOX. Since 2024, daily, this coiling right here, the 200-day moving average is a major trend proxy, right? So the SOX has been bouncing up against its 200-day moving average, threatening this bigger uptrend since the middle of August. This shows investor indecision. It's like energy that's getting, that's starting to accumulate in a coil. It's like winding a spring. We've broken out of this. If you're a technician, this is called a symmetrical triangle. We're breaking out to the upside of this. As long as we stay up above 50.83, it suggests that this bigger uptrend is resuming. The measuring objective of this is 6,000 or a retest of the July highs. That's 17% higher than where we are right now. Keep in mind, in a normal uptrend, the SOX could be up 17 and the S&P, can be up 10. It tends to lead, but that's what this says. This is the NASDAQ composite index, the comp. That's the broader of the two NASDAQs. It's a bigger index. It has a lot more stocks in it. This same thing. You got this investor indecision coiling. We broke out on September the 19th. Targets have moved to 20,250, which is 12% higher than where we are right now. 17,395 is where we need to hold in order to keep the target intact. If this thing did an about face and crashed through 17,395, that means the market changed its mind. It changed its mind on this breakout that it did on September 19th, and now we're in trouble because we have a failed pattern, and we're probably going to crash back down at least to the 200-day and probably to fresh lows. But right now, everything looks good here. We've got two targets and two market leaders. We're going to get to relative performance in a minute, which complicates this a bit. But here's the Russell 2000. Again, from the 200-day moving average, this coiling, we broke out on September the 17th. Targets have moved to 2450 as long as we stay above 2173. That is 12% higher than where we are right now. This is the Dow. I always call the Dow the Dow's the burro. If you're going up a slippery hill, you don't want to be in a thoroughbred. You want to be on a burro. You want to be on something that you're not going to fall off the side of the mountain on. That's what the Dow is. The Dow tends to do better when the market is defensive. It tends to trail because when the market is in an uptrend, everyone wants to be on the racehorses. That's the SOX. That's the NASDAQ indexes. But we've got an inverse head and shoulders pattern here. The way that I look at patterns, by the way, just a quick 2 sentences on this. Earlier in my career, I saw a chart pattern. I thought it was like the heavens opening and the gods were coming and giving me a free trade. Not anymore. What I do now is we look at relative performance. We look at asset flows going into these ETFs. I will not take any of these trades unless I see relative performance and asset flows supporting what I see on the screen. I'm seeing that now. So above 41,880, it targets a move to 44,500 in the Dow. That is 6% higher than where we are not right now. So if you're looking at this, SOX up 17%, SOX often leads tech. Tech target is up 12%. Tech often leads the Dow 6%. So it lines up in terms of what you would expect if we had a great rally here into the election, that the leaders are leading and the donkey is trailing here. The sure-footed donkey is trading with up 6. Let's look at some relative performance because there's still some missing pieces here. This is the S&P 500. Let's just spend a moment here talking about support. Know where support is. The first support level clearly is the old highs from July and August, 56.70 to 55, 56.52. The 50-day moving average is at 55.24. That's a minor trend proxy that you can't turn on CNBC and not hear someone say. It's like a drinking game on CNBC with the 50-day moving average. You'd be smashed in an hour because they're always talking about the 50-day moving average. It's what everybody looks at to try to establish the minor trend. As long as we stay up above there, this minor trend is intact. Look at all this choppiness. This is where I was telling you earlier, the market didn't know what to do really throughout the second half of the summer. So we were getting these wide swings, and there was money going into overseas markets. The market was expecting the market was afraid that this was going to continue. It didn't, it turned higher. So those are two support levels to look at. If you want a PDF of this, go to asburyresearch.com. Or just go to info at asburyresearch.com, and we will send you one. I know I'm burning through this kind of fast. Relative performance. In a normal bull market, which is what these breakouts are suggesting, we are resuming the bull market that we've been in since 2023, you get outperformance by the leaders. We don't have that now. That's the missing link right now. It's one of a couple of missing links. XSD is the ETF that tracks the SOX index. It's been underperforming the S&P on a quarterly basis, which again is our strategic time frame, since July the 24th. That is, if this persists, if this relative underperformance persists, that pattern that I showed you in the SOX is going to roll over and die, and it's going to fail. So this is the missing link. Over the next couple of weeks, in order for that pattern to become more valid and more feasible in my eyes, we need relative outperformance from XSD and the SOX versus SPY. We use SPY here. It's the ETF, obviously, that tracks the S&P 500. Same thing in NDX. That's the smaller, bigger cap of the two NASDAQ indexes. NASDAQ 100, it's been underperforming also since July the 24th, getting a little bit closer to outperforming. Once it starts to outperform again, if it does, it will probably look like this back in May. Once it started outperforming on a quarterly basis, look what happened to NDX. It turned on the afterburners. We had this nice move here up to July 10th. Once it started underperforming again, the NASDAQ fell too. So watch relative outperformance in these two. If we don't get it, these rallies that we're beginning because of these breakouts, they're going to fail. IWM, relative performance of the iShares Russell 2000 ETF, technically outperforming on a 63-day basis because it's up above the green line, but it's really not trending. So if you're looking to buy small cap for relative outperformance, you ain't getting it. This is not a place that is giving you relative outperformance right now. What is, and it's troubling to me, is the Dow. This is DIA. This is the Spider Dow Industrials ETF, tracks the Dow 30. It's been outperforming since July the 24th, the exact same day that the NASDAQ started underperforming. This is what you see in a sideways to bearish market, a sideways to bearish S&P 500. It's not happening now. So it's kind of like, what's wrong with this picture, right? We don't have everything in place to give us the green light for smooth sailing. We have a lot of risk reward by buying some of these indexes because they've just broken out, but we don't have these ingredients that we need. In order for me to feel much more comfortable with being bullish, I need to see DIA underperforming, or this line down here in the lower panel going through the 63-day moving average. Without that, if this keeps outperforming, if the Dow keeps outperforming, eventually these rallies that we're seeing are going to fail. Key stocks, sitting right on some support levels here. This is Microsoft. It's number 2 in market cap, and obviously both of these are very tightly correlated to the NASDAQs. The linear correlation on these, we use a Pearson coefficient for this is like 0.95. So they trade just like the bigger indexes do. Major support here at the 200-day moving average, let's call it $415 a share, and this trend line that dates back all the way to January 2023, it's been banging around in there since August the 5th. As long as it stays above them, we're good. If this rolls over, it's got so much sway in the market because it's number 2 in market cap. If we start trading back around the September 6th low, red flags should be going off in your office because something's wrong, something's failing. Google's the same thing. The November 2021 benchmark high is at, let's call it $152 a share. The 200-day is at, let's call it $160 a share. Look how the market sees this. If it fails, we're in trouble. Google is number 5, Alphabet rather, I still can't get Alphabet. Number 5 in market cap. Above it, we're good. Below it, there's a problem and we're losing technology. So we're not out of the woods yet. Great to have these bullish patterns, but there's stuff going on that we need to be aware of, and I tried to show you a few of those. Our CPM, the correction protection model, I have RIA clients that have been with me for 20 years. After the financial crisis in 2008, I had a bunch of them call me within the period of a month or two that didn't know each other that said, hey, John, can you just build a model that simply shows me when I should be risk on and when I should be risk off? That doesn't move very much. So that's where CPM came from. A lot of our clients are older, they're wealthier, and they understand that investing when you're over 50 or certainly over 60 is like playing football in the fourth quarter. You've got a lead going into the fourth quarter, so you're not doing like flea flickers or throwing balls up, into the end zone and hoping your guy catches it. You're keeping the ball on the ground. You want to keep what you have. You don't want to take any losses. You don't want to be sacked. You want to keep going forward in a cloud of dust. That's what the CPM does. You can see just over this past almost a year, we went risk on November the 2nd. We went risk off on April the 15th. Right back to risk on May 3rd. We went risk off before we had this 10% move downward from the late July highs, and now we're back to risk on again. Generally, that's how this works. CPM is a completely data-driven dynamic stocks bonds allocation model. The way that I look at this is a dynamic. Usually if you go to your advisor or your financial planner, they're going to tell you, okay, you're a 60-40 bond guy, Joe. You're going to be 60% in stocks, 40% in bonds. Set it and forget it. I'll send you a card around Christmas time and I'll take you out for steak in the summer. This is dynamic. When CPM is risk on, we are in the in SPY. We back tested this with a hypothetical $100,000 account. CPM is risk on, that money is all in SPY. When CPM is risk off, that money is all in BIL. BIL is the Lehman 1 to 3 month Treasury ETF. What's it getting now? 3 or 4% interest, something?
Year to date, it's like 5.25% yield.
5.25%. So we're still doing our stock bond allocation, but we're not putting it on there and doing the set it and forget it thing. It's based on what the market's doing. So here I'm in stocks. Here I'm in bonds. Here I'm in stocks. Here I'm in bonds, and so on. It's binary. It moves about 5 times a year on average over the past 8 years, 5 round turns a year, a little bit more than once a quarter. Annualized total return, we already looked at this. Very comparable to the S&P, which with much less drawdowns, better Sharpe ratios. Now this can become an alpha generating model by using leverage. Instead of trading SPY, we trade SSO. I do this for my own account. I'm not advocating using leverage to anybody that I don't know, but you can turn this into an alpha generator by using a leveraged ETF instead of SPY. Right now, it's risk on. And we looked at these numbers already. The 5-year 5-year standard deviation, much lower than the S&P. Sharp ratio, much better than the S&P. Maximum drawdown, a lot lower than the S&P.
Just a quick note, the reason we feel that sometimes if you're trying to turn these models into alpha generators, why we can do so is due to the defensive nature of the CPM model. With its low standard deviation, low drawdowns, when we do take on that additional leverage with SSO or a UPRO, it actually brings those risk numbers more or less in line with the S&P 500, so we could take advantage of the leverage while using our model that does a really great job of protecting your downside and still keeping those risk numbers in acceptable levels.
Jack is the guy that really allowed me to take 40 years of experience and quantify it. It's changed our business hugely for the better. We're very quantitative in numbers. It's able to take what I knew in my head for 40 years and be able to quantify it, be able to attach numbers to it, be able to attach the risk reward, and that's the game for us. I sleep better than I ever have doing this all my life because I trust those numbers. Those numbers will get us out of the way before we take a big hit, and that's the name of the game because the stock market inherently goes up. Here's CPM. Since the fourth quarter of 2017, you can see it sticks to the S&P like glue, but with a lot better risk-adjusted numbers, which means you could take more risk because this is really protecting you on the downside. Our Asbury 6 are 6 indicators that Jack and I back tested that we found they work really well together, sort of like the 6 people on a hockey team. Right? If your left winger falls down, your defenseman comes around to pick up his check. That's what this does. There's 6 parts to this. We look at the monthly rate of change in the S&P, the relative performance of stocks versus bond prices, investor asset flows, volatility, trading volume, and market breadth. The Asbury 6 has been a relative performer versus the S&P 500 since 2017, meaning like CPM, they were right on top of each other. But maximum drawdown, as we know in the S&P, was 34%. In Asbury 6, it was only 13.6%. So why don't we just use that and not the CPM? This has 11 to 12 round turns a year compared to 5 for CPM. It's much too busy for a lot of traders. But this even takes that risk reduction while giving you the market to another level. It's just very, very active. There's a lot of customers that we have are not going to do 11 or 12 round turns a year in order to trade this model. Some do. So here they are now. 4 or more in one direction give you a directional signal. Right now, there's 5 green. These are the dates that all of these turned. So there's 5 positive and 1 negative. When would this turn negative? 4 or more of these would have to turn red. So let's look at them together. The first one is a monthly rate of change in the S&P versus its 21-day moving average. Why the 21-day moving average, John? That's our tactical time period. This is a tactical tool. So you can see since September the 16th, monthly rate of change has been down. So we are down right now in this particular constituent metric of the A6. This is relative performance of stocks versus high yield bonds. We use SPY and JNK for this. Look how choppy it's been in here. This is indecision, directional indecision, but right now it's positive because it's above its 21-day moving average. ETF asset flows. That is the AUM in SPY. How do you get it? You multiply the shares outstanding versus the NAV, and that gives you a dollar value. Again, note the choppiness here. The market hasn't been sure of where it's been going for much of the past couple of months. It's up now. It's expanding above its 21-day moving average, its monthly expansion, and the market has responded. As long as this stays above the 21-day moving average like it did here, that's good. That's the fuel that feeds a trend. Volatility, looking at the VIX. When the VIX is above the 21-day moving average, it means the market's getting a little spooked, like it did here on September 3rd, gave us this. Now we've drifted back down below the 21-day, which is right now at 17.6, let's call it. As long as the VIX stays underneath the 21-day moving average, the market's relaxed It's complacent. It's good for it's good for the price of the index to go higher. It's set for that. Volume. We use cumulative volume rather than raw volume. It's a lot easier to read. It's been expanding on a 21-day basis since September the 12th. As long as that stays the case, it's good for the market. Market breadth is 6 of 6 in the Asbury 6. We use the NYSE Advanced Decline line or the AD line. Generally speaking, it's been up above its 21-day moving average. It has been since September the 12th. That's what we use every day. This is updated every day, 2 hours after the close in the research center. And we use that to tell us day to day, what condition is the market in? If the market's all green, 5 of 6 green, I can relax up here. I can go play golf. I can take a day off. If you're 3 and 3, the market's starting to rock back the other way. It means pay attention. Know where your stops are. Know what you own so you could be ready for that turn in the market should it come. This is an excellent daily indicator that gives you a real truth indication of what the condition of the market is, and not what the monkey business going on in the S&P 500, up 100 today and down 100 tomorrow. That stuff will kill you if you let it. This keeps us focused on what's important. ETF asset flows again. This is the AUM and the Qs. We're really interested in the Qs because technology leads. We looked at that chart of the comp on slide 7. Right now, expanding on a 21-day basis. As long as that keeps happening, NDX is going to go up, so is the comp, and we're good being long and overweight tech. We still want to see that relative performance get better, but this is a good sign tactically. This is a relative performance between SPY and AG. AG is the iShares Core US Aggregate Bond. It's like a paragraph long, the name of it. But this is the aggregate bond index. And right now, stocks are outperforming bonds on a 63-day basis, quarterly basis, like they did all this period here in the first part of the year. And look, when the trend was tested on April 19th and May 1st, those are really good bottoms to buy in the S&P 500. We had a couple periods where we were down here recently. The market went down with it. Right now, it's starting to outperform again. Tactically, that's a good sign for the market. This is the standard deviation, more of a technical thing. Did you want to talk about that and how that works?
Yeah, so the way that we look at our standard deviation is when it hits a certain percentage of stocks trading above or below, or in this case, below their 40-day moving average. And the way we kind of look at this is kind of an onsides, offsides situation where as the market hits its extremes, we want to kind of know. So when there are a certain amount of stocks that are trading below their 41 moving average or above their 41-day moving average with the standard deviation, it just kind of gives us a sense of when are we at extremes, using this to start to look to our other indicators to maybe identify tops or bottoms in the market.
So this is telling us be careful of a top. Does it work all the time? No indicator works all the time, but this is one indicator that we're looking at that says for the next couple of weeks, the market may warn of a top. If that top lasts for a week and a half and it takes the S&P down 4%, it's not going to do anything to the other stuff that we looked at, but we want to know it's there. It's like if you're driving down the road and there's a pothole, it's not going to screw up your vacation, but you try not to hit it, right? You try to avoid it. This is a possible pothole. We want to be aware of it. Market breadth is a little bit too frothy on a short-term basis based on the percentage of NYSE stocks trading above their 40-day. Again, a pothole. You can see all these other times that we've been up here, we've had little pullbacks in the S&P 500, but again, it's not enough to change the overall view. This is benign here. This is percentage of those stocks trading above their 200-day on longer term perspective. It just doesn't have any value. Sometimes indicators don't have value, and this particular one has no value right now. Investor sentiment. Investor sentiment is showing us both on a This is a version of Jake Bernstein's Daily Sentiment Index. Jake is kind of who I wanted to be when I was a kid and when I grew up on the floor of the Chicago Mercantile Exchange. Smart guy, he's still around. This is his index of futures traders is saying the market is a little too bullish here. We might get a pullback. This is the investors' intelligence data. Longer term, guys like us, we're independent investment advisors. They're also a little too bullish. So sentiment is frothy. It doesn't mean that there's a top coming up, but it means the market's getting a little bit stretched out on the upside. Seasonality, weak in September. September's almost over. October gets better. October's still a little dicey on a quarterly basis, this is quarterly seasonality. This is annual seasonality. So October's still a little dicey. We can have a little rough spot in October, but once we get into November and December, they're the first and third strongest months of the year. So seasonally, we're going into a good pattern. We talked about large cap outperforming, large cap's the 500, it's outperforming the 1500, but the trend isn't strong here. There's really not a lot of value here in overweighting large, small, or medium cap because they're not trending. The same here with value. Value, we've been overweight since July the 24th. There's a lot of text here, by the way, that I can't get to, so ask me for that PDF. Go to the contact tab at asburyresearch.com or just send us an email, info@asburyresearch.com, and then you could read all this detail. But right now, we're still overweight because it's above its 63-day moving average versus SPY, but you can see there's really not a whole lot of trend to be had here. The next thing, this is our CART model. This shows us what's outperforming and in what time period. Trading, tactical, or strategic. Stocks are outperforming bonds right now. That's bullish. The broad market is still outperforming NASDAQ on a strategic basis. Blue chips are still outperforming the broad market. So some of these are still on a longer term basis. Some of these are still sideways, but without getting into too much detail, the relative performance relationships are starting to get better, which is bullish for the market. This is our US versus the world model. We look at the US S&P 500 or SPY versus 25 equity markets around the globe. Currently, 8 of the 25 are outperforming the S&P 500 on a tactical, which is monthly, and on a strategic, which is quarterly basis. One of those that we've been overweight for some time is EWM, it's Malaysia. So we put the trade out to our subscribers here on August the 12th. You can see since then EWM has risen by 14%, and it's outperformed the S&P by 6, which I'm really happy with because the S&P has been higher. So outperforming the S&P when it's making new all-time highs is very tough to do, but this is performing for us. The next thing we're going to look at is our SEAF model. Jack has turned into the expert on SEAF. I'm going to let him explain to you how this works.
Yeah, so SEAF is our sector rotation model. It's really trying to identify the velocity of money as it's entering the 11 different sector spiders. What we do is we track that, with our algorithm to determine the flows of the inflows into the ETFs. We do that over 3 time periods, our trading or weekly, tactical month, or a strategic quarter. And the reason we do that, now we have a really great example this week, the numbers align for us, but energy. As you can see, we don't have a lot of momentum going into energy in terms of the asset flows. The way this works is each column is broken up into 1 through 11. It's kind of like a golf score, 1 being our algorithm identified the most flows for that particular week in that time period, and 11 being the worst, which means in often cases we actually are having outflows that we are tracking. So in this case, we see that we have no momentum behind energy. So we don't want to bite on energy. Energy is ranked 22nd. We have our rankings broken down into 3 different groupings: favored, neutral, and avoid. For our model, which actually rebalances weekly, we only take the top 3 signals. So for this particular week, we have consumer staples, industrials, and real estate. But what we do is we don't want to bite on the intermediate movings. A news breaks about some AI company and money rushes into technology, but it's only a brief rush. It's only for a week. We can't track those trades. We really want to see that momentum build over several time periods, which is why we've built this model. What we're currently at is a little bit of a unique situation in the sense that we don't have a clear leader. Normally rankings are, when we have a true leader at the top, rankings are 2 or 3, 4, 5, showing real strength across all 3 time periods. And that's how we kind of identify that we have a real strong signal. Right now, we're in a bit of a transition period with SEAF. A couple of weeks ago, we were strictly defensive, utilities, healthcare, financials. We're starting to kind of rotate out of that a little bit.
Staples.
In staples, not financials. And as we kind of rotate, we're going to see this money kind of shift around a little bit. And SEAF does a really great job of tracking that. One of the ways we can kind of identify, and I know we're running close on time, so I'm going to zip through this. One of the ways we identify is through our rainbow charts. What we have up here is a daily tracking of the ranking in SEAF on the top end of the panel, and in the bottom we have the relative performance versus SPY. What we can see here is as we identified real estate entering into favor in July 23rd, we've had a 14% outperformance in the market. On the flip side here with technology, as we've kind of entered into this avoid neutral ranking, we've seen a little bit of a slip in the relative performance for the market. Ultimately, what we're trying to say with SEAF here is, wrapping this into our view of the overall market is while we're making new highs, we are looking for a leader. And with technology and communication services often being that leader, we do want to emphasize that we're looking for technology to start to turn around, jump itself into neutral, into favored, and really lead the market like it normally does, traditionally does. Just some high-level views on the numbers. SEAF, standard deviation on a 5-year basis, about half that of the market. We have some nice, strong Sharpe ratios, 1.28. Again, my understanding, anything over 1 is relatively good. And max drawdown about the market. We use this model as our alpha generating model, outperforming the market while keeping risk numbers, in the case of standard deviation, a lot lower, and in the case of maximum drawdown, about the same. As we can break out here, we really kind of took, right here we have our COVID low, and we've really kind of broken away from the rest of the market. Big part of that was in 2022, and the market was relatively down, as you can see here, breaking this down. As we're going up, we picked up energy. SEAF kept us in energy for most of the year, and we believe the ability for SEAF to identify where people are walking with their feet, not just kind of yelling words on the TV. We can identify places to put our money even when the market's down. In this case, energy allowed us to really break away from the broader market in a time where it was difficult to find other things that were outperforming.
Okay, I know I don't want to have Mr. Gibby have to pull the hook out, and jerk us off the stage here, but this is our trading ideas. We're not short-term traders, but some of our customers are. So we use 4 different criteria to try to identify out of about, 4,000 or 5,000 ETFs, trending positively. XTL, telecom, has been one that we've been in and out of twice this year. We've made money both times. Positive trend, which you can see here. AUM is expanding on a 21-day monthly basis. You can see that here. Relative performance down here at the bottom versus SPY. It's been outperforming SPY for most of this year. So we were in on June the 14th. We took a profit here on August 2nd, and we re-engaged the trade on August the 20th. We're still long. We're up 6% right now on this idea, and while outperforming the S&P by 4%. We're big believers in, if you're not outperforming the S&P 500, then why be in that asset? We want to be outperforming the S&P. So the average, here's what we look for, and this might be useful to you. In order to build a successful trading system, you want your winners bigger than your losers, and you want to have more winners than losers. So 67 trades that we've had here over the past, well, basically from March through the end of July, average winning trade 4.4%, average losing trade 2.3%. So we're 2.1% better Now on the percentage of winning trades, 67 of them have made money and only 32, or let's call it 33 of them have lost. We're making money on 2/3 of our trades. Our winners are bigger than our losers. Average winning trade length is about 15 trading days, as you can see right here. Average losing trade length, and these are business days, about 8%. So this is what you want to have, more winners than losers, your winners bigger than your losers, and typically if you're a trend following system, it's going to get you out of your losing trades quicker, and it's going to let your profits run. So if you're building something like this, this is what we use. We have a risk reward overlay, so we're not putting these trades on right underneath the resistance level, but this is what we use to come up with a winning methodology. I'm going to finish here. We have taken our Asbury models and we have turned them into portfolios. We have 3 different portfolios: Asbury Aggressive, Asbury Balanced, Asbury Conservative. We have PDFs on these. Our subscribers use these themselves, do-it-yourselfers, and to build these portfolios by looking at our research. The people that we manage money for, we actually trade these 3 portfolios for them, which give you different risk-reward characteristics. If you're interested in these, send us an email or go to asburyresearch.com and go to the contact tab. Please send the 3 portfolio PDFs. We'll send those to you, and you can have a look at those and see how we use different models to come up with different results. So we sell research, we have money management. If you're interested in the research, 10% off for anyone who attended today, only through the first week of October, through October the 7th. We put aside a small number of these. Go to the contact tab again, or send us an email and just say 10% off Metastock. And that will tell us you're from here and that we are to give you that option, and we'll send you an email so you can see what the price is, see what you get, and you can sign up online. Disclosure and disclaimer, just a quick sentence here. Past performance does not equal future performance. I mean, most of you probably know that. We can't look forward. Nobody knows what the future is going to be, but we do know what the past is. We're huge believers in testing your methodology over a robust period in the market like we've had. We've had a pandemic. We've had a major uptrend. We've had a major downtrend. We went back to, we went from a 0 interest rate policy back to a more normalized interest rate policy. That's how we discover what works. And this is how you get a hold of us, which I've mentioned a couple of times. I'm sorry, Mr. Gibby, I went over a couple of minutes here, but I'm talking as fast as I can.
It's okay. Got a couple questions?
Absolutely. I got as much time as you need.
Let's see. Cynthia says, I love your objective data. Thank you for that. For the CEF, do you see people actually rotating weekly with your information?
Sometimes, because we're in the top 3. So we may stick in one of those top 3 for 2 quarters or for 6 weeks or whatever it might be. And then you might have that number 2 or that number 3 where they're bouncing back and forth between staples and healthcare or whatever it might be. So the rebalances are done weekly for the purpose of always being where the money is. And if it falls out of that top 3, that means that there's not a lot of asset flow in there across 3 different time frames to make it worth my while. So sometimes the market is stable and it gets 3 that it likes and it sticks there for periods at a time. Other times the market, like this year, the market's going from offensive to defensive, back to offensive. Even though it looks calm looking at the S&P 500, there's a lot of indecision and there's a lot of angst going on underneath the covers.
Yeah, for example, we were relatively stable for the month prior to the Fed cut. Money was flowing consistently into the what was the CEF's top 3, and that remained more or less the same during that time period. After the Fed cut, we were starting to see a little bit more rotation. So we do see some stabilization. These things do trend, and CEF identifies and captures those trends honestly as early as we possibly can.
All right.
Sometimes it catches bottoms. Yeah.
Last question, real quick. What is your look back period when you look at asset flow trends?
Asset flow trends. I mean, for CEIF, it's, we have the 3 time periods. It's 3 months, 1 month, and 1 week. So,
Okay.
for CEIF, it's 3 months. We try to stay in those strategic, tactical.
Weekly, monthly, quarterly. They're all similar spaced, right? It's 1 week, 4 weeks, 13 weeks. So you've got that similar spacing across the 3. That's important also to know.
Okay. Very good. So info at asburyresearch.com. You can call 888-960-0005, and all that information is right there on the YouTube. Thank you, Jack and John. Always great to have you. I actually really do enjoy the how did Cynthia put it? The data-driven approach. And so great job with that. Thank you.
That's from taking too many beatings in the trading pit over the first 17 years. The data is the safe place to be, and you sleep better at night. Thank you very much, Jeff. You guys are great.
Thanks, guys.
All right. Thank you very much. I'm going to go ahead and dismiss you. Prepare for ejection. All right. See you guys. All right. Let me go ahead and make me the presenter. I'll go ahead and show my screen. And let's go over here real quick to the presentation. I want to say thank you to CMT Association, for sponsoring the event today. Much appreciated. You can find out more about CMT Association at cmtassociation.org. And in addition to that, we're Metastock. And Greg, you should know by now, the slide is up. That means it's prize time. So let's go ahead and look at some prizes. This time, I'm going to give away some great prizes, actually. Well, they're always great prizes. So
I'm excited. Let's do it.
All right. Big friend of Metastock, somebody that was a great technician, did a lot of talking about candlestick patterns, somebody that I used his patterns to trade with, and just somebody that we absolutely love. Steve Bigelow wrote some books on trading. We're going to give them away. Candlesticks, Profits, Eliminating Emotions, the High Profit with Candlestick Patterns, and also a very handy mouse pad that has the major signals on it.
I love that mouse pad. I had it for years.
Yeah, me too. I keep spilling coffee on it, and then I'll have to grab another.
You should send me one. I need a new mouse pad. This little guy's not quite cutting it.
Venmo me.
You got it.
All right, let's see. All right, so let's go ahead and give this away. I'm actually all ready. What I need from you is a number between 1 and 7,319.
And I'm going to give you 2193.
Okay, and I'm going to tell you who that is. Oh, Mary Jane in the USA. Last initial S, Gmail address. If you're in the room and you win, if you're watching on YouTube, say, hey, I won. I love it when you're actually watching and you win a prize. But otherwise, again, next week what I'll do is I'll get in touch with you. We'll actually go in and give the prize out, or I'll get your address, make sure we have a good address for you. We'll get these sent off. So big thank you to everybody so far. Greg, thanks for the assist.
Hey,
you want to introduce me?
I do. That's exactly what I want to do.
Do you remember why we updated my pick?
Why? Because you're not in high school anymore?
Right. Well, so we were doing a conference just a little bit ago, and somebody's in the chat going, this isn't the same person. This is on the schedule. And so we figured that it might be a good idea to update my bio pic. Do you remember that?
I do remember that.
Okay. All right,
today's the next speaker is our very own Jeffrey Gibby. Jeff is such a ubiquitous face at Metastock and has been with Metastock for so long and done so many presentations and so many conferences and so many live events. I feel like probably 0% of the people watching right now don't know Jeff, but in case you don't, he's the sales director of Metastock and also the business development director. He's been with the company for 27 years, 25
Yeah, 26.
26 years.
Correct.
Which is a long time. That's almost half of my life. Almost.
It is more than half of my life when you put it that way. Jeez, wow.
Obviously, he's very competent speaker. He's very knowledgeable about Metastock. He's got to be one of the world's top experts on Metastock and very competent on whatever he's talking about today. I can't remember what you're talking about today, but I'm sure it's awesome.
You're going to love it because I'm going to, on purpose, mispronounce things for you.
Oh, Ichimoku. Well, I'll tell you what, Jeff will point out, I lived in Japan for 5 years, so I tend to know how to pronunciate Japanese words. But I have to say, and I've corrected him, but Jeff, you do mostly correct lately. I don't irk anymore. You're doing great. So you do you and break a leg.
All right, thanks, Greg.
Get out of your way.
Let me go ahead and read this out to you. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Metastock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained, in the presentation should be construed as investment advice or the solicitation to buy a security. So there you go. How are we doing? I hope we're doing well. I hope you're enjoying the conference. It's great to see all of you here. I do want to say thank you for everybody that's been here, all the attendees, all of the speakers. I really like these events. I think this one in particular is going well. Haven't had any major issues, anything like that. So I hope you're enjoying it. What I would like you to do, just simply because I don't like to kind of go in and cherry pick a whole bunch of signals. Today I'm going to be talking about the Ichimoku method. What I would like you to do is, if there's a specific symbol that you want to look at or something that you have in mind that you'd like to see, go ahead and put it in the chat. I've got the chat here and the chat here for YouTube. I've got them both in a place where it's every time I look over in this direction, I'm looking to see if you're writing something. Go ahead and put some symbols in there, and that'll help me kind of with the demo. We're going to look at some stocks today. I'm going to talk about Ichimoku method, and it's a new method. Well, Ichimoku is not by any stretch of the imagination new, but it's a new method that's included in Metastock, and I'm going to kind of walk through how Ichimoku is used. So put some symbols down, and let me go ahead and get started here. As Greg said, I started here 26 years ago, and as we just figured out, that's more than half of my life. It's been a great company to work for. I absolutely love it here. The people are great. I started in inside sales, and absolutely, it's a great company to work for. It's a great company to represent, and in particular, like kind of the atmosphere that we have here. FND, thank you, John. One of the things that we really like to talk about is kind of how good our support team is. We usually have more people in support than we put in our sales and marketing teams. That's on purpose. They do a really, really good job. I think one of our biggest assets, if you want to talk about things that we do well, I always talk about scanning, but it's people. Like if you have questions, you can reach out, you'll get answers. We've had several people during the course of the surveys today have asked or said, hey, I talked to support, they did a great job. And that's not uncommon. It's not uncommon for us to have our survey results for the whole week, and 100% of the people that contacted support are satisfied and were helped. We love that. So in any case, I'm not going to really read this out. Cross your fingers, sir. Okay, there we go. In any case, the one thing I do like to kind of talk a little bit about the software before we kind of get into this. The other thing I like to brag about, aside from our support desk, which is awesome, is the fact that we've been rated #1 for 31 years in a row. You know, we have customers that have been here longer than I have. I think Scott was talking about the tenure of our employees and how long we stay here, but our customers, they'll come in, they'll start to use the software, they'll use it, and we have customers that have been with us since like version 1. Literally. Oscar kind of was talking about how long he used Metastock a couple days ago, Oscar Carboni. And the reason I really think that you keep using it over and over again is because you found something that works well for you. And that's a huge toolbox, right? But I love Metastock. I love the ability to go in and run scans and stuff like that. If you have symbols, let me know in the chat. We're going to talk a little bit about Ichimoku today. Okay, so Metastock 19 just came out. I think this is the first big conference that we've done with Metastock 19, and it's got a lot of things in it. I love 19. You can have black themes and white themes. And the charting workflows are great for the way I like to look at stocks. I run a scan and I open a whole bunch of tabbed windows open and I just close the ones that I don't want. And, it works good for me. The layout approach is great. You can have a layout with your broad markets. You can have a layout with multiple time frames. New container, it's a brand new look and modern look and feel. New charting styles, new drawing tools, and new trading systems. There's actually 3 that are in here, but one of them I wanted to include particularly was this Ichimoku Master. And typically this presentation sometimes goes a little bit short. So if we get done with Ichimoku, I'll also show you how to do gaps. Melissa talked about gaps. There's a new gap scanner in here. If we have time, I'll talk a little bit about that. But one of the things that we did, a gentleman by the name of Robert Dedman developed this Ichimoku Master System. And I'm going to show it to you. I'm going to show how it kind of helps you understand what's going on a chart with Ichimoku. And it was one of those things that I felt fit well in Metastock. Like, for example, when I started, there's an expert. It's still in there. It's called the Candlestick Expert. You can attach it to a chart. It'll show you all the candlestick patterns. There's 32 of the single-day candlestick patterns, and it kind of explains to you each of the patterns, and you can scan for them. And it'll tell you what a doji is and identify it on the chart. And for a new trader that wants to learn about candlesticks, I think it's a really good learning tool. And then once you learn about it, you can run the scanner to find any patterns you want to see on a chart. You can look at charts and all that kind of stuff. But I think one of the things that Metastock does really well is it can help you understand from a perspective of a chart, what's going on in a chart, whether that's Bollinger Bands or candlestick patterns or now Ichimoku Master. And the reason I like this and the reason we decided to kind of buy it from Robert and include it in Metastock was because I think it fits well in that, okay, here's a methodology that's actually pretty straightforward, but there's a lot of things to keep in mind. And this is using our expert advisor can kind of help you understand what's going on with it. So anyway, let me go ahead and go in here. I've talked a little bit about Ichimoku, and I'm just going to kind of lay some groundwork for what we're going to talk about. And most of what we talk about is going to be in Metastock. And Sean, thank you for putting a symbol in the chart. If you have other symbols that you want to look at, open up the chat box and put them in there. We'll be happy to kind of look at some symbols and look at how they're doing with Ichimoku. So this is your opportunity to put in a symbol. Okay? All right. Gentleman on your screen right now is a gentleman by the name of Goichi Hasada. He also went by Ichimoku Sanjin, as you can see right here. Okay? And what that means roughly in Japanese is what a man in the mountain sees. Now, usually when I'm coming up on here, I'll actually kind of have some notes that I print out just to kind of remind me a little bit about what's going on, but I didn't print them out. Oh, and I don't have them in this one either. So that's okay. Let me kind of tell you what I remembered. Ichimoku Sanjin, or Goichi Hasada, actually created the methodology and developed it and traded with it and refined it over the course of about 60 years. In the late 1960s, he published the rules and made it available for the markets. Now we're starting to get some good. Thank you, Neil. Thank you, Mike. Now we're starting to get some good symbol requests. So it's a method that's been used and proven, and that is very, very well liked. There's people that I know in the industry that teach how to use Ichimoku. Their main strategy is some of the strategies that are involved in Ichimoku. So what we're going to kind of talk about is the uses of Ichimoku. I'm going to go through kind of the indicators. I'm going to talk about how they're calculated and how you can use them to kind of get a full picture of the market. So you can use Ichimoku for buy and sells. There's 2 primary buy-sell signals. When there's a primary and kind of a secondary buy and sell signal when it comes to Ichimoku. I'm going to explain both of those as we go through the indicators. We can use Ichimoku to determine bullishness. There's actually 7 or 8 different things that you look at to determine how bullish a stock is or how bearish a stock is. It's all kind of laid together. It can help you understand future price direction, current price direction. It'll show you support and resistance and where it anticipates support and resistance to be in the future with the Kumo, which means cloud. It'll show you the current and expected future trend with the Kumo and the cloud. It has things in it that help you identify the stability of the trend and helps you anticipate potential reversals and stops. So that's a lot. But really, I can actually, because it's so straightforward, I can actually get through it fairly quickly. So let's go ahead and kind of just talk a little bit more about kind of the indicators. Here's a listing of them. We're going to go through all of these, and I'm going to tell you exactly how they're calculated and kind of how you use them and their relationship to the Ichimoku. So there's a Tenkan-sen, a Kijun-sen, Senku span A, and Senku span B. The area between Senku span A and Senku span B is going to be called the Kumo. And then also the Chiku span and the close. Those are the things that you're looking at. So the close is just the close. Chiku span is actually the close put back 27 days. I'm getting ahead of myself. Let's start with the Tenkan-sen and the Kijun-sen. If I wanted to tell you how to calculate the Tenkan-sen and the Kijun-sen on a chart, it's very, very simple. I would take the highest high value in the last 9 days and the lowest low value in the last 9 days, and I would add those together, divide them by 2, and give you the exact midpoint for 9 days. Okay. The Kijun-sen is a very similar calculation. What I do is I take the highest 26 bar in 26 days, the lowest bar in 26 days. I'd add those together and I'd divide that. And the answer that I'd get would be the exact midpoint from the highest value to the lowest value in 26 days. So those calculations are very, very simple. The way, don't misread me when I say this because it isn't a moving average, but if you're comparing the Tenkan-sen and the Kijun-sen in the same way you would look at a moving average, not a moving average. I always get that comment when I say this. You can kind of look at it in the same way. Like if the Tenkan-sen is above the Kijun-sen, that means price is kind of moving up, okay? Because you're just looking at the midpoint from a shorter period and a longer period. And so that's kind of, if you kind of look at two moving averages and kind of compare them, well, if a stock is rising, your shorter period moving average is going to be above your longer period moving average. If it's going down, the same thing is going to happen. It's not a moving average, but I kind of equate it the same way. Okay, and here's what you use actually for the Tenkan-sen and Kijun-sen to kind of look at them. If your Tenkan-sen is above your Kijun-sen, in other words, if that short-term midpoint is above your medium-term or your longer-term midpoint, then you're bullish. Okay, if it's down below, you're bearish. Okay, and then the crosses actually indicate the secondary primary buy signal or the secondary buy signal. So let's kind of look at that on a chart. I'll kind of reiterate kind of like what we're talking about. And let's go ahead and just open up some of these symbols. What I'm going to do, we'll do FND. And I've got the Ichimoku template here. I'll do LEU.A. I'm actually going to look that up. I don't think that LEU. Okay. That is the proper symbol. Thank you. Okay. FDX, Federal Express, I think is what that is. Kirby, I'm going to do SEG for you, and we'll do W. And we might not have a chance to look at all of these, but maybe we will. Okay. I'm going to open up all of these with the Ichimoku template. Let's go ahead and open up the chart. And it'll take a second to load, but it's not too bad. While it does that, I'm going to have some coffee. I love coffee. All right. All right. Wayfair, that's interesting. Let's go back over to FND because that's the first one. And let's kind of talk. He is kind of sideways for a while with this Ichimoku method. That's okay. Let's kind of talk a little bit about kind of how we would read this thing. If we're looking at, this is the Tenkan-sen and the Kijun-sen, okay? So if we kind of look here, when the Tenkan-sen is currently trading above the Kijun-sen, it's bullish, okay? And you can see right here, when that Tenkan-sen initially crosses, there's a little bit of a buy signal. It just indicates that that's the initial buy signal. Now, based on kind of the other parameters, I probably wouldn't trade based on this buy signal, but we'll get into that, okay? When you kind of look right here, when the Tenkan-sen crossed down below the Kijun-sen, I believe it was right here, you get a sell signal on the chart. And that's the way you can read it. So if we're just looking at the two midpoints, right now we'd look at the very end. The Tenkan-sen is above the Kijun-sen, which is going to give us a bullish indication. It's been above, the Tenkan-sen has been above the Kijun-sen since right here. Okay. There's other buy signals. I want you to kind of ignore that for now. Let's look at LEAU just real quick. You can see right here, you had that Tenkan-sen Kijun-sen cross, and it's been bullish ever since. Okay, all right. Very, very simple for those two. You're looking at a midpoint in price. You're looking at a longer term midpoint in price. If your shorter term midpoint is above your longer term midpoint, the stock is in a bullish trend. If your midpoint, if it's the other way around, it's in a bearish trend. It just means that prices have been trending down. Crosses indicated opportunity to buy or sell. And there's a lot of other things we're going to look at. So let's get to those two. Next, I'm going to talk about this, the Senkou Span A and the Senkou Span B. Okay. And actually, every time I look at this, I like, oh, okay, I forgot to put this as Senkou Span B, but this is Senkou Span B. What this is I'm going to take the Tenkan-sen and the Kijun-sen. So those other two indicators, I'm going to add them together. I'm going to divide them by 2. I'm actually going to plot them 26 bars into the future. So that's why when you're looking at the Ichimoku cloud, it always plots into the future. That's what it's looking for. You're looking at kind of where the cloud is. Okay, oops. Okay. Oh, well, okay. So the Senkou Span A, that's how it's calculated. Right here, you've for the Senkou Span B, is taking the highest bar for 52 days, the lowest bar for 52 days. It's adding those together and giving you a much longer term midpoint. And it's plotting that into the future. So your Senkou Span A can be on top of your Senkou Span B. Okay. In this case, Senkou Span A is on top of the Senkou Span B for most of this chart. And that's also bullish. Since it plots into the future, you can see kind of where an anticipated trend might be into the future. Okay. The distance between Senkou Span A and Senkou Span B is called the Kumo. Okay. So that just means cloud. So if you ever hear somebody say Kumo cloud, you can kind of tease them for saying cloud. And that includes me. Sometimes I say Kumo cloud. So in any case, when Senkou Span A, you see right here where Senkou Span A comes up above Senkou Span B, that means that's called a cloud twist or a Kumo twist. And that just means that's a bullish signal. Okay. When Senkou Span A is above Senkou Span B, as it is for most of this upward move, that's also bullish. That's an indication that the stocks are likely to increase. This cloud represents quite a number of things. And so I'm going to go kind of slow in terms of where if your Senkou Span A is above your Senkou Span B, it's bullish. And you have a different color cloud. If it's down here, it's bearish. Okay. It represents potential future support and resistance. So the angle of which the Kumo is going is important, both now and in the future. You see this twist that happened on the chart. That's actually a bearish signal. When the Senkou Span A crosses below the Senkou Span B, that's a bearish Kumo twist. Another major signal of the cloud, I think I have all this written down so I don't forget anything, but another major signal of the cloud is when the Kumo crosses up above the cloud, okay, and closes above, okay. So right here you see it's under the cloud. Right here it kind of comes up and starts trading above the cloud. That's a bullish trigger. That's the other signal I was talking about, 2 signals. That's the second signal, okay. That's a lot to keep in mind, and I think I said it all fast. So let's go over here. Actually, not here. Let's go here, and let's kind of go through it again. Okay. The Kumo can give you an understanding of trend bias in a number of ways. Is the Senkou Span A above the Senkou Span B? That's bullish. Is the direction of the cloud right now headed up? Is it headed down, or is it headed sideways? That's an indication. If it's headed up, it's bullish. Is it headed up into the future? That's also bullish. So the relationship between price and Kumo is important. Okay. Current direction of Kumo is important. If it's headed up, that means it's bullish. If it's headed down, it means it's in a bearish state. And the future direction as well, where that goes in the future. The Kumo twist is important. If the Senkou span A is coming above the Senkou span B, that's a bullish indication. If also the Kumo acts as support and resistance. So if we're trading above that, one of the places where if let's just go to one of our charts real quick here. If we're trading above the cloud, we anticipate the cloud to act as support. And I'm going to go over to FDX real quick because I think it might be more indicative. So if we're kind of looking at a long position, it comes back into the cloud. We expect this cloud to hold as support. If it doesn't, as you can see, it doesn't here, it issues us a sell signal. So if we're looking to place stops, we can very much place stops around the cloud. Okay. Let me kind of zoom out a little bit on this chart. I'm just trying to find one that's kind of been in a good trend. And SEG doesn't look like we've had enough activity on it. Wayfair, at least we've been kind of in a bearish trend lately. Let me kind of zoom in a little bit here. Right here, you can see where all of this activity that we've had below the cloud, we had that Senkou span A come in. But I want to talk just mostly about kind of the cloud and the way that the cloud interacts with this particular chart. So when we see it close down below the cloud, as you see right here, that's an initial primary signal. Okay, it came back up into the cloud, closed above the cloud, and then the cloud actually kind of held. And right here we had another entry signal. Okay, as long as price is trading below the Kumo or below the cloud, you're going to have this bearish indication on the chart that you're below the Kumo. Okay, and I would say it's important. The cloud is probably one of the biggest things you want to look at when you're looking at stocks. Okay, so if we're kind of look at this close down below the cloud, here you kind of see right here you had a TK cross, your Tenkan-sen cross above your Kijun-sen, but you got a long signal. I completely ignore that because if we kind of look at kind of what's going on with Wayfair in this scenario, we're trading down below our cloud. Our cloud's bearish. Right now it's trading down, but in the future it's also trading down. We don't anticipate a long position. Okay. Now, as long as we're trading down below that, you can kind of see here where we go. Okay. Right here we had that initial Tenkan-sen Kijun-sen cross. That gives you this signal here. Again, I wouldn't go long. I might start to play this more defensively, but if we're looking at this right here, you can kind of see that the cloud is kind of sideways at best, right? So here we did cross above the cloud. We're trading above the cloud now. If we were looking to kind of structure a trade because of that, I'd want to look at kind of a complete breakdown of what's going on the chart. But right now we're bullish. We're trading above the cloud. Our Tenkan-sen is above our Kijun-sen. So everything I've talked about so far is more bullish than it is bearish. And our expert advisor can kind of help us stay organized about what's going on with this. So let's kind of take a look here. And I'll just show you kind of how that works. So I've been talking about quite a number of things. There's a couple more indicators, 2 more that we want to talk about. But this helps me understand what's going on when I open up the commentary window. I'm going to go ahead and pin this here. Right here you have kind of dashboard view of where your indicator values are. And by default, this should be at the very end of the chart. I'm going to go ahead and just kind of push it to the end. So it should be looking at right there. Yeah, okay. Go ahead and pin it right here as well. So looking at right there, our TK cross was bullish. We had a weak TK cross. Okay, the TK cross is what happened right here. It was weak, but it was bullish, and it occurred 11 days ago. Okay, the price relationship to Kumo, that's the relationship between the price and the cloud. That's currently bullish because we're trading above the cloud. Okay, our current Kumo direction, I keep accidentally moving this commentary, which is why you see the thing. The current Kumo direction, if you kind of look at where Kumo's headed, it's actually not going up. It's going down. And so that's bearish, and it's going to tell us that it's bearish. Okay. It does in the future. It does start to head up. You can see that. And so that's giving us a bullish point. Okay. Chikou span relationship to, okay, let's talk about the Chikou span. That catches us up to where we're at. Let me go ahead and kind of come back in here. Okay. The Chikou span is the last indicator we're going to talk about because the close is pretty self-explanatory. But the Chiku span acts as kind of like a bit of a stability detection. All the Chiku span is if I take the current close price right here and I moved it back in time 26 bars, I'm going to get the Chiku span day price. Okay, so that's all it is. It's just showing you where the close is, but it's moving it back in time 26 bars, 26 days if you're looking at daily, etc. So this is today's closing price, 26 days back on the chart. The way that we read this is it kind of helps us understand what stability of price looks. So the relationship to the Kumo, if the Chiku span is above the cloud or the Kumo, basically that adds stability to the trend. That tells you that you're kind of in a decent trend because price is still going up. Okay, if your Chiku span is above your price, that also adds stability to the trend because it tells you that its price is still going up. If it's below, it's bearish, is exactly the opposite. And so you can start to get, you do get kind of a full picture of what's going on with all the things that we're looking at. So for example, here on Wayfair, if I ran an exploration, I was looking at it here. Let me just go back to this day. But and we can kind of say, okay, well, if we're looking at Wayfair back here, right now we're trading above the cloud, which is bullish, which is what we talked about. We had a weak TK cross. Our price is above our Kumo now, so it's bullish. Our current Kumo direction is bearish, but it's going to get bullish in the future. Our Chiku span relationship to the Kumo. So if we come back here and we look at the Chiku span, which is this one right here, it's below the price. So that's actually bearish. And that's what it's telling us, right? The Chiku span relationship to price is bullish, where our Chiku span is above, our price is above the Chiku span. And our Chiku span relationship to price, well, actually, this is the Chiku span. We're above where we were we're currently trading above, so the price is going up. That adds stability to the trade. That's also bullish. And our Kumo twist is actually bullish. You can see that this doesn't happen until into the future, okay? It happened back here, but when this happens, that's also bullish. The next thing that we're going to have on the cloud, on this particular chart, is a Kumo twist, and that's going to happen in 23 periods. It's bullish. It's visible on the chart. This was put together when it didn't plot into the future, but we fixed that because we're making a lot of changes to Metastock. So this kind of helps you break it down, but I want to go back to my PowerPoint for a second. So the uses for this, very, very popular indicator, been time tested. You can use it to get buy and sell signals with the TK cross and that close above or below the cloud. Bullishness or bearishness, there's 7 or 8 different criteria that kind of spill into that. Future price direction, looking at where the cloud is, the Kumo is. Support and resistance by where the Kumo is. The stability of the trend based on where the Chiku, it's a Chiku span, right? There's a lot of things we're keeping track of, and that's the reason I like this. It helps you keep track of it. And when you cross down below the cloud, it's a potential reversal. That's a scan you can run. And because you can treat the Chiku span or the Kumo as support and resistance, you can use it to identify stops. So let me kind of just show how, looking at the time, this kind of can be helpful for you in terms of understanding and learning about the Ichimoku method. Okay. All right. So we kind of broke down exactly what's being spelled out here and how it's being spelled out. Here's where your support and resistance value, your Kijun said support is at 47.84. You could consider that as a potential stop if you're looking to long this position right here. Okay. Your next period Senku span B support would be 50. That's another potential stop. Now here's what I really like about this is kind of the detail that it goes into, because there's a lot of things going on here, and I'd say I did a marginal job of explaining them actually, but even if I did a great job, there's a lot of things to kind of keep in mind, right? What's a TK signal? Well, that's a Tenkan-sen and Kijun-sen signal. Is it bullish or bearish? Did we have a signal? What does that mean? And so if you kind of scroll down in this commentary for any particular day, it's going to help break down that information and kind of just help you remember what's going on. So the Tenkan-sen, Kijun-sen, this black part is basically stuff it'll say every time. This is an overview. It's designed to kind of help you understand what's going on. And this blue part is actually kind of what it sees in relationship to the chart on the day that you're looking at. So the black part, you can read it if you want. It just basically is saying, here's what it is. The Tinkinson and Kinginson, if it's above it, if it's crossed, that's what we're looking at there. Here's what I'm seeing on the chart, okay? Did it close above or in or below the Kumo? The Kumo, and then it breaks that down for you. Current bar closed above the Kumo. And remember, we're looking at this bar because I clicked on that bar. Only long signals should be considered when looking at an entry, okay? Current Kumo direction, it breaks it down for you. Future Kumo direction, it breaks it down for you. Chiku span relationship to price and Kumo, it breaks it down for you. I love the way he kind of wrote this up because it gives you that kind of that textbook. Here's what we're looking for. And here's what's happening on the chart with the blue part. I think he did a great job with this. Now, the way that this works as a scan, as an exploration, if I'm looking for kind of these potential buy points, what I want to be able to do is I want to be able to identify them. And then I also want to see kind of how bullish or bearish they are. And so what I'm going to do is I'm going to come in here, and I might have told you this already, but the software does have a really good scanning engine. It has an ability to go in and scan for these things and also rank them. And I think one of the things we do with our scanning is really awesome. In fact, I use it multiple times every single day. So there's a scan in here that's in Metastock 19. It was added for Metastock 19. It's called Ichimoku signals. What I'm going to do is I'm going to run it against the Dow Industrials, the NASDAQ 100, and the S&P 500. So there's about 520 stocks. I'm going to go ahead and start it. We're just running it on a daily. You can run it on different time periods if you want. And we're going to have it filter out anything that doesn't have a buy signal, either a primary buy signal or a secondary buy signal. Okay. The primary buy signal that we'll be looking for is, did it cross and close above the cloud? Cross and close above the cloud. Okay. The secondary one would be, is it above the cloud, but also does it have a TK cross? Robert called that a re-entry signal. Okay. And if you hover over this, it's going to kind of give us a little bit of an idea of what we're looking at for a signal type. A 2 would be a long main. A 1 would be a long re-enter. A -1 would be a short re-enter, and the second would be a main. Okay, so let's look at the main long signals. Those would be our 2s. I'm going to go ahead and make this a little bit more of a full screen view. And if I'm looking for stuff that had a long entry signal, like they closed, that means they closed above the cloud, they had a new change in trend. These stocks, out of the 520 we scanned, I'm going to say that there's maybe about 20, 30 of them here would have a long signal. If it has a 1 in the signal, it's above the cloud already and it's re-entered. And then if it has a -1, basically there is one waste management where it had a K cross and it's trading below the cloud. And then we have our -2s where it closed below the cloud for the first time today. Okay, hopefully that makes sense. The thing that I really like about this scan is it kind of also breaks down the other criteria. So if we have a TK cross, it's going to score it. If it's got a cross above the, or if the close is above the Kumo, if the current Kumo is headed upwards, you're going to get a bullish or bearish reading. Bearish is -1, so this one would be bearish. If the future Kumo is headed up, it's going to give it a 1. In this case, it's headed down, so it's going to give us a -1. And then the Chiku span relationship to Kumo, in this case, the Chiku span is above the cloud. That's bullish, so it's a 1. If the Chiku span is below the price, it's going to be bearish, and so it's going to give it a -1. So you can kind of see, even though Generac had a cross above the cloud, I bet if I open it up, it's fairly choppy because its total score, when we kind of factor in all of the scores, all of these other things that are kind of indicative of bullishness or bearishness actually gives us a -2. Okay, I'm going to actually score this by the score. And when Robert talks about kind of the score that he wants to use, he doesn't really like to see kind of the maximum value. He likes the 4s and the 5s and the 6s because he feels like once everything is kind of lined up, you've missed most of the move. So when he kind of recommends that you kind of look at things, that you look for a score that's like 4 or 5, maybe a 6. Okay, so if I wanted to kind of look at stocks that were kind of in the 4 or 5 area, We do have BioRads Lab. We've got Marvel Technology. BioRads did just close above the Kumo, so we have a 2 there. JM Smucker closed above the Kumo, so you have a 2 there. Let's just open up a couple of these, and we'll just kind of take a look at whether we like the charts or not. Not everything that comes up on the scanner is going to be stuff that we absolutely love. I'm going to grab a 6 just for fun too. Are you having fun? I am. Let's go ahead and open up these charts. And let's see. Oh, we're doing okay on time. I might even have a chance to show you the gap identifier. So, okay. Go ahead and close this out. Those charts are going to open up for me. And again, we just kind of take a look at some of the analysis and that kind of stuff. This must have been a re-entry because we're getting a TK cross here. You can see that I didn't mean to actually get a re-entry, but you can see if we're kind of looking at the Kumo right now, if we would have scanned and we would have found a number 2 right here. Okay. At that time, well, actually, let's just look at it. I love the fact that we can kind of go back and say, well, what would it have said back on that buy signal? Let me look at the expert commentary. Okay. And what I want it to do is I want it to look at that day. And I'm actually going to pull this out of the flyaway mode because I want it to kind of stay. I do love the flyaway mode. And I do love the fact that you kind of have an option too. So let's go ahead and put it right there for now. Oh, did I break it? Well, okay. Oh, there it is. Okay, I thought Metastock only crashes when you're demoing it, and I thought we crashed, but we did not. Okay. So right now, if we're looking at the hard right edge, which is where we have to trade, I can kind of say, okay, well, this came up. The score on it, actually, this is all, let me just make sure we're at the hard right edge. This is all bullish right now. So this was the 6 that we kind of pulled up. Everything's bullish. We have a long signal. Okay. If I want to kind of evaluate what we would have saw, well, okay, if this would have come back here, let me just go ahead and kind of move it back here to this date. It should, oh, I have it pinned. Let me unpin it. Let me move it right here. Okay, you see the arrow that kind of forms right below it. That just tells us what day we're on. If we kind of look at that, we were bullish for our TK cross occurrence. We were bullish. So if we ran this scan for the 2, we would have had almost 1, 2, 3, 4, 5, 6, 5. We would have had a score of 5. You can kind of see what happened ever since then. At that time, we would have had a current Kumo direction that was pointing up. Things would have been, the only thing that would have been bearish would be the current Kumo direction at that point. So that worked out pretty well from that point. I don't know how it's going to react from this point. Everything is bullish on it, but you kind of get an idea of how this works. Let's look at another example real quick. All right, and I think, let's see. Let's just go back to Expedia. Okay. You can see that we've had a much choppier chart on Expedia. Kind of looking back, it looks like it's kind of been a little bit sideways, and not just a little bit, maybe a lot sideways. But let's kind of see what the chart actually says in relationship for Expedia. This would have also been a 2, or I'm sorry, a 1, because it's the Ichimoku cross that actually gave it to us. But if we're looking at kind of the way Expedia looks like, the TK cross is bullish. The current relationship to price is bullish. The future direction is bullish. It's going up. The Chiku span relationship to Kumo is bullish. And so you can kind of see this. Now, just looking at this chart, I mean, it might be breaking out, but it's just so noisy that I probably wouldn't trade this one. I like to have a charts that don't have a lot of noise. This one has a lot of noise. And I just, you know, let's look at a different one, though. Right here, we've got Bio. Bio's come down, it's tested the cloud. The cloud held as support. Okay, because it closed under the cloud, or in the cloud, not under, but in the cloud, and closed up today, that is a bullish indication. And if we're looking at kind of the relationship right here, bullish, 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 trade entry not recommended based on the Chiku span relationship to price, bullish. Okay, so that's kind of how it can kind of help you identify and understand. You know, I've seen a lot of people that just look for the TK cross. That's one of their favorite signals. Did it cross above the cloud? Actually, it's what I meant to say. Did it cross above the Kumo? It's one of their favorite signals, and you can scan for that. But the reason I wanted to include this in Metastock is because I think it does a really good job of helping you understand what's going on with Ichimoku. You know, Ichimoku has been a time-tested, proven system, been released to the public for decades now. A lot of people show Ichimoku clouds. I like this because it helps you understand methodologies. It fits really well in with, you can put a MACD expert on here to explain what the signals are. It does a really good job of kind of helping you understand that. And once you kind of understand it, you can also use it to help you identify trades and entries and setups and all that kind of stuff and understand that bullish and bearishness. So I like this from an application view as well as a kind of just understanding. And for those reasons, I feel like it works well inside of Metastock. I did say that I'd help you, I'd show you how to, now we have 10 minutes, which was great. One of the other things that I really like, Melissa earlier today talked about gaps. A new feature of 19 is a gap identifier system. I'm gonna go ahead and go in there. What I'm gonna do is just show you where that is. It's super easy to run. Let's see, I'm just gonna go ahead and type in gap. And you see gap identifier. I made a version of this which includes stochastics. We'll just run the one that's built into Metastock. I do like the fact with Metastock it's pretty easy to add new columns if you want to make new things in there if you want to, and not hard at all, in fact. If I wanted to have all of the stocks, I had to close this report out, but if I just wanted to list all the stocks at a gap this morning, I'll go ahead and start this exploration. It's running the same list, but what it's going to do is it's going to go in and identify all of the stocks that have a gap. It's that easy. If you haven't gotten 19, you should. I think it's one of our coolest upgrades that we've had in a long time. And 18 was also really, really cool with the new charting engine and stuff like that. But I think this kind of illustrates what I really like about Metastock. Ichimoku is a great system. It kind of helps you understand it. The gap identifier, if you like to look at gaps and see if they're confirmed by volume, that's helpful. But for me, it's the ability to go in and say, okay, well, what exists in the marketplace? Because for me, I spend a lot of time working, and then when I get done with work, I want to go home. I want to spend time with my kids and my family, and so for me, I don't have kind of the time to kind of look at 520 stocks in the marketplace every day, let alone 5,000. But I can come in here and say, okay, where are the stocks that have an opportunity? Which ones had a gap? Which ones were gap up confirmed by volume? And you see how easy that is. I still think the best thing we do is customer support. But that ability to go through and scan markets and the use cases we have for those, whether you're looking for Ichimoku signals or MACD signals or candlesticks or gaps or whatever it is, there's going to be something in there that fits well for what you're doing. So anyway, that's the Ichimoku. Hopefully that was helpful for you. That's kind of how you look at it. These are all included in Metastock 19, and they're free. So you get the expert advisor. This was an add-on. We used to sell it. It was $300, and it was worth $300 for sure, if not more. Robert did some really good classes on how to use it, and he's a great system designer. But with Metastock 19, we just I said, okay, Robert, how much can I pay you to just include this for every Metastock customer? We came to a deal on that, and now it's part of the program. So play with it. If you don't have 19, I'm just go back here real quick. There are so many new things in 19 that, like I do Ichimoku just so it doesn't get overlooked. But you have the new charting workflows. You've got the scan. You saw how I ran that scan and just opened up all the charts. They had all their own windows and tabs, and I could close the ones I didn't care for. All that's there. The container's brand new. It's a new look and feel. All the drawing tools are new. Charting styles, there's a couple of new ones to those. And then a lot of trading systems too. Putting a new container is what they're called in Metastock is a huge endeavor. But it does allow us to do it does allow us to kind of make a huge step forward and kind of making everything really nice and fresh and new and supporting multiple monitors and new workflows that people want to do. So in any case, if you haven't got the upgrade yet, get in touch with us. The upgrades are very inexpensive. give us a call. If you're leasing the product, they're actually free too. So I do want to close out by saying, #1 in its price category for 31 years in a row. I think Ichimoku is a great addition to that, methodologies and stuff like that. In terms of pricing for Metastock, there's 2 versions. We have Metastock Real-Time. Metastock Real-Time includes a new service. It's called Zenith. It's very, very comparable to Bloomberg. Bloomberg's $1,200 a month, to put that into perspective, but it includes all the Reuters news. There's hundreds of news bureaus, thousands of reporters. They spent $1 billion designing Zenith just by itself. And it's a really, really, if you're interested in news, fundamentals, macroeconomics, that kind of stuff, you'll really want to take a look at Zenith. It also includes Metastock. It's $265 a month. Basically includes everything you need to go ahead and get started. We have our end of day version. It doesn't include that $1 billion platform that's the news platform, but it does show you everything that we've got in here. It's only $69 a month. The special we're going to do, that does come with free white glove setup, installation, all that kind of stuff, unlimited support, access to the trainings that we've got called the Unleash the Power of Metastock. And what we're going to do for you today is, if you buy a month, we'll give you the 2nd and 3rd month for free. So 1 month, I thought it said, you didn't see this. Okay. All right. That was also on Scott's slide the other day. Okay. It's going to be the brand new, it's a new version. You'll get the Metastock 19, the brand new version. You get data. You'll get that white glove installation support. They'll call you. They'll help you answer any questions you've got. You'll get a training video. If you pay for $69 for the Metastock DC right now, you'll be running until the day after Christmas. And the actual cost to you will be $23 a month. If you do the real time, it's going to be about $80 a month. I believe 267 divided by 3, whatever that is, right? It's not expensive. And the thing is like, if it's something that's helpful for you, you're going to keep it. And we love that because we want it to be useful for you. And we love having customers as a business, But if it's not helpful, if it doesn't help you, if it doesn't kind of help you identify those better trades, you can just cancel it. There's no commitment. So you can take advantage of this. You can call us at 800-882-3040, metastock.com/salespchat, or metastock.com/compro. So don't see a lot of comments or any questions. I did actually do a pretty good job of managing my time there. Greg, you know what this slide means. Are you around, Greg?
I'm sorry. Right. A second to find that mute button. It's always a little elusive.
The nemesis mute button, right?
Yep.
All right. So let's see where we at here. Oh, you know what? I think we should give away some Metastock. I felt really good about that presentation. Let's go ahead and let me have you pick a number, Greg. That number, I'm going to update the list again right after this, but any number between 1 and 7,319.
That would be 3470. Hey, Jeff, while you're pulling that up, I was just going to mention that I was just chatting with Kevin Nelson, who's going to be one of our presenters tomorrow, showing concern that he might be in the path of Hurricane Helen.
Oh.
He is not directly in the path of that. He doesn't seem to be too concerned, so he should be able to present tomorrow. But we'd probably be remiss if we didn't send out a shout to the folks in the Panhandle of Florida that are probably kind of concerned right now about that, and it's supposed to be significant. So really, hope to the best to all of you, and hope you can join us either way.
For sure, yeah. Hopefully it just misses, right?
Yeah, I mean, yeah.
Speaking of Kevin, I'm going to give away 3 months of Learn Metastock with this one.
That sounds like great. That sounds awesome.
Because that's a perfect companion to help you get started. LearnMetastock.com. Kevin's the guy that hired me at Metastock. Greg, did you ever work with Kevin? I think he was well before your time.
No. I sat right with Kevin for a couple of years, and of course, he to be a great friend as well. But yeah, I worked with Kevin.
Cool. So 3 months of Learn Metastock. He does 3 webinars a week in terms of using Metastock, has hundreds of videos. The thing that I really like about Learn Metastock is there's like all these downloadable formulas. So he'll go in and say, hey, let's talk about the super trend filter. And it's a download. He'll talk about what he likes, what he doesn't like, things to look for, the haves and hazards of a system. And there's over like 50 something systems. So I'm going to include 3 months of that. I'm going to include 3 months of Metastock Zenith, which I just talked about. I'm going to include 3 months of Metastock, and yeah, everything you need to run for 3 months
That's a lot.
with data. Yeah.
That's the
I
best
don't know
thing
what the value is on that for
yet so far. It's about $8,000 million.
Yeah. Well, yeah. I'd say invaluable if it helps you find better.
In my heart, that's what it's worth.
All right. So did you give me a number already?
Well, yeah, 3470.
That's what I thought. I wanted to make sure. The number, that's Joe S. with a Yahoo address. Man, there's a lot of Yahoo addresses on this list today.
There are a lot of Yahoo addresses.
In the USA, Joe S. If your name's Joe, there's probably a few of you. But you just won Metastock. So congratulations for that. And the Metastock 3 months prize package. Okay. And I wrote it down. So thank you. Mike, thank you. I appreciate that. I'm glad that was helpful for you. Before we move on, I want to say thank you to AAII.com, American Association of Individual Investors. Great partners of ours. We appreciate the work that they've done to help us kind of promote the events. And we actually built an add-on with AAII with Ray Rondo, the head of their active investor division. If you're interested in finding out more about AAII, go to AAII.com. And our next presenter is Thomas Wood. And I don't remember the last time we've had Thomas Wood actually come in and talk. So I'm really excited because it's been too long. I think Thomas would agree with that. Thomas is going to talk about a patented technology that they've developed to kind of help identify the fair market value of a stock, and how they took that methodology and turned around the trading performance of a bunch of traders, including a hedge fund that went from losing money to being profitable just because of it, or as part of it. I don't know if that was the only driver for it. I can't really say that, but I'll let Thomas talk about that. Tom, how are you doing today?
Hey, Jeff, doing good, man. It has been a while. Thanks for having me.
Yeah, do you remember how long? I don't offhand.
It's probably been a couple of years, though, seems like.
It's been a good minute, yeah. Well, welcome back. It's kind of like when you kind of get together with an old friend that you haven't seen for a while. It just kind of is coming,
Yeah.
Right? All right, let's see. I just sent you the presentation. Oh, I can see it. You look good. I mean, your presentation looks good. You sound good. And I'll get out of the way. It's your turn.
All righty, thanks. Well, thank you to Metastock. Thanks, Jeff, for having me. And without further ado, we'll go ahead and dive in here. For those of you not familiar, first thing I got to do is go through the risk disclaimer. Just keep in mind, trader investing carries a high level of risk and is not suitable for all persons. Look, there is always risk involved in trading, period. No such thing as risk-free trade. And then along the same lines, we're required to show you CFTC Rule 4.41, just hypothetical disclaimer saying past performance is not necessarily indicative of future results. Obviously, we can't guarantee the markets are going to behave in the same manner that they have previously. But with that being said, the first thing I want to do is ask you a question. How is everybody's trading going this year? Are you hitting your goals? Are you achieving the profits that you wanted? Are you following your rules? Or are you getting into trades and getting out of trades too late, too early? Has the market been taking you by surprise? We've had some wild swings, including down moves and up moves, and volatility is extremely high right now as we go into a presidential election. We have some news just the past couple of days that's been happening with regards to China and their stimulus package, and it's been making some great opportunities, but also some crazy fluctuations. Well, there's two things that I typically check if I'm talking to someone that says they're not hitting their goals, it's not making money, they're losing money. And the first thing is, do they understand how to read and interpret price action? It's pretty simple, but it's one of the most important things you can do is, do you actually know how to interpret price movement? And the second is, do they understand how to combine price with momentum? Do they understand how to take advantage of momentum as a filter on top of their price analysis? And then once we do that, we take another layer and we add this layer, which is called value. And then we say, okay, are you timing your trades at the appropriate value zones? It's where you have the highest likelihood of the market following through in your direction instead of moving against you. Then, with that being said, most traders end up having an equity curve that looks just like this. And this is what we're trying to fix. Most people, when they first start trading, they come in, they have decent success for a little while. Their equity curve moves the right direction for a little bit, and then it turns around and goes the complete opposite direction, and they make a big mistake and they blow up, which is what you see here. However, consistency is possible. Once you understand how to combine all of these different pieces together, you can find consistency in your trading. For example, this is Michael Galloway. He's one of the traders that worked with us, and his account equity curve obviously looks beautiful, but you can see kind of where it all started to click, and then it's just smooth sailing from then on. Or this is Dave, and this is his equity curve was doing very, very well. Once again, consistency over time. Now, notice here, we're not winning everything. I'm not sitting here telling you you're going to win every trade, because you're not. But what we can do is we can get a very attractive balance between reward risk and win rate. Or this is Sherry's equity curve. And Sherry did really, really well also. Just nice and smooth. And again, there's losses in all of these. Sherry only wins 47% of the time. However, she makes $1.75 on every winning trade and only loses $1 on every losing trade. And here's some trades, for example, from myself. This was SPXU, like 117% gain, CCL 117% gain, inner workings 200%, Qualcomm 172%, CSU 109%, Tilray 50%, Zyop, Helix. All of these are trades that I did myself. And we had several really good ones today. We had shorts. Well, we had been swinging NVIDIA long all week from the breakout earlier this week, covered all the longs this morning, and then took a 5-minute consolidation breakdown on NVIDIA today, and that played out beautifully. We've been long coin all day. That's played out beautifully. Long Mara, that's playing out really well. Now I'm looking at a couple more like Zim, for example, for a breakout to trigger and give us some follow through here over the next few days. But for those of you that don't know who I am, this is me, Thomas Wood. Let me tell you a little bit more about who I am. I've been trading since I was about 13, 14 years old. I spent more time trading than most people will in a lifetime. My dad's who got me started in this industry. He said, Thomas, if you want to make the money you want to make, do the things you want to do, the best way to do that is by learning to trade the markets. And I've been doing that my whole life. It's the only thing I've ever done in my professional career. It's the only thing I ever want to do. Trade for myself, trade for others, and teach people how to trade. I have been a partner in a hedge fund. I currently manage other people's money as well, and then trade for myself. And us here at Basecamp, this is the last time we did a live event with Basecamp Trading. Combined, us partners have over 40 years of experience in hedge funds, professional money management. We're a trading technology and consulting company. We have patented trading tools that have been featured in Bloomberg, CNN Money, Barron's Money Show, Traders Expo, etc. We've done consulting with multi-billion-dollar funds as well as thousands of retail traders. It's one of the things we love to do, and our strategies work. This is one of the brokerage statements from a fund in our past. You can see 4.7 million year to date or month to date, and then 7.6 million year to date on that account. And this is another one of my personal accounts. This is like a $50,000 day trading futures specifically. But you can see based on our background, what we've done, we have experience trading. This is what we do for a living. We are traders. So let's talk about what separates successful professional traders from the 90%, because we've all heard that statistic, 90% of traders lose money. Well, professional traders, profitable traders, do a really good job of a few different things. First off, they're not a mile wide and an inch deep. They are a mile deep and an inch wide the majority of the time. That means they get very, very good at a single type of strategy, and then they increase size over time. They do a really good job of maximizing their profits. How many of you get into a trade and you go, you know what, I got out of that way too soon? And I'm not going to lie, this still happens to a lot of us. It happened to me today with Coinbase. We made 20-something% on coin. I was trading options out 3 weeks or so. Made 20%, got out a little bit early, and then it ran on and continued to run. But you need to, as a successful trader, maximize your wins. Make sure you're squeezing as much as you possibly can out of those good opportunities when you see them. The other thing is they have confidence in their approach. This is where being an inch wide and a mile deep comes into play, is because if you are a master in a strategy, you're going to have the confidence to stick to that system and follow the rules like you should be. And then consistency in their gains. The traders that are the most profitable that I've worked with in the past, they're very consistent, not only in their profitable trades, but also in their losing trades. They do not have blow up days. They don't let one trade wipe out tons of different profits. It's okay to have a bad trade. It's okay to have a bad day. It's okay to have a bad week. It's not okay to have a blow up trade or a blow up day or a blow up week. Okay, so you have to maximize your profits, be confident in your strategy, and that comes from being an inch wide and a mile deep, and then have consistency in your gains. So let's talk about what we're going to be discussing today, because I want to introduce you to some really cool tools here on Metastock. First, we're going to talk about the 3 components of trading. What are the 3 aspects of the market that we analyze before placing a trade, before we pull that trigger? We're going to talk about understanding the fundamentals of objective value. So what do we mean when I say objective value, and what are we looking at? We're going to talk about how to read the value charts indicators, what they are. We're going to talk about how to range trade with value range trading. We're going to also add a momentum component to it, talk about trading value, price, and momentum together. All right, and by the end of the presentation, you should have a pretty good idea if this is the type of trading you want to do. And I'll show you how you can move forward and take that next step. For those of you that say you're ready to go. For those of you that say that you're not, no big deal. Never going to pressure anybody into anything. So with that being said, keep in mind the law of diminishing intent. I like to always say the law of diminishing intent is important, because we always start with the best intentions, but the longer we procrastinate putting off making a change and taking action, the lower the probability of us actually following through, and the less energy we will have to actually do it. And too many traders put off making a change when they need to take action. And then by the time they actually pull the trigger, they don't have the consistency or the energy to stick with it. Okay. So with that being said, let's dive in here on the 3 components of trading. So whenever I'm looking to get into a trade, to click buy or click sell, all right, there's 3 things I'm typically analyzing. The first is price. What is the setup? What's at my core? I'm a price action trader. I started off with price action. I still believe that's one of the best ways of trading available. Understanding how the market moves and how price action moves. It's the fundamental of technical analysis. All right, it's that cornerstone of everything I do. Now, in addition to that, I always look at momentum. I look at how fast is the market moving? How much strength is behind it? What's the volume look like? What are the buyers and sellers doing? How are we running? Which, as we speak, the S&P's spiking back up here, which is great because I went long right before this presentation. And speaking of that, I'm actually going to take off partial profit right now. Sorry, got distracted there. And then in addition to that, value. This is where we can really make a change and make a difference, and what most people don't have. There was a hedge fund we worked with. I know Jeff kind of alluded to this earlier. There's a hedge fund we worked with that had a strategy they've been running, and that strategy was consistently losing money. Not a good strategy to run, right? However, they kept saying this strategy should be working. It should be able to be profitable. It tests out, but then when we implement it, it actually loses money. So we went in and we actually added one filter to it. So we took that system and we added a value component using the value charts tools. And that strategy went from consistently losing money to making millions of dollars every month. All right, and that's the power of making sure you're getting in at the right time, where we have that ability to say we have the higher likelihood of this market moving our direction as opposed to moving against us. Now, once we analyze price and momentum as the foundation and then add that value component on top, this is where we get a trade opportunity, which, speaking of, the reason I just took profits in the S&P is because we just spiked up into overvalued. So it just got a little bit extended on this run up. Again, fine with me because I went long right before this presentation off of a 30-minute reversal candle. And we're just taking some profits right now, just half profit off. So I have another question for you. Once you understand price, momentum, and value, and you have these rules all put together, all right, they give you a lot of backbone. They give you a lot of confidence in your trades. But if you don't have them, a lot of people don't have a lot of confidence in their abilities, and they do not stick to their plan, and they do not hit consistency. So what's the first feeling that you get when you're about to place a trade? And I've asked this question, and we've done polls on this question with thousands of retail traders, okay? And here's the first ones that normally come up. And this is one of the big differences between consistently profitable, successful traders and those that are not. Anxiety, uncertainty, hesitation. Remember how I said professional traders and successful traders have confidence in their approach and confidence in their abilities. If you are confident in your approach and confident in your strategies, you're not going to be experiencing these emotions. The other big one here is loss, a fear of loss, pain, and disappointment. So if you are taking trades with a proven system where we have price, momentum, and value all in agreement, you should not experience these emotions. They get crossed out because you're following a rule set that's been proven over hundreds of years to work. By the way, the runners on the S&P now are looking great. I'm also long Apple, just FYI, if you want to see what I'm in. So how do we read value charts? Let's dive into how do we use the value tools that I'm talking about right now that I just used to take profits in the S&P. First off, value charts plots price in one of 5 what we call value zones. All right, it's pretty easy to recognize. You're going to have fair value. Now, this is where the market trades the majority of the time. Then you're going to have moderately over and undervalued. That means it's slightly extended up or down. That's why I just took profits in the ES long, is slightly extended to the upside on a 30-minute price chart. And then you have significantly extended up or down, significantly over and undervalued. Now, they're color coded when you're looking at value charts, and that makes it pretty easy. And you can think of this kind of like a bell curve. It goes just like this. The majority of the time, it's going to be in fair value, and then the smallest amount of time, it's going to be down here significantly over and undervalued. Historically speaking, we actually went and had this back tested by PhD statisticians when we were getting the patents together. And historically, the market trades significantly over and undervalued about 2% of the time. Okay, so roughly 2% of the time, we're up here and down here. And then we're about 14% of the time and moderately over and undervalued, about 68% of the time in this fair value zone. Fair value means it can go either way. Over and undervalued means extended up or extended down, which means there's a higher likelihood of it pulling back. So when we look at this on a price chart, this is kind of what it looks like. Now, again, we had this vetted by 3 PhD statisticians. We had Dr. Weiner from University of Pennsylvania Wharton Business School. We had Dr. Laber from University of Michigan, and Dr. Nair from UCLA, California. All right, and all the 3 of those PhD statisticians were in agreement that value charts were highly effective in determining valuation and dramatically changing market environments like we're seeing now, where volatility is extremely high. And it works in any type of market, whether you're trading equities, options, futures, or Forex, it doesn't matter. By the way, just took some profits in my Mara long, which is another trade I'm in because we're getting extended to the upside. So how do we read this and how do we use this? Well, this is what it's going to look like on Metastock. You can see the value charts indicator down here, and this is a price chart up above. The upper and lower red areas are when we hit that significantly over and undervalued level. Okay, so you can see here, one of the great things about Metastocks, we actually put an alert on the bar when you're hitting these extreme zones. And you'll notice the red bars, these red dots, when we've hit significantly over and undervalued. You can see we hit it, pull back down. We hit it here, pull back down. We hit it here, we bounce for a couple of days, hit it again here, immediately reverse back up. Hit it here, pull back the very next day, hit it here, we move sideways. Now, just looking at whether or not a market's significantly over and undervalued is not enough to make us want to take a trade. This is why we start adding filters. And the filters we add, like I said before, are price and momentum. We want to make sure we have a component of price action momentum in every trade. Now, this is why. If we're in a trending market environment, we definitely don't want to be just selling every overvalued market bounce, because in an uptrending market, we expect to see prices get extended to the upside. That's a good thing. It shows that there's upside strength in an uptrending market. If we're in a downtrending market, we don't want to be buying every undervalued dip, because if it's trending down, we expect to see undervalued movement, because that shows there's a lot of strength to the downside. But if we're in a trending environment, what we can do is start filtering our trades with a bias. So we only look to go long in uptrending markets, which means we only buy undervalued dips. So what's that look like? Well, this is Amazon. And you can see here, as Amazon is obviously trending up on the price chart, we have the MQ momentum indicator down here, and then we have the value charts indicator down here, and we can start only looking to buy undervalued dips. So when does this market get undervalued? Well, that's the lower red price bar segments, when we hit significantly undervalued. So when are we hitting those? That's right here. That's right here. Right here. All the way up. And you look at the timing of these, because we're trading it with a bias, immediately moves our direction, immediately moves our direction, immediately moves our direction. So what does that do for us? Why is that good for us as traders? Well, it does a couple things. It's going to make it so our reward risk is much better. Our potential return is better because we're timing our entry better. Our risk is much lower because we expect the market to immediately move back our direction, or very, very quickly move back our direction. If you think about, as the market moves, it's kind of like slingshots up and then down, and then up and then down. And if we're making sure we're hitting significantly undervalued, the likelihood of it going up is much higher than the likelihood of it continuing to go down. And that's all we're trying to do, is make sure that the likelihood of a bounce back in our direction is much higher than the likelihood of it continuing to sell off. All right, so one of the first ways of trading with value, the most simple thing you can do is you understand how trends work, higher highs and higher lows. You throw a trend filter on there, and then you look to buy undervalued dips in an uptrend or sell overvalued bounces in a downtrend. All right, now, I know a lot of you will say, well, Thomas, there's times when the market is not trending. For example, earlier this week, we've been chopping all week up until today, last night, which we broke out, which was long into that this morning, covered everything this morning when we broke through support and then just rebought on the hammer. But when we're range trading, when we're not in a trending environment, we can implement a different type of strategy. So we adjust the strategy based on the type of environment we're in. We want to use the most suitable strategy for the market environment, right? So one of the ways we can do that is what we call value range trading. Now, the way value range trading works is if we find a market that's in compression, it's in consolidation, i.e. the S&P on a 240-minute time frame over the last few days. All right. What we're looking to do is profit from market fluctuations between both over and undervalued. So we're going to use the value charts tool to identify entries and exits from price extremes. Remember, as we get further overvalued or further undervalued, the likelihood of it reversing drastically increases, right? That's all we're trying to do. So here's an example. We want to be, one other thing I want to add about this though. You want to be careful of attempting to trade a value range trading during incorrect market environments. If you're trending, range trading is not going to work, right? You got to make sure you're in consolidation, and we do that based on price action. If we're in a trending environment though, range trading is not going to work. We want to have a bias. So here's an example. This was Tesla a while ago, and we can see we are chopping sideways. We have highs and lows and highs and lows, but they're expanding or narrowing. It's not in a trending environment, right? Until you get to the second half, which over here we start going lower highs, lower lows, and we start a somewhat consistent downtrend. But on this whole first half, or first 2/3, you're in chop because we're inside of these lows down here, the lowest low and the highest high. So all we're going to do is whenever we get an extreme, significantly undervalued, like there, and here. So that shows up here, 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 and here, 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 and here. As you can see, significantly undervalued. So all of these are when we get to that extremely oversold area where that market only trades about 2% of the time. That means the likelihood is extremely high that we're going to bounce back. And you can see every single one of them, we bounce back within just a couple of days. All right, now where do we exit our targets? If we're going long, we're going to use moderately overvalued, so the upper yellow, to target our exits. So that would be right about here. It would be right about here. It would be right here. It would be over here. It would be over here. And then over here, it would be right there. All right. So you can see that because we're hitting each of these overvalued upper yellow price bar segments. So we're just ranging from the lows to the highs using value charts as that tool to time the entries. Now, because we're in a range bound, we can also sell the upper extremes, do the exact opposite. So that gives you a short setup right, where's this at? Here, which this one didn't follow through, you have a loss. Then you're going to get short here again. That one doesn't follow through. You get short up here. That one plays out beautifully. You get short right here. That pulled out a little bit. This is where you would have hit your target on the undervalued dip. You would have been short at the very top of this bar. You would have been short at the top of this bar, which both of these played out really, really well also. Okay, so if we're in a sideways market, we're going to range trade. We're going to trade the upper and lower extremes. If we get into in a trending environment, we can add that filter. All right, now let's say, for example, over here, this is Google, where you're going high, low, high, low, high, low. All right, so this is our trend. Higher highs, higher lows means uptrend, lower highs, lower lows means downtrend. So this whole period here is an uptrend. This right here is consolidation. This right here is downtrend. This right here is uptrend. This right here is consolidation. All right, so we implement range trading during consolidation periods. So we'd sell the significantly overvalued pop here and here, get that sell off. We sell significantly overvalued here, catch that sell off. You would have sold it here and caught that sell off. Once we get out of the consolidation zones though, we're going to be looking at trend bias. So during the uptrending period from here to here, we're only buying undervalued dips. So we're not buying down here. We're buying right here. We're buying right here. And we'd be buying right here. On the way down, when this starts trending down, so we stop going higher highs and higher lows, we put in this lower high here and then break to a lower low. So this starts a downtrend. We're going to sell this overvalued bounce. We're going to sell this overvalued bounce. We're going to sell this overvalued bounce as we continue to trend down. Once we start our uptrend over here, we go high, low, high, low. So we go higher highs and higher lows. We're going to buy this undervalued dip. 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 Okay, so we add that bias in the correct environment, and that's going to give us a much better likelihood or much higher probability of that trade following through our direction and moving the way we want to see it move. Make sense? Everybody following along? All right, now let's talk about how we start adding that momentum component. Because remember, there's 3 components to it: price, momentum, and value. And before we actually do that, one other thing I want to mention that's really, really cool about Metastock and what we've done with them is we've set up expert commentary. So if you don't think you're an expert in this, that's okay. The tool can do it for you. For example, you have expert commentary that will tell you exactly what the market's doing and what your development of the market is. You can turn this on or off via the Metastock platform and use this tool when analyzing current market environments to help you find bias and trade setups. And this is what it looks like right here. You can see it tells you your value charts, whether it's a buy opportunity, for example, in this case, a VC buy opportunity. Conditions indicate this market's momentum is gaining. At the same time, relative valuation is still low. So it's telling you the opportunity. So it tells you current bar information, current value charts analysis, intra-bar value extremes, the value chart value level at the close, and then considerations, whether it's buying, selling, or holding, based on all of the above. All right, so with that being said, though, we can add this momentum component to really take our trades to the next level. So one of the things you get access to when you purchase the Value Charts Indicator Suite is the MQ Momentum Indicator. And it's one of my favorite tools. It's one that's on every single one of my charts, no matter what platform I'm using, no matter what type of trading I'm doing. All right, the MQ Momentum is an oscillator that we use in determining market strength. Remember the 3 components of placing a trade: price, momentum, and value? Well, those are the 3. Now, one of the ways of using the MQ Momentum is to identify what we call a bullish or a bearish divergence. But let me show you really quick what the indicator itself looks like. It's this oscillator just like this. Looks similar to an MACD, but the algorithm's a bit different. And what we do is we look for a few different things. The indicator lines will tell us the overall trend, whether or not the momentum is trending down with lower highs and lower lows, or trending up with higher highs and higher lows. It will confirm breakouts. If we're looking at a breakout trade, let's say we go high, low, high, and then price is breaking out like this, we should see momentum also breaking its previous pivot high on the indicator line. Okay, so it confirms breakouts as well with the indicator line. The histograms then tell us kind of the overall strength or force behind a move. The way I like to explain it is it's like getting hit by a Mack truck or being pushed by a baby. Okay, the bigger the bars or the deeper these histograms are, the more force behind that run and the more it's going to take to reverse it. The smaller those histograms are, the less force behind each run and the easier it is for the market to reverse it. All right, so keep that in mind. Now, one of the things we can look for, because momentum should confirm, when price is trending down, for example, here in Apple, when Apple is trending lower highs, lower lows, right, moving down, momentum is also trending down. So price momentum should confirm one another. When price is trending up, higher highs and higher lows, you see momentum also trending up, higher highs and higher lows. It should confirm. However, you can run into a divergence, and that's when price goes one way and momentum goes the other. When you see this, this is often a sign that a market's getting ready to pull back. For example, we come down, up, and then back down. So price goes here, here, and hits a lower low. Momentum should also be hitting a lower low. However, what do we see? Histograms from the first low to the current low, significantly higher. Indicator line, significantly higher, even though price is lower. So this is where it diverges. When you see this, this often precedes a reversal, or at least consolidation. In this case, we got decent reversal off it and ended up completely changing the trend and going right back up. So we can use this combined with value, and then we can find divergences that are value and momentum based. So we can look at something like this, where we come up and we look at Google and we go, here's high number 1, we come back down and we go to high number 2. Look at how much weaker the momentum is between those 2 highs, and we're overvalued on that second rally, and it's weaker on the value charts indicator. This is a great sell opportunity. And then we catch that down move over the next few days. Making sense? Everybody following along? Same thing happens right over here. high 1, high 2, significantly lower momentum, significantly overvalued on value charts. Gives you a short opportunity and you immediately follow through the next couple of days. So it starts giving us that timing aspect to make sure that we're getting in not only with momentum and price action, but because the value is saying, hey, we're at an extreme and it should pull back relatively quickly. Following along. So this is how we can really start taking trades and have them go from that was an okay opportunity to that was a really good opportunity where we got in with minimal risk and maximum reward. And that's how we can have a 50, 60% win rate and still have a very, very attractive equity curve like I showed you earlier. Now, another one we can do is we can combine both momentum and value to identify these potential entries. And we've set up the Metastock version of value charts to call out these potential buy and sell signals. So you don't have to go learn to do this yourself. The indicator will do it for you. Now somebody's asking, do you use technicals or fundamentals to estimate the value ranges? It's all technical. That's why the whole thing is patented. The algorithm for determining value based on technicals is a patented tool that we developed years ago. We actually developed it for a hedge fund and then started offering it to things like Bloomberg and Metastock, these mega platforms for other traders to use. So when you have the expert advisor, and this is the only platform we do this on, by the way, you can use Metastock to actually tell you where potential entries are based on price, momentum, and value. And you get things like this. VC sell based on weakening momentum. This is bearish divergence coming across, weakening value. That gives you your short entry, straight down to significantly undervalued, and you're taking profits right there, right before the bounces. But right here it says VC buy, same thing, attractive momentum and value. We get the pop over the next several days, straight up coming through this breakout. Right here it's telling you, hey, watch out, there's bearish pressure. So this means this is getting extended. Be careful if you're long. Down here it's saying, hey, careful, you're getting extended to the downside, bullish pressure. And you can see we start to consolidate and bounce. And then again here, consolidation, then reversal. And then bearish pressure, right back down. Bullish pressure, consolidation, and then it goes, boom, VC buy. So here's a buy signal again. Once more, here's that divergence showing up on the MQ momentum and on the value, and straight up until your sell signal there. So when you look at this, you actually had a few different signals. You had a buy signal here. This one didn't work out. You had a sell signal here, beautiful. A buy signal here, beautiful. And then a buy signal here, beautiful. So working really, really well when you actually look at what the potential entries are. All right. So here's another example. And once again, Metastock is the only platform we offer this on. This is on Tesla. You see VC buy, there's your long, straight up you go. VC sell, there's your short, straight down you go. VC sell, there's your short, straight down you go. And you can see these are all based off of those three pillars of a really good trade: price, momentum, and value. Like I said before, when you get all of those together, that's when you have great opportunity. And you get trades like this: 150% on Apple, 175% Microsoft, 76% AMD, 44% Apple, 78% Solo, 130% SHLL. This is how you get accounts. Like you can see, this is one of my accounts I was trading up 690% in 3 months. That's how I took a $15,000 account for demo purposes and turned it into $150,000 over a 6-month period. This year, my entire portfolio is up like 140% year to date. This is how we do it. And it's not just us though. We have lots of other traders that have been able to do this. This is Randy's equity curve. And you can see 58% win rate with a payoff ratio of 1.44. That's your reward risk. You get equity curves like this. This is Lori's. She did extremely well. And Lori actually went on to open up her own bond trading fund. And then this is Frederick's. His equity curve doing really well. He just plotted this one on Excel though. This is Dave's. Again, 1.49 reward risk, 66% win rate, over 200 trades. Beautiful. And it's just consistency is what we're after. So for those of you that are tired of just hearing about other people being successful and hearing about other people doing really well in the markets, and you're ready to maximize your profitability, increase your consistency, and grow your confidence, we have the Metastock bundle available for all of you today here with Metastock. So all you gotta do is go to metastock.com/valuechartsSA. You can also call them 800-882-3040. You can also get help if you need help at support@metastock.com. But to make it even better, one of the things we're gonna do is give you a bonus, a workshop that goes with the tools that will help you become a better value trader. So you're gonna get the value trading boot camp that goes with that to help you learn how to use your tools better on Metastock. But I wanna thank Jeff and everybody over at Metastock for having me out today. Hopefully you learned something, hopefully you enjoy it. If you have any questions or anything, you can always ask support@metastock.com, or if you need to ask me any questions, I'll be here able to answer them for the next few minutes as well. But Jeff, thank you, my friend. I know I'm finishing a little bit early here. I apologize for that.
That's okay. We do have some questions. And we can always give away a prize too. So, you know. But Kirby wants to know, when you're looking at the value charts and the fair market value, do you use technicals or fundamentals to estimate the range?
The value charts indicator and the algorithm is completely based on technicals. It's based on price movement relative to historical price movement and rate of change.
Okay. Let's see. Does this work with U.S. stocks? What kind of instruments does this work well?
This works. Yeah, it works on anything because it's based on technicals. You can apply it to any market in any time frame. So you can use it on a 5-minute intraday chart on the S&P, or you can be looking at gold futures on a daily price chart or a monthly price chart.
Do you let's see? Do you have any experience with customers using it on overseas markets like India, Australia, Malaysia? Those are big markets for Metastock.
Yeah, absolutely. We have traders all over the world that are using value charts and the value charts bundles.
Do you have a preferred time frame that you look at when trading?
Personally, so I do mostly day trading, and my bread and butter is like a 240-minute, but I do what's called multiple time frame analysis. So I'm typically looking at a higher time frame chart, whether that be 240 or daily or a 60-minute chart to get direction, get bias, and then I time my entries with a shorter time frame entry. So I'll use a 5-minute chart typically for my actual buy or sell signal to pull the trigger.
Gotcha. Okay, very cool. That kind of comes to the end of the questions. So let's go ahead and let me go ahead and kind of take the control here. I do have a little bit of some stuff ready to kind of talk a little bit for value charts. So where is my, Craig made me the presenter, I think. All right, Tom, thank you for joining us. I appreciate it. Let me go ahead and kind of do this. Let me go ahead and dismiss you. And we'll talk a little bit about kind of the specials and kind of how it works in Metastock as well. So let me go ahead and kind of turn on my camera. All right, cool. Okay. All right, yeah. So I want to talk a little bit more about the value charts and I do have kind of some of the metrics that we're using. It's a patented technology that actually took that struggling hedge fund. It was losing $60,000 a month before they added that value charts component, and then it turned into about $30,000 a month. And so the turnaround was about $90,000 per month with just by incorporating the value or the fair market value there. So anyway, let me kind of go ahead and kind of skip through here a little bit. Included in the actual value charts is the value charts indicator, the momentum. Of course, we're going to include scanning, so you can scan to find stocks that are overbought, that have a buy signal and a sell signal. You're also going to get that value charts expert advisor to kind of help you explain everything, understand everything that's going on with it, and of course the template. So normally it's $14.95. As a special for being at the conference today is $747. That includes a training class, a subscription trial to Metastock if you need it, the data region of your choice, white glove installation, and Unleash the Power of Metastock. So all of that, they actually do have a special where you can get both the value charts and the MQ trender that we talked a little bit about on Monday. Both of those are available at kind of the special price or the special offer at metastock.com/conf promo. So you can go up there. If you have questions, you can give us a call, 800-882-3040, or you can go to metastock.com/salespchat. All of those will be very, very helpful for you. So we'll talk a little bit about some of the sponsors we've got because we have a little bit of extra time. So if you haven't checked it out yet, thetradersforum.com. Tradersforum.com is a partner, technically, in Metastock. There you can find live market chat. Come in, I'll go in there and I'll actually talk about like the stocks that I'm interested in, things that are kind of exhibiting in a pattern, all that kind of stuff. It can help you learn about the markets. It's designed to be a community of traders actually helping traders, and completely free. I encourage you to come up and join. www.thetradersforum.com. We do a couple of events there right now. We'll run a little bit of a market scan where I'll scan the markets. We'll kind of look at stocks that are kind of exhibiting different patterns. The patterns I like to trade with are Steve Bigelow's patterns, so that's a scan that we run. But in addition to that, we'll come in and we usually have a podcast that we'll put up on YouTube. Last week we had Price Healy. He came in and talked about kind of like his experience, the way he likes to manage money, what caught him into trading in the first place. It was a really, really cool session. We've also had a number of guests. Dan Passarelli's been up there. Jake Bernstein is going to do a session with us next. I believe it's Wednesday. It's a great group of people, lots of people sharing ideas. I've gotten some great trade advice or trade ideas from there myself. So www.thetradersforum.com. You can join, you can kind of be a member, and I'd love to see you in there. You can share ideas with me. Of course, we are Metastock. Metastock's been rated the #1 software program in its price category by the readers of Stocks and Commodities, and that's happened 31 years in a row. We've done a lot of talking about Metastock. Today, I just showed you the Ichimoku expert. I think it's a cool thing in Metastock, and it's just one of a bunch of cool things. So with Metastock, you can scan markets, test trading ideas, forecast price movements, get real-time alerts, commentary, signals, all that kind of stuff. Pricing on Metastock we talked about is $69 a month here in the US. If you're interested in international markets, it's $59 per month for end of day. We also have a real-time version that's called Metastock RT. It's $265 a month. The special that we're going to do for that is if you buy a month, we'll give you the second and third month for free. That means basically it's $23 per month. If you do the end of day version, it is going to run until after Christmas at this point. And if you don't like it, if it's not beneficial, you can just cancel it. But I hope it works for you because, you know, a lot of our customers have been with us for decades. They've been paying for it for decades. I've been using Metastock now 26 years ago, 26 years in a row. I wouldn't trade without it. Metastock.com/conf promo, metastock.com/salespchat, and 800-882-3040 are kind of different ways you can get a hold of us. Greg, it must be prize time. Let's do prizes. You ready?
I am ready.
Actually, I was going to take that out. Next time I'm going to actually do based on questions again. But right now, let's do a random number. So the prize that we're going to give away is, we just had Asbury come in. And they talked. You remember Jack and John? I like Jack and John. They do a really good job.
They do.
They have a research report they talked about. It's a chart focus. We're going to give away a free. Actually, we're going to give away 2, just because we have so much extra time. We're going to give away 2 1-month subscriptions. The chart focus provides its readers with a weekly outlook of the market, allows you to go beyond the talking heads and the noise and of the markets, and really get a good idea of what's going on. So we're going to go ahead and give away 2, and that means I need 2 numbers from you, Greg. So go ahead and give me anything between 1-7319.
All right. First number is 2740, 2740.
That is a Mr. Fay with the first initial H with, you're not going to believe it, a Yahoo address.
Yeah.
Yahoo.
I believe it.
I'm surprised we're getting so many they didn't register with a country. So, but if that's you, you may have just won. If that sounds like you may have just won. Okay, I'm just making a note of that. Okay, and then Greg, let's do another one. Same
All right.
price.
This doesn't sound random, but 53.53.
Okay.
5353.
Corinthia. That's a pretty unique name.
That is.
In the USA, Corinthia J. And let's see, it's a Gmail address. So not too surprising, unsurprised. Not a Yahoo one again.
Hey, Jeff, is this a good time to mention that we might have a change in our schedule this afternoon?
It might be. We definitely probably will. So
Yeah.
we can talk a little bit about that. We're kind of still trying to figure it out.
Okay.
What's happened is there's a lot of Anne Marie is coming up. She's the speaker after Tyler Wood, who's our next guest. And she has had a power outage because she lives in Florida, and she's getting hit by a storm. We're not sure if we're going to be able to get her on today, just because I've heard it's a pretty big storm. So we hope everything's okay with that.
Once in a generation storm, according to AccuWeather.com.
Yeah.
It's going to be a big one.
And I just got news that so what we're going to do in her spot is we're going to move AJ up. So we're going to have AJ speak. He just confirmed that he could. Yay. So you can leave those tap dancing shoes in the closet, Greg.
Rats, I was ready to come out and perform. So this afternoon, in lieu of Anne Marie Baiynd, will be AJ Brown.
Correct. And then and I don't think it's very likely, but if Anne Marie gets power back, we'll have her do the last lot of the day.
If Florida's in like Texas, she will not be getting her power back soon.
Yeah. Well, and she said very, very specifically that there is tons of trees down. Like there's an insane amount of trees down.
I don't doubt it. Again, once in a generation storm. And once again, we send out our best wishes to everyone in that region. Looks
like Tyler's joining us. I think what would be a good time to do, since we do have a little bit of extra time, it's really interesting. It seems like we're always running over. Yeah. But this conference, everything's kind of run on schedule.
I've been seeing you do a lot of this.
Yes. I've pulled out some dad jokes. Yes. And some of those. Do you want one? What did the ocean say to the beach?
You don't even have to ask.
What
Fire away.
What did the ocean say to the beach? You know this one.
It didn't. It just waved.
Yes. That is the answer to that one. We did the ground beef ones yesterday.
Yes.
I did both of the corner ones. I'm trying to think of some other good ones. I like the one that Sunny had yesterday. Why don't skeletons get into fights? Do you remember the answer to that one?
I don't think I heard the answer to that.
They have no guts.
Oh.
Why don't they fall in love?
They have no hearts.
Yes. And lastly, I love this one. You know that when you get a brand new Tesla, my buddy just got a brand new Tesla.
Yeah.
It doesn't smell like a new car.
No?
No. It has a very unique Elon Musk to it.
Oh, I see.
All right.
Oh, what time
now,
is it?
I think.
Ooh, still got 7 more minutes, eh?
No. We're going to talk about, Tyler's here. We can start him anytime, but I think it might be appropriate. And I'm just going to find some slides real quick to talk about all of our great sponsors because, they have been very, very helpful in helping us put together stuff. And so I'm going to just go through them real quick here. I think I got them all right here. Number one, I don't see task.
By the way, I have been posting in both GoToWebinar and YouTube the links to Task and the Traders Forum, or at least I think I have. I'll double check right now.
There's one in chat. There's a dad joke in chat. Do you want to read it?
Yeah.
I'm going to let you go with that one. Gentry has one for you.
I'm not going to read that.
Okay.
Yeah, go right ahead.
I'll send it to chat.
Gentry, I enjoyed that joke, Gentry.
Yes, Gentry, thank you for that joke. I don't think we can read it out loud though. So here we
Well,
go.
I mean, it's just not.
Yeah.
No.
Yeah, here you go. I'm going to send it. I can't read it.
Oh, I should mention something really quick while we're trying to stretch time. We have a small, I'm sorry, I'm trying to navigate there now and I can't find it. On YouTube, we've been running a little poll, and the poll is, which candidate will be more helpful to the markets with the win in November? Trump, Harris, when doesn't matter. So what are you going to guess is the top answer between Trump, Harris, and doesn't matter?
Trump. Yes. I guess the answer.
Yeah, 52%
Oh!
have said Trump, 17% said Harris, and 32% have said doesn't matter. Contrary to those 32%, several of our speakers have pointed at the significance of the elections in November and how that will probably cause a market move in one direction or the other.
Yeah. All right. Thanking our sponsors, I want to say thank you to Stocks and Commodities magazine. Since we'll go ahead and get this back on track. Traders.com. You know, I remember we sat down with Stocks and Commodities, and we were just. You remember when we did our first conference here, Greg, and we were like running around and trying to get all the wires working and doing
back in 1902.
Yeah, I think it was like this was back when we had moved into this office. I just remember a lot of times. This wire needs to go here. This wire needs to go here. This wire.
Yeah,
could literally be rewiring the studio in here to make sure that we could go to webinar.
Yeah, we weren't even live casting then. It was all just on GoToWebinar.
Yeah. 10 years ago, we said, hey, we're going to do these crazy events. They're going to be all week. We're going to talk about technical analysis. People will love it. And it's been extremely successful. And Stocks and Commodities saw the vision for that, and they've supported us every single step of the way. We appreciate that. And I think you should have a subscription to Stocks and Commodities. If you go to www.traders.com, you can get one. Also want to say thank you. I'm going to save CMT for last because it's a good intro to what our next speaker is. AAII, also a sponsor of us, a huge organization, nonprofit. They've been supporting us for a few years now. They do a great job. They have a lot of, you've heard of investor sentiment survey. They do that. They have a lot of research reports that they do. They have an active investor division. Ray Rondo came in and he talked about his conviction indicators and how they work. And that was on, I think, Monday, yeah? AAII.com for them. And then, of course, the Traders Forum. I talked a little bit about the Traders Forum. Go to the tradersforum.com. Set up a membership. There's no charge. There's nothing up there that you can actually buy. But you can download information about the markets, learn about patterns, talk to other traders. It's a new project that's done with a partner of ours. And I'd love to see you up there, thetradersforum.com. And then we'll come back to, us. We'll also come back to the CMT Association.
Hey, Jeff, I'll one last thing, and then I'll log off or get out of your way. I'm putting in AAII.com, and it won't pull anything up. Are you sure about that URL?
Oh, I bet it's AAII.org.
I was thinking that was it, but I don't know.
Have I been saying?
I don't know, if I'm honest. I'm not sure.
I'm pretty sure.
Oh,
yeah, you're right.
Oh, that's CMT, that slide.
It is AAII.com, and it does load for me. In fact,
does it load for you?
Yeah. But you did have me nervous there because I was like, have I been saying the...
I apologize. It took an exorbitantly long time to load, but yeah, that's correct. And I'll go ahead and share that with the folks. I have been sharing that, by the way. It's the first time I actually checked it. So.
Yeah.
Okay. All right.
Our next guest.
I'll get out of your way.
Thank you. No, you're fine. Thanks for the assist. We enjoyed the jokes. All right. Our next guest is the CMT Association. Our next guest is Tyler Wood. He's not bringing everybody with him, but CMT Association has been a partner of Metastock. Tyler's actually the first time we had him talk. I remember it was a few years back, and he talked about how if you're looking to manage money, or if you are managing money, or even if you just want 3 cool letters after your name, the CMT letters that you might want to look into a CMT designation. We've had quite a number of, or getting a CMT designation. We've had quite a number of speakers that are CMTs. John Asbury just spoke just a little bit ago, and he has a CMT designation. Martha Stokes spoke, I think it was on Tuesday. Those are the only ones that I can think of offhand. But a CMT designation, Tyler's going to talk about this, and it blows my mind, can be very, very helpful in terms of helping you if you want to have assets under management, if you want to work for a bank, if you want to work in that type of a capacity, or even if you just want to learn a bunch of stuff. It's a very, very well-reputed organization, well-respected, has a great reputation. I just said the same thing in 3 different ways. CMTassociation.org, 646-652-3300. So there you go. And this is Tyler Wood. I'm going to come out of here for a second because I wanted to say this to you.
Sure.
I actually really like the new biopic.
All photo credits go to my 10-year-old daughter. She did a great job.
I second that emotion. I'm the one in charge of the photos at the company, and I prefer the last 2.
She did a very good job. I will give her.
And the background's all colorful. You've got this great smile, probably because you're looking at your daughter.
That's right.
I'm looking at that guy, and I want to buy stuff.
All right, I'm going to go ahead and make you the presenter. I hope you got a chance to listen to some of our jokes.
I sure did. You know, I was talking to a friend of mine who's the CFO over at Chobani, and he said, you know, they're very focused on company culture.
Okay. Chobani or us?
You know, for dad jokes, I feel like we could fill most of the afternoon, and I'm a big fan. I was the minute my daughter was born.
I literally have a database full of them. All right, I'm out of the way. It's your turn.
Awesome. So good to see you, Jeff. Thank you very much for that introduction. And thanks to everybody who's tuning in to this amazing week of presentations. Educational content is a big part of what CMT Association does, and working together with Metastock and these conferences has been a great pleasure. I am here on behalf of CMT Association. I'm not the whole thing, but I do serve as executive director and CEO now for the organization, which is 50 years and running. This picture that I've got up on screen, if you all can see my slides, was a great moment in the spring of 2023. The New York Stock Exchange invited us to come down, ring a closing bell, and we hosted a 4-day conference for investment professionals in New York City to celebrate that 50th anniversary of the organization. So if you're new to CMT Association, you might think that we are much larger than we actually are. This is 50 years in the making, and it's largely been driven by an army of volunteers and folks around the world who've dedicated their professional practice towards using the tools of the market to help their clients and their firms. And what we're going to talk about today is everything that the CMT Association has helped me to understand about markets. And if you're like me and you went through a traditional finance education, got your MBA, you probably studied a lot of fundamental analysis, which is critical. But I'm going to talk about the other side of the market and how technical analysis can actually be a very important element in investment decision making for all practitioners, regardless of your time frame, your objectives, the asset classes that you're trading, or your risk tolerance. So let's dive right in. Happy to be here and happy to represent this great organization that I've been a part of now for about 14 years. So quick introductions on who and what the CMT Association is. CMT stands for Chartered Market Technician. We're a global organization. We offer the CMT credential. So the credentialing authority requires folks to master a candidate body of knowledge and pass a series of very rigorous exams. But we're committed to advancing the discipline of technical analysis across the financial services industry. That includes wealth management, that includes commercial hedging, futures traders, asset managers across all asset classes, and many, many more. A little bit of history on our organization. I mentioned the 50 years, but we're coming up on a big milestone, 20th anniversary of this recognition from FINRA. That's the highest regulator in the United States of America. And what Ralph Acampora would tell you is that the most important day in modern technical analysis history was December 17th, 2004. And that was sort of the conclusion of a year-long process of showing the regulators of the United States of America that indeed the practice of technical analysis is its own very robust and rigorous discipline. They had introduced the Series 86 and 87 exams earlier in the year, and the board of directors went up in front of SEC attorneys and others to argue the case that happy to take a regulatory exam, but you need to test us on our body of knowledge. And over the course of that year, and then specifically on December 17th, they argued the point that technical analysis, studying the movements of the market price, volume, statistics like open interest, looking at cycles, both economic as well as liquidity cycles, which we're watching change right in front of our eyes right now, that all of that practice can be surmised under technical analysis. And at the end of the day, the regulators, what became FINRA, recognized all CMT charter holders for the same weight and exemptions that they offer CFA charter holders. That was a big moment for us. Since then, we have continued that advocacy work with regulators across the world, IROC in Canada, SEBI in India, Monetary Authority of Singapore, and many, many others. And that's been a big part of my role at the organization. And it's a wonderful work to be doing hand in hand with all of our volunteers. All right, so this global organization, we represent members all around the world in 137 different countries. So if you're tuning in to online education like this Metastock Traders Conference, I assume you're coming from anywhere and everywhere that there is a Wi-Fi connection. We have chapters, local city level volunteers that organize meetings and events. And we represent roughly 35,000 folks who participate in our educational offerings, including the CMT program. And that work just continues across the industry. So I mentioned working with regulators. I also spend a lot of time discussing with employers the value and validity of having technical analysts and CMT charter holders specifically on their teams, whether that's in the research department, as portfolio managers or institutional traders. We do a lot of employment advocacy on behalf of our members. And that largely takes the place of just explaining what I'm going to talk to you about here today, which is how we define technical analysis and how it works in lots of different investment capacities and for different strategies. We also work very closely with higher education, academic institutions. I'll mention our academic partner program before we're done here today. And believe it or not, we work very closely with the media. Financial news media gets a bad rap sometimes, but what we're trying to help them do is have salient, responsible commentary coming from CMT charter holders. When the markets become volatile, you can often see financial media even adding to the excitement of big market moves. And what we're trying to do as CMTs is react responsibly to what the market is telling us, rather than try to predict or forecast or get in front of ourselves about what we expect to have happen next. This is a little shameless plug, but one of the labors of love that I have at this organization is getting to sit down each month with our members, the men and women of Wall Street who have innovated, who have developed a lot of the indicators that you're going to use right on your Metastock platform, but also money managers and how they synthesize all of these concepts and tools into sensible risk management and aggressive alpha capture. That podcast was the brainchild of David Lundgren, who's a dear friend and a board member of the CMT Association. A few years ago, he came to me and said, "Tyler, we've got to relaunch the CMT's podcast." I think the first podcast was probably 10 years ago, but it had gone dormant for a while. And what a wonderful way to spend some time during the pandemic lockdown than by sitting down with these great portfolio managers and technical analysts to understand how they employ these tools on a daily basis. If you head to content.cmtassociation.org, you can listen to all the episodes for free. You can access a ton of research written content from our journal and from our Technically Speaking magazine. You can also stream these podcasts anywhere you get your podcasts, Apple Music, Spotify, you name it. So check that out when you've got time. I did mention that we're a global organization. This year marked a big sea change, a paradigm shift, if you will. For years, we held our annual symposium in New York City, well over a decade actually, and it was an incredible conference. Wonderful to be a part of that. But this year, we made the intentional move to put that conference elsewhere in the world, and we took it to Dubai. We held the conference at the Museum of the Future, which is perhaps the most beautiful building I've ever been in the world, project of the Crown Prince of the Emirates. Dubai is a thriving metropolis for financial services and a real center point, I think, for a lot of our members around the world. We don't need to make everybody travel to New York every spring. And so for 2025, if you've got your calendars out and you want to save the dates, we have 3 large conferences. In January, we will be in Tampa, Florida, the 16th and 17th. In April, we will be in San Francisco, California for the West Coast Regional Summit. And then again, first week of October 2025, we'll be back in Dubai for that largest flagship event, again with the Museum of the Future. Really looking forward to that and sharing some firsthand knowledge with investors and asset allocators and professionals from around the world. All right, that's enough of an introduction. I've already taken 10 minutes of your time. What are we going to talk about today? Well, I'm a simple guy, so I can only remember 3 things at a time. You should look at the grocery list that my wife sends with me. Never more than 3 bullet points. First, we're going to talk about what is technical analysis, how we define it at CMT Association. I think a shared common understanding of what we're talking about will help with the second section of our discussion today. I'll dive into just a few core tools, the core competencies that you're going to learn in these textbooks as you go through the CMT program. Hopefully these are also some evergreen lessons that you can apply in your own trading right away, right after this conference. And lastly, I'll talk to you a little bit about the CMT program. For those of you who are interested in really digging in and mastering some of these first principles, I think the CMT program was probably the most practical course of study that I've been through. I've gone to a lot of school. School was a wonderful habit of mine, and I did it for many, many years. All right. First things first, what is technical analysis? How do we define it at CMT Association? Well, for most technicians, it starts with a chart, something beautiful that you could create on a system like Metastock, for example. It's a way to organize market data. Oftentimes that's in a time series, right? So we look at price charts, price over time, we can plot movements in price action. And what we know about data visualization is that the human brain can make sense of a lot more information when it's displayed in an image than we can if we were just to look at tables and tables and tables of price data, right? You could look at this same amount of information, all of the individual daily closing prices, you could look at the momentum readings, you could look at volume, but displaying it like this is much more helpful to understanding where we're coming from, being able to see trends or patterns as they emerge. Edwards and McGee, sort of the foundational text in technical analysis, at least in modern Western technical analysis, they said that this is the study of the action of the market itself. So instead of looking at companies, we're looking at the whole market, or we're looking at the activity of the market around an individual security. And I know that sounds very rudimentary to define technical analysis in that way, but when you really think about it, that's going to be very powerful when I get to some later lessons. We also know that technical analysis is the study of supply and demand. And I hope nobody gets any twitch in their system if I take you back to your Econ 101 classes, but we'll talk about that supply and demand relationship and how that reflects in price action. And the last definition that I'll share with you right now comes from Perry Kaufman, who's widely cited throughout the CMT curriculum. He said it's the systematic evaluation of price and volume and other statistics. Systematic trading, algo trading, quant finance. There are a lot of terms that I see circulating on the internet constantly. A lot of those rest on technical analysis. They use technical analysis to express an idea, to implement a strategy. And when we're talking about systematic or algorithmic trading, whether you code in Python or R or any other language is secondary to understanding what are the rules that you are building into your system. What are those first principles that you're looking for? where are you going to separate signal from noise? And despite being able to code very, very well, there are a lot of quantitative managers who struggle with how the market behaves. And when I talk to veteran portfolio managers, there are some things that they've learned over the course of their years in the industry through multiple market regimes, bull and bear cycles, that are very difficult to code up or quantify. When we talk about technical analysis, we absolutely want to have a rules-based approach. We want to be thinking systematically. Whether or not you have discretion over trade decisions or it's fully systematized in terms of the execution, but maybe you have discretion over what signals to send to that execution, or you could be running completely systematic fund strategies. There's no right or wrong answer there. It's an endless debate, systematic versus discretionary. There are pros and cons to each. But when you think about using technical analysis tools, hopefully what comes through in the presentation today is the idea that we could be rules-based. We could have a system and a checklist that's going to be the same no matter what the market is doing. We're going to approach each decision with a rules-based mentality so that we are not falling victim to our emotions. We're going to talk a lot about that in today's session. All right, so technical analysis. Is it only charts? Line charts and bar charts and candlesticks and relative rotation graphs and point and figure charts? I would argue no. Technical analysis goes far beyond just the data visualization. It is a complete discipline for how to approach decision-making in investing. The way we define technical analysis is that it provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes through a systematic approach to market behavior and the law of supply and demand. Now that's a lot of big words, and I worked with a team of volunteers and board members many years ago on that definition. But this little graphic from our whiz kids in the marketing department helps illustrate what we're talking about. The concept for this this clarification statement, this definition of technical analysis, came actually from the blog writings of Aswath Damodaran. He's a PhD scholar and a professor at NYU Stern School of Business. He's also the world's foremost expert on valuation. This man lives and breathes discounted cash flow statements. So what is the technical analysis group care about what a valuation guru thinks? Well, Dr. Damodaran was exploring in some of his blog writings this idea that so many fundamental investors see that the market is often wrong, that the price that a security is trading at does not represent their estimates of intrinsic value. Price could be way higher than what they think the company's stock is worth. It could be way lower than what they think the company's stock is worth. Now, as a fundamental value investor, if it's overpriced, they're selling it. If it's underpriced, they're buying it. Now, technical analysis allows you to navigate that gap because the market price, we argue, is not wrong. The market's always right, and it is driven by things that are very different from what drives an intrinsic value estimate. Market price is driven by things like sentiment, the supply and demand relationship, not just for that one company's shares, but for the sector, for equities versus fixed income or commodities. So we can look across asset classes, across sectors, across industry groups, and understand how those supply and demand relationships are taking shape using technical analysis. All right, very early on when I started at the CMT Association, I got to meet Ralph Acampora. And if you haven't met Ralph Acampora, do yourself a favor, go to wherever he is speaking, listen up closely when you are around him because he is a wealth of information. And Ralph taught for over 40 years at the New York Institute of Finance, teaching Wall Street technical analysis. And every market specialist, the market makers and the traders from the New York Stock Exchange all had to take his class and that of Alan Shaw, later on Louise Yamada as well. Ralph used to illustrate this idea using the example of IBM. That was sort of the mega cap security of the day. I should probably change this out to NVIDIA now, but we're going to stick with Apple for a minute. So if you are an investor, you might first look at the fundamentals, Apple, the company. You might want to know some things about that company to decide whether or not you're going to invest in Apple stock. You would look at its valuation. There's a lot of different ratios you could dig into. Price to earnings, price to book, price to sales. You can use a lot of different measurements to come up with your valuation estimate. You might also look at the management team of the company. Are they very efficient or inefficient at allocating capital throughout the firm? What does their balance sheet look like? Do they have, are they highly levered? Do they have a lot of debt that they have to service? Do they have a lot of cash sitting on the balance sheet? What's their M&A strategy look like? How is the quality of that company being assessed through their balance sheet and the direction and strategy of that management team? You might also look at growth factors. So return on equity. You might look at margin expansion. How you define the growth factor is also its own Pandora's box. And you could talk to a lot of fundamental analysts about the many different ways that they do this work across industries, because it's not the same when you're talking about industrials companies versus non-profitable tech. And then, of course, you want to know about their products. Those are going to generate the future cash flows, which are you will derive your intrinsic value estimate from. So Apple phones, how are they selling in China? How are they competing against Samsung or Google Pixel phones, whatever it is? Is it just the phones? Maybe you care more about Apple's streaming service in your valuation. How about other Apple hardware? There's a lot that goes into that product and cash flow projection. And then, of course, there's competition. You care about Apple versus other companies trying to serve that customer set. You also care about things like the regulatory environment. Is Apple going to win these lawsuits over intellectual property thievery? I know they've been slapped with a few big fines. Is that part of the competitive space that goes into your analysis of the company? All of that is the fundamental side of the equation. But as you can see, we only have half of the picture. If we're going to be investors and we are owning shares of companies, right? Not a private equity firm that's going to buy the whole company. We have to complete our view by looking at the charts, by looking at how that security is trading. So Apple, the stock, is very different from Apple, the company. And understanding how Apple stock is moving can help us navigate that gap between intrinsic value and what is driving market price. So if we want to analyze the stock, we got to know what price it's trading at and what price it's been trading at historically. We want to look at volume as a confirmatory indicator. Is there enthusiastic participation in whatever trend we are seeing? We might look at the futures market, and we can see in open interest and the position of commercial traders, the Commitment of Traders report. We might look at supply and demand relationships, again, for Apple shares themselves, or for the information technology sector, or maybe just for the industry group, or maybe we want to look at equities versus other asset classes to understand those supply and demand relationships. And then perhaps the all-important and most difficult to quantify is the psychology of the market. There is no way for you to get a clear view of what the psychology of market participation is telling you from the fundamental toolkit. And so what I want to talk to you about next is how you would think about these two disciplines in conjunction. There is an inextricable link between technical analysis and fundamental analysis. And I think in the last 10 years, CMT Association has done a much better job of bridging that gap, of creating common ground. And I think the industry at large has really accepted a lot of technical analysis tools as a vigorous and rigorous approach to the investment discipline, and part of the toolkit for a lot of fundamental managers. Even if a core component of their work is on financial statement analysis and poring over those balance sheets and 10Ks, they can still use technical analysis to their advantage. All right, so here's the formula. This whole slide is borrowed from David Lundgren, who is a veteran portfolio manager from Wellington and Fidelity, and he's taught a lot of his colleagues about this inextricable link between technicals and fundamentals. So if we take the asset management industry and we chop it into 3 styles, and I know these are big, broad brushstrokes, most PMs would want to clarify and not be pigeonholed, but we could look at trend following investors, those who focus on price. We could look at the growth managers, right? If you look at growth equities or a growth fund, mutual fund managers, they're focused on the companies that have those expanding return on equity, expanding margins. Or you could talk to value managers, right? They don't want the growth story. They want something that's been really beaten down and that is mispriced, meaning the company is worth more than the shares are trading at. So the valuation of the company multiplied by the growth factors is going to deliver us price. You can see in this equation, they are all linked together. Not one can exist on its own. And in fact, price is the product of the growth factor multiplied by its valuation. Now, it gets a little more complex than this, right? We can see that earnings per share estimates and the price to earnings or value estimate is part of what drives price. We can also see that we're all in this together, meaning price isn't going to move unless there is some improvement on the right side of this equation. And every CMT charter holder on the planet should be able to tell you that long-term trends are always driven by the fundamentals. We care very much about what is happening on the right side of the equation. We care less about what people think, what their opinion is of what's happening on the right side of the equation. But nevertheless, long-term trends are going to be driven by the actual fundamental data, not fundamental opinion. All right. Where it gets more complicated is when we introduce this variable here. Everything on the right side of the equation is filtered through this lens, and it's a magnifier or it's a real detriment, and that is the sentiment or the behavior of the market psychology, and it's exponential. So this little variable here, B, could be some whole number larger than 1, right? If we're in a raging bull market, that's 3, 4, or 5. So our fundamentals that we are looking at about these companies are good and improving, but the irrational exuberance of investors in high liquidity markets, when there's a raging bull, when we've been moving upward steadily for years, that can get overdone. If you look at the tech bubble in the late 1990s, if you look at the real estate bubble through late 2007, you can see just how far that multiple will push markets. Now, in a bear market or at the end of a bear market, that B might become some fraction of 1 that gets very, very, very small. So no matter how good the fundamentals of the companies are, the share price the price per share of their stocks is never going to rise. It will be mispriced, in the words of our fundamental brethren, because it is all to the power of 1/2, 1/4, 1/3, and that behavioral input is where technical analysis can really help you to understand what's going on in financial markets. So that B is a range. The other key difference between the left side of the equation and the right side of the equation has to do with complexity and simplicity. Now, I'm not saying that there is no sophisticated element of technical analysis or that it doesn't take time to develop a mosaic approach and a multi-factor checklist when looking at the message of the market. But there are undeniable truths and some really simple things that we can do to manage risk and reap reward by just looking at price, because the variable price is just that. There is a price at which the market closed today or will close in about a half an hour. On the right side of the equation, it's much more complex. When we talk about those growth factors, we could debate all afternoon how we categorize, how do we calculate, what are we observing to deliver on a growth factor. How about a valuation estimate? I just listed 3 variations on those ratios, but you could spend all year debating what valuation metric works best for which industry groups and which securities. My point is, if we opened up each of these variables, we would see Pandora's box in front of us in terms of lots of different variables that you have to estimate, all of that information that we can't possibly know. All right, so the perspective of technical analysts is that the market is right. The perspective of fundamental analysts is that the market is mispricing, and therefore there's an advantage for them if they can spot where the market has it wrong. and the difference in complexity cannot be overstated. What I love about the way Dave Lundgren explains this power of price is that it gets a little Donald Rumsfeldian here for a second, but what price represents is everything on the right side of the equation. So there's all the information that the companies report publicly, right? There's everything that we actually do our homework on and that we understand. There are probably some categories that we'd be willing to admit, well, I don't know enough about that, or I'm missing some information here or there. But price also captures not just the information we know and the information we're willing to admit we don't know, but it also includes all of the impact and information that we couldn't possibly know. So what happened in a boardroom in a Taiwanese semiconductor company last week is in no way accessible to me. But the market will start to reflect whatever happened behind closed doors in this beautiful, elegant, simple little variable called price. And so if something terrible is happening inside a company, that will start to show up in price long before you're going to see a quarterly report from the company itself. And that is very, very, very powerful. So we all agree that fundamentals drive these long-term trends, but we simply hire the market to be our fundamental analyst. And the last point that I will make, if you're a value investor, you're looking for those companies that are mispriced, right? The company is worth more than what the market is selling those securities for. You need price on your side. Once you make a purchase, if something's been in this terrible downtrend, you need it to stop going down, reverse, and start going up. You need it to trend higher in order to be profitable as a value investor. If you're a growth investor, right, and you're already finding something that is working and the market is pushing that higher and the company is growing by leaps and bounds, you need that trend to continue. And if you are a trend follower, by definition, you are looking to buy those securities that are trending in your direction. So at the end of the day, we are all depending on the market to agree with us in order to make money. All right. Where this comes into a practical application, so not just the theory of that equation that we're all in this together, when we look at portfolio construction, we could think about the kinds of categories or the kinds of screening that we want to do for the items that are going to make it into our portfolio. So it's non-negotiable that a security in our portfolios should have price trend and momentum on our side. We should see that the market already agrees with us. And that might be a combination of those technical factors plus a really low valuation. It might be those technical factors plus a great fundamental growth story, or it could be a combination of great technicals, strong momentum, a quality fundamental story where it's been showing growth quarter after quarter, as well as a good valuation. That it would be great if you could fill your whole portfolio just with the securities that are at the center of this Venn diagram. It's a little tough to do. We'll take some 2s. We'll definitely take some 3s if we need to. But all of these that are 4s, where they don't have the technical conditions that meet our criteria of trending with strong momentum, those are going to be on our watch list. Because maybe something is super beaten down, has a great valuation. Maybe something is a great growth story, but the market hasn't recognized it yet. When that takes off, it's going to move into the center of the Venn diagram, and that'll make it into our portfolio. So hopefully that helps you think about how you can screen across all of these factors and use technicals and fundamentals to your advantage. Now that B, the behavioral component, the psychology of the market, is something that I think technical analysis has a huge role to play. I read and reread every year this book by Daniel Kahneman, Thinking Fast and Slow. And what was fascinating to me in 2002, the Nobel Prize in Economics went to Daniel Kahneman. He's not an economist, he's a behavioral psychologist, and yet he won the Nobel Prize in Economics for work that he and his colleague Amos Tversky had done in the 1970s. They developed this theory, prospect theory, that we all suffer much more pain from a loss than we experience joy from a gain. They also went on to identify heuristics. When we look at evolutionary psychology, there are some habits and some shortcuts that all of our human brains have come to rely on that help us get through the world. This herding principle that they talk about, one of the heuristics identified by Kahneman and Tversky, is that we all found it was safer to stay in the group. And that's been evolved in the human mind over thousands of years. I'm sure when we were Neanderthals, we realized it was better to stay with the group. If you're off wandering on your own, you might get picked off by a saber-toothed tiger. Well, the same thing happens in markets, right? If everybody's buying Apple stock, or if everybody's buying tech, or if everybody's just looking at the Mag 7, by definition, we all find safety in numbers, and that trend continues because there's more and more attention being paid to those crowded trades, and it pushes the price higher. Why does it push the price higher? Here's where I'm taking you back to Econ 101. At a fixed rate of supply, an increase in demand is going to push us up the price equilibrium, right? An increase in demand will, by definition, raise the price of the security if we have a fixed rate of supply. Similarly, a decrease in demand is going to move us down the price equilibrium at a fixed rate of supply. And that is what we are studying as technical analysts. Are there more bulls than bears? If so, there's greater demand, and they're going to push price higher. Because price, remember, is established at that center point where someone is willing to part with a security and someone is willing to buy it. The bid and the ask meet at the current market price. And so price action is all telling about all of that fundamental information and the market psychology in one. Now, I've been deliberating on this point here for a while, but I find this quote sums it up really well. This is from Mark Abraham, who's a very successful trend-following hedge fund manager, and he says, ultimately, it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. That consensus is revealed by analyzing price and volume and other market statistics. But what an elegant, beautiful way to state that. The collective opinion of all market participants. And that's what we are tracking. We're not playing slots, we're playing a game of poker. And so we need to know what the others at the table are doing. Now, market behavior, sentiment, the supply and demand issues have shown us just how extreme and powerful they can be. Did anybody trade GameStop? Everybody watched this meme stock craze that came up in 2021. That's going to be in the textbooks for a very, very long time. I found it so fascinating that the wisdom of the crowd could actually squeeze out the smart money, Melvin Capital and others. And by creating that short squeeze, we saw huge volatility, huge spikes in GameStop. Now, from a fundamental perspective, right, GameStop rents video games in brick and mortar stores, physical cartridges. That's going the way of the cowboy. And from a fundamental perspective, there's no way this is a $260 a share kind of company. But the behavior of the crowd can push price levels far beyond the realm of rationality or fundamental analysis. It cannot be explained using only the tools on the right side of the equation. We have to look at what's happening on the left side of the equation. And for the poor folks at Melvin Capital, that was a tough lesson learned. There's a lot of examples of this, but let's move on. The objectives for every CMT charter holder is going to be to participate in trends, not to anticipate. We want to confirm what's happening. We want to participate with the market. We want to trade as the market agrees with us. We also want to remove doubt, uncertainty, all of the confusion that comes into trading the markets. Just by show of hands, and I can't see you, but shout it out at home. How many of you would have guessed that knowing Jerome Powell cut interest rates by 50 basis points, that we would see the long end of the yield curve climb every day since? Rates went up every day since the 50 basis point cut. That's why we don't anticipate. You got to watch what the market is giving you, and that is the true story in order to make good investment decisions. All right, so we're reacting responsibly without emotion. How do we do that? Tyler, that's enough theory. Let's look at some charts. Let's dive into it. I'm going to talk about 3 technical analysis tools very, very quickly so we can get to our final section of today's presentation. First, I'll discuss multiple time frame analysis, and then we'll dive into a concept called relative strength, very different from the RSI the relative strength index. That's a momentum indicator. We'll talk about ratio charts for a little bit, and then we'll discuss market breadth and divergence for a little while as well. I'm making today's presentation primarily equity focused. In the CMT program and amongst CMT charter holders, it is not an equity only game. In fact, we have a lot more commodities traders, folks who are doing commercial hedging. We've got folks on the rates desks. Our current board president is the head of FX trading for JP Morgan. So these tools apply to lots of different disciplines across the financial services industry. You can use technical analysis and these charts in the exact same ways, no matter what asset class you're trading. But some of the concepts here I'm talking about are particularly for equities, because I know we've got a lot of folks on the line who are thinking about their equity investments, their retirement portfolios, and just learning how to work with what the market is giving you. All right, so let's dig into multiple time frame analysis. My good friend Brian Shannon wrote the best book that I've ever read of multiple time frames many years ago. Actually, it's been almost a decade, I think, since Brian released his book. But it's really powerful stuff, and the ideas come from Charles H. Dow. This is the OG technician in the United States, late 19th century, 1890s. This gentleman was observing market price action with nothing but ticker tape, and he was a journalist, not a banker, not a railroad titan, but he was watching what was happening in markets. No fancy charts, none of these tools, and yet he got to these core understandings of what drives markets, how markets work, that were then later compiled by Robert Ray and others into the Dow theory. If you've heard of the Dow Jones averages, and if you have ever read the Wall Street Journal, you have old Charlie Dow to thank for the existence. All right, so these very first principle, these first person perspectives on what was happening in markets, no fancy tools, no algo trading, just the ticker tape, led Charles H. Dow to these very core observations. Now, he was also an accomplished sailor, and he used this nautical theme throughout a lot of his writings. He said, markets move along a primary trend, and that primary trend is like the tides of the ocean. It's unflappable. It comes in and goes out. The primary trend is your longest term view, and it's largely driven by the fundamentals, by expanding gross domestic product, by a thriving economy, by the fundamental factors in the growth story of the companies that are producing these life-changing products that they're introducing to consumers. That is the primary trend, the tides of the ocean. However, if you really smooth out your price chart, you'll get a line that looks like that. But we know that price action is going to move above and below that primary trend. So Charlie Dow defined the secondary trend. Secondary trend he referred to as the waves of the ocean. Now the waves come in and crash on the shore at high tide, and the waves come in and crash on the shore at low tide as well. The secondary trend is people's interpretation of those fundamental inputs. And for technical analysts, we can use that to our advantage, knowing that there is a tendency for that secondary trend to mean revert to what is the longer term underlying primary trend. Charlie Dow also identified the tertiary, or this minor period trend. And these are the day-to-day fluctuations in market action. That is what he referred to as the ripples on the surface of the water. So the magnitude of the moves is smaller, the frequency of the moves is higher, and they move along the waves, which move along the tides. So are you starting to capture this idea that multiple time frames are going to crest together? So when we think about multiple time frame analysis as technicians, in our research process, we should be looking first at what is that longer term perspective. Then we have to identify the time frame on which we're going to trade and be objective about that, keeping in mind how that trade is shaped by the primary trend. Are we deep down here on a secondary period, totally pulled away from that long-term primary trend? And if so, we might even look at that minor period for sensible entries, right? So if the secondary trend is down here in the troughs and the minor period or that tertiary trend is in a trough at nearly the bottom of this trough, and we see that start to turn up, maybe what we start to do is trade in the direction of the primary trend and the direction of the secondary trend. As analysts, using multiple time frames on the same security can give us great context about the impact of a move. When we see the secondary period crashing below that longer term trend, we might be in it for a while. When we see a minor period pull below a secondary period, maybe that's just a little counter trend correction, right? It might not be meaningful if it's still just on this minor period. So let's look at that in context. If we're looking at weekly candles on a chart of the S&P 500, the SPX index, we might be able to see a couple different moving averages, right? A 200 period and a 50 period. And we might be able to see that price action was below a falling 50 period moving average and that it coiled up before breaking out, right? Breaking out above that shorter period moving average, which never went below. This is all healthy emergence of a new bull market on that secondary period. Now, if we dive down into that daily chart, right? So let's focus here. This little pullback, right? Didn't even touch our moving average, right? This more recent pullback from this summer of 2024. Well, now when we see that pullback on a daily chart, it's a little more severe. We've broken below the short period moving average. We saw a little more destruction, but we regained our territory, right, after those April lows and resumed that longer term uptrend. Now, what if we dive into an even shorter, right, 10 equal bars per day? We could see that this trend, right, was quite destructive in that April lows period. But on this shorter period, we saw that gap higher. What a powerful point to entry, even before this had broken out above the moving average, right? So we can use multiple time frames to our advantage. We know that the longer period, the primary trend on that weekly chart is moving higher. We know that this secondary period, this daily chart, had broken below the short period moving averages. Maybe if the daily time frame is our trading range, right? We're a swing trader, a little longer term. We might dive down to that 39-minute bar, that intraday chart, and look for the opportunity to get in as early as possible. Best execution, right? As that breaks above and gaps higher, that gives us the signal this is the one we're looking at. 39-minute, the gap higher gives us the opportunity to get into that trend earlier and not wait for confirmation from that secondary or even primary trend. Does that make sense to y'all? All right, let's move right along. Concept of relative strength, right? So we're analyzing across multiple time periods. Now we also need to compare multiple securities, right? We don't just buy the index. It is, after all, a market of stocks, not a stock market. So we might want to compare some things. Martin Pring defines relative strength it has this division, one security by the other. But I find it easier to explain relative strength by just using a chart. And of course, we're going to use the textbook example, the COVID-19 collapse that we saw in March of 2020, February into March of 2020. So growth equities or value shares. Two different indices created a mix of stocks in both, but typically growth sectors include things like information technology, consumer discretionary, communications. The value shares are going to be things like energy, financials. We could look at some healthcare or even utilities companies in that value component. All right. If we were to do a relative strength analysis just with the two charts, weekly bar charts, we could eyeball them. They were going up, they both went down, they both recovered. There's almost nothing to distinguish one against the other. We could see a little bit of divergence here, value shares outperforming their growth equities, right? We see this line rising here at the end of the chart and this one remaining pretty flat. Other than that, it's not very intuitive to just eyeball two charts side by side. So what do we use? A relative strength ratio chart. Okay, I want you all to do this in your metastock charting. Do your analysis before you start making your trading plan. what you're doing with a relative strength chart is looking for which one is better. Now, a relative trend does not mean it's in an absolute up or down trend, but we can see on this relative strength line, dividing growth by value, that growth equities are outperforming value shares during this period. When the line is moving down, value is outperforming growth. And so we can use the trend of that relative strength line to identify the periods that we want to be participating in what style of equity investment. It doesn't work on just styles. Maybe we want to compare Apple to Microsoft. Use a relative strength line. By the way, they trade pretty similarly. They're both mega cap tech names, but we might try to distinguish which one is doing better. We might look at industry groups relative to their sectors, or sectors relative to the index, the benchmark as a whole, to identify the spots in the market where we want to be looking for longs or shorts. That relative strength concept is very, very powerful for your analysis, for your security selection, looking for where in the pond you want to go fishing. You want to be fishing in the styles, the cap size, the sectors, the industry groups that have strong relative strength, those that are beating the benchmark index. And you can use anything as your benchmark. You might say MSCI All World Index, and you might look across geographies for equities all around the world. Or maybe you're looking at just trading commodities futures. You can still look at relative strength and find those that are leading the pack. So here's how fundamental investors use relative strength. We're going to do a top-down approach, which I highly recommend to all of you. This is what every sell-side analyst and CMT charter holder is talking about when they go on to CNBC or Bloomberg News. They're talking about not just what the index is doing, but they're diving into the sectors or the industry groups, and they have methodologies for ranking those, largely on relative strength. So that top-down perspective is going to give us a huge advantage. As you'll find out, most of the performance of an equity, of a stock, is going to be driven by the overall market performance. Are we in a bull or a bear market? And what sector or industry group is it in? If it's in leading sectors and industry groups, that's going to drive a lot more alpha, a lot more outperformance than if you're trying to find a great performing company in a sector or an industry group that is a real dog. Now, that has only increased with the advent of ETFs, because so many of the institutional investors, the big money out there, they're not trading individual securities. They're trading baskets of securities to identify a theme or an industry group or a sector of the market that they want to be exposed to. So in this ranking, we're looking at all these industry groups, and we are ranking them based on their trend and momentum. So numbers 1 through 33. Now, what else is in this table are the growth factors and the valuation, right? Remember that equation, price equals F times V. So we want to understand their growth and their profitability. We want to understand how they are valued. And if we rank them based on their trend, their technical performance, we can see that the market is giving us real information about what is working and what is not working. And we can see from this table that it is profitable companies, but expensive companies that the market likes the best, right? Bad valuations, but great charts. And these are the ones that are leading the pack. Now, from a portfolio management perspective, let's say in your analysis, you just do the technical ranking. You just do relative strength of these industry groups relative to the S&P 500, and you see that software and semiconductors, mining companies, internet stocks, medical companies, these are the ones that are leading. That's where you go looking for individual long ideas. And these that are doing terrible, leisure, energy, apparel, that's where you're going to go look for either short trades, or you're going to stay out of those industry groups. Does that make sense? Let's move along. From here, right, we could look at those top performing industry groups like semiconductors. And again, we're using the COVID-19 crash as our textbook example. We can look at semiconductors, the industry group relative to the benchmark S&P 500. We can see that on an absolute basis, right, everything crashed. That was unavoidable. The whole world was shutting down. We had no idea what this global health pandemic and crisis was going to do. from a pure price action, from an absolute trend perspective, everything's falling. So if we were going to do cross asset analysis, maybe we were all holding gold during the COVID collapse. But when you look at it on a relative strength basis, relative to the S&P 500, semiconductors actually are outperforming the market. They were rising going into the crash and rising coming out of the crash. That's the power of relative strength for the industry group. So we know semiconductors are a great group to be invested in, but then we got to look at the individual chip making companies. And I've removed all the names from here, but we could see a rank order of those chip manufacturers that comprise the industry group, and we could do the same relative strength work, but test those companies not just against the S&P 500, but against all other semiconductors. All right, so here's what that ratio looks like. And obviously, there, even amongst an industry group that is leading, there are winners and there are losers. We want to own the leading securities from the leading industry groups within the market. All right, so a sector analyst, again, thinking back to our fundamental colleagues, if you're a research analyst and you're covering semiconductors, you're supplying this research to a portfolio manager, they want to know what do we want to be long and what do we want to be short, or overweight or underweight? What do we want to stay away from? And so you got to rank order based on the relative performance of these individual companies. Some of these down here are great short trades. All right, so let's look at a couple of those charts. All right, chart number 1 versus chart number 15. Very different picture. Now we can scan through 3,000 securities and look at the same charts and identify that this one may be bottoming, but let's look at the relative strength in the bottom panel. So relative to the S&P 500, the blue line, chip company number 1 is cruising higher. Relative to other semiconductors companies, chip company number 1 outperforming. This is an absolute winner. The fundamentals are driving that, but of course, a rising tide lifts all ships. It's in an industry group that is outperforming the market. Chip company number 15, it's kind of holding flat with the S&P 500. I mean, all equities recovered a bit after that COVID collapse, but relative to other semiconductors, this is a real laggard. This is underperforming. And if we're trying to capture alpha, if we want the biggest winners, then by definition, we want to own the securities that are outperforming the market. I'm going to jump through this next example. It's the same idea. You could look at a really beaten down sector of the market. You could rank all of the companies within that industry group or sector, and you could look to do the same kind of relative strength work going on. But in the interest of time, I think you guys all understand the concept of relative strength, one of the core pieces of information that you're going to use a lot through the CMT curriculum. Let's talk about breadth. The way I talk about breadth has to do with my childhood. I was a huge fan of the 1990s Chicago Bulls. And of course, everybody likes to talk about Jordan, but that team had incredible players in every position on the court. You had Scottie Pippen, you had Dennis Rodman, you had a team, and each person on the team had their job to do, and they did their job so well. A great coaching staff too, I've got to say. So when we're looking at trends in the market, if we just look at the index, we just look at the S&P 500 or the Russell, we can see that an index might be trending higher. But we don't care, we do care about the bench strength within that trend. So the Chicago Bulls won 7 back-to-back championships, not just because Michael Jordan was the greatest basketball player of all time. I'm sorry, Steph Curry fans, but because he had a great team around him. We care about what's happening under the hood of an index. We care about all of the stocks in an index. And so if we're looking at breadth, we can look at things like the advanced decline line, right? How many issues are advancing versus declining within an index? We could look at things like the Russell 2000, and we could plot breadth underneath our price chart. These are weekly candles. And of course, going into the COVID collapse, what did we see almost a month before the price action really caught up? Well, what we saw was a rapid and serious decline in a lot of the issues, a lot of the securities within the Russell before the index even tapered. So by looking at market breadth, we can start to see the overall trend of the markets well in advance of the index actually sliding. We can see in this example that the Russell corrected, right? It resumed an upward trend out of that COVID low, but we saw breadth expansion pretty tepid, right? We didn't see a lot of new exciting 50-week new highs. We didn't see a lot of expansion of breadth during that period where the index was recovering sharply. What we did see is that once the index stalled out, and this is in April of 2021, we saw a rapid rotation of leadership groups within the Russell index, and we saw a ton of new companies in fresh bull market territory. So our job as traders and investors is to not be lazy, right? We got to get under the hood, and you would miss this stealth bull market if all you cared about was looking at the overall index, the Russell 2000. Instead, we want to do the homework. We want to look at the relative strength, and we want to pay attention to breadth and find those securities that are breaking out, that are moving to new highs, that are supporting what will then become the next leg higher in a bull market trend. Similarly, what we saw in the indices here in 2024, a lot of folks really terrified about this Meg 7, the thin breadth of the market. And what they were talking about there is, look, we had a championship winning team in the S&P 500. The whole team was participating. And now it seems like we've only got a couple of star players, right? The Magnificent Seven stocks are the only things holding up the entire index. And they do that because the index is cap weighted. That's how it's calculated. And so those mega cap tech names were holding us up higher. All right, last lesson here, divergence analysis. We could use any number of indicators on our chart. I'm going to talk about RSI. That's different from relative strength. The RSI from Wells Wilder, delivered to the markets in the 1970s. Wells Wilder was a annual award winner of the CMT Association and a good friend of the community. The idea of momentum and momentum divergence is really powerful. When we see price climbing to new highs, but we see our momentum oscillator, the RSI, making lower and lower highs at each new price point, we can see the exhaustion showing up on the chart. Now, every time you see a divergence doesn't mean that's an immediate reversal of trend, but we can see bearish divergence here on the left side of the chart. We can see a bullish divergence here. At this ultimate low, we saw a higher low in the momentum oscillator. It tells us there's less and less enthusiasm for more selling of this security at those ultimate lows. All right, I see that it's already 4 o'clock and I haven't even made it through the last section. I'm going to take just 2 more minutes and tell you a little bit about the CMT program and hand it right back to you, Jeff. Here's the idea. When you are thinking about how to be a responsible and rigorous investor and analyst, you have to understand these first principles, concepts like market breadth and relative strength. It's much more than just buy and sell decisions using the charts on using the tools on our chart. Instead, we cover knowledge domains like risk management. We do a lot of quantitative systems design work. We can put all of this in the context of portfolio management, and we apply these lessons from the behavioral finance community both to ourselves, the mental state of being a decision maker with other people's money, but also how you can spot those extremes in the marketplace. It's a global credential, 3 levels of examination, 3 textbooks to go through, and then of course experience and eligibility criteria to become a chartered market technician. There's a lot of text on here talking about the time frames and the formats for each of these exams. I do a weekly office hours session with all of our CMT candidates every Thursday morning at 8. And so if that's you, we look forward to welcoming you into the CMT program, where I can go into much more detail about all of that. The core idea, and you can scan this QR code right here if you want to jump over to our website and learn some more about the CMT program. But all 3 levels build on each other, and that creates the value that the industry is looking for. We go out and survey hiring managers. We talk to the heads of trading desks. We talk to chief investment officers about the knowledge, skills, and abilities that they're looking for in their next hire. We also canvass our entire charter holder community worldwide, and that's what helps us frame out the knowledge domains and the weightings of all of the topics and subject matter that's covered in the CMT program. It's a living body of knowledge, and it changes and adapts and evolves alongside the industry. That's why it is such a powerful credential. In terms of why somebody would dedicate so many years of their life, so many nights and weekends to all of this study, it comes down to having a career path, and the value of the Chartered Market Technician designation is reflected in some of the survey work we've done with new charter holders 1 year after completing the program. Over 68% responded of having more responsibility a year after becoming a charter holder. What they were talking about is greater assets under management. So whether it was a prop trading firm that allocated more to their strategies, maybe they're an asset manager and clients were bringing more money to them as their wealth manager, or on the institutional side, you can see firms allocating to chartered market technicians because they have a defined, rigorous risk management approach and the ability to capture alpha. That's the value of the designation once you have the trademark, Chartered Market Technician, CMT, after your name. But there's a lot of value just going through the program. As I said, it's a complementary discipline to fundamental analysis. It provides a lot of differentiated value within the workplace. And then it's a structured approach to learning all of these tools. That's why you're here at this conference put on by Metastock, because you want to learn in a robust way how to become a more disciplined, rules-based trader. The CMT program is a way to level up in a big way. Those 3 levels of the textbooks are currently published by UWorld. It's a financial publisher, and they actually asked me to share with you a discount if you wanted to pick up your copy of the textbook and start doing some studies. You can enter this code, CMTTW30, on any of the 3 levels that you are eligible to purchase. You can use that code to receive a 30% discount. All right. The CMT program is really powerful. You don't have to take it from me. There's a lot of information on our website. As soon as I'm done, you can head over to cmtassociation.org. A lot of testimonials with big money managers from the business and how they use both their CFA and CMT in concert. I did mention the academic partner program, and I'm not going to spend a whole lot of time on this, but we work with colleges and universities worldwide, over 75 institutions, and we work with their professors and the students for practicum education. So we host an international trading competition every fall and spring semester. We have campus ambassador programs, and then we also offer scholarships to students. So if you're a full-time student on this conference, by all means, reach out to us, academy@cmtassociation.org, to learn a little bit more about the investment challenge, the internship opportunities, and even those scholarships. What I have found most wonderful about this community is that no matter what state of the industry these titans have reached, they still have time for anybody with an interest and good questions. This is Bob Farrell signing some autographs and talking about his 50-year career as the chief strategist at Merrill Lynch. That's Ralph just handing out hugs everywhere he goes. All right, you can find us on Discord and all over the internet. Let's move to the last slide, which is the upcoming exam dates. If you are not yet registered, I'm glad you tuned into today's session, because you could save yourself $400 on your registration into the CMT program this weekend. 4 days left before our standard registration period ends. Those exam dates, December 2 through 16, that's going to be our next exam cycle, and you should register before October 1st to avail of those discounted prices. That's all from me, Tyler Wood, CMT. Thank you very much for spending the hour with me. If you've got any questions, you can shoot me an email. You can find me on social media. I think we call it X now, or on LinkedIn. I'd be happy to get acquainted with you, help you along your own career path, and answer any questions you have. Thanks so much for sticking with me. Jeff, thank you so much for having me again. I'm looking forward to seeing you tomorrow afternoon.
All right. Thanks, Tyler. For the 33 sectors that you use, just a quick question. Are those the IBD sectors that you're using or something else?
That is exactly right. How did you know?
Okay. I Googled it, but it was a question. I wanted to make sure I got the right answer. But yeah, Google knows everything.
Yeah, IBD is a wonderful organization, and I think How to Make Money in Stocks was one of the first books that really got my attention.
right.
Bill O'Neill is a legend.
Very cool. Thank you very much, Tyler.
Thank you, Jeff. I'll talk to you soon.
All right.
All right. Cheers.
Okay. Let's go ahead and kind of get this kind of over to me again. Let me make me the presenter. Go ahead and show my screen. Go back over here real quick. All right. Advance a little bit. All right. Okay. Very, very cool. Okay. All right. So we kind of get, dang it, a full screen of my face in front of me. Okay. Thanks again for everybody that's participated. I just want to remind you, 31 years in a row, Metastock's been rated #1 in this price category by the readers of Stocks and Commodities magazine. Allows you to scan on markets, focus on opportunities, test trading ideas. The offer we're doing, we talked about this a lot last time. If you buy a month, we'll give you a second and a third month for free. You can do that at metastock.com/conf-promo. All of the offers today are going to be part of that. metastock.com/salespchat, or give us a call at 800-882-3040. Special shout out to Stocks and Commodities magazine. You can find them at www.traders.com. And they do a very good job as well. For this price, just to kind of, I won't need Greg, just to make it really fast, what I'm going to do is I'm actually going to give away a special book. I'm going to grab it. Should have grabbed it before, but I just thought about it. Adrian Matt spoke yesterday. I think it was yesterday. It's been a few days. But I have a couple of his books. These are the Around the Horn. Very, very nice book, $95. He's working on a second edition to it, but this is awesome. Has all of the patterns that he uses to trade, all that kind of stuff. What I'm going to do for this one is instead of doing like a random number drawing, I'm going to take anybody that's made a comment today. And I'm going to kind of randomly pick. So let's go ahead and just kind of scroll up a little bit here. I'm not looking. Scroll down a little bit. Okay, I've got all the... well, Greg Lewis can't win. Let's try again. Sorry, Greg. Okay. Satish G was earlier today. He was asking about the Nifty 50. I'm going to go ahead and put this in the chat for the bottom. Satish is the winner. Okay. So I'm going to go ahead and kind of put that out there for him. I do have your email address, Satish. You don't have to send it to me or whatever. Let me go ahead and do that. Our next presenter today is AJ Brown. AJ has spoken at a number of Metastock events. I remember he used to live in an area that was very similar to mine. He does a great job. He used to live up in kind of the Northern California area, and we kind of talked a lot about that, but he's been trading for a number of years. He does a lot of options research. He's a very, very good presenter, and that's why we keep bringing him back. AJ, how you doing?
I'm doing well. I've got a little bit of a voice issue from celebrating my little toddler doing some gymnastics, so you're just going to have to deal with the low, raspy voice.
So you were cheering too hard?
I was cheering too hard.
Oh, okay. Well, that's awesome. Here, let's go ahead and make you the presenter.
Excellent, excellent. Hi, everybody.
I can see you.
Perfect. And I'm going to go ahead and share my screen. All righty.
All right. So I can hear you. You sound pretty good. You sound like a horse angel.
I
can
Hi,
see
everybody.
It's all you, AJ. Take us away.
All right. Listen, I'm going to go over a behind the scenes look at how I create income selling options. And I want to make sure you can do it too. And of course, what we heard from the previous speaker, I can't emphasize enough about being disciplined and taking into consideration, especially in our case, we're going to be selling options, but we have to make sure we're selling options against underlying symbols that are robust and heavily scrutinized. You know, at Trading Trainer, I was listening to a lot of what, they were talking about with respect to what makes a good candidate and all of the above. And a lot of the screeners that we provide our users tap into that research. And so I'm kind of like validated that, that disciplined approach goes across the board, not just for directional traders, trend traders, but also for premium sellers like what I'm going to be talking about today. So let's get right into it. So I've got a couple of facts. First of all, we know there's so much uncertainty along with this election, with big skirmishes around the world, whether it's, in the Ukraine, whether it's in Israel, whether it's in Sudan. There's a lot going on. Then there's a lot of stuff happening here. Are we going to get spending happening? Interest rate drops, what's the Fed up to? But now when you separate that from what's happening in the markets, what's happening in the markets, first of all, you got to kind of ignore what a lot of the talking heads do. They'll talk about how so much trillions of dollars was lost in the markets, blah, blah, blah. The markets are only places where money changes hands. That's the definition of a market. So the key is putting yourself on the correct side of the equation. It simply moves from one hand to the other. And so what I've always focused on, and I've been doing this premium selling since the late 90s, is making sure that I'm on the correct side of the equation. You'll have noticed if you're a VIX watcher, a VIX is kind of a measurement of confidence versus fear in the markets. You'll notice that the VIX has been climbing in the last couple of months. It had been kind of living down at some of its lows around $12. Now it's been anywhere above $15. Sometimes it's up above $20. The beautiful part is when most people see the VIX rise, they get a little bit worried, right? Because that's what it measures, is the fear in the markets. But if you're selling options, you're actually having small little celebrations, because when the VIX goes up, we get higher premiums than we've ever asked for before. And of course, you know how they always talk about what's always true in life is death and taxes? Well, as option traders, we know there's a third truth, and that is on the expiration day of options, its extrinsic value, its premium value is always going to go to zero. So whatever we sell premium wise, whether it's high because the VIX is high or not so high, we know that it's going to expire worthless. And if we play our cards right, we're going to get to capture all of that premium. So we like it when there's fear and uncertainty in the markets as premium sellers. So let's get a little bit further into my presentation. First of all, I always like to take the temperature of the room. I like to know, are you here because you want to learn how to invest, get low risks, high returns? In other words, are you here because you're picking up strategies and you want to be 100% self-reliant ultimately? Or there's a lot of folks I've found who want to be self-reliant, but they'd love to do it in a crew, a tribe of seasoned investors who will look over your shoulder right before you do stuff and make sure you're on the right path. And finally, I found that there's always a group out there of people who aren't actually interested in like learning all the nitty gritties. They just want to be in room with seasoned investors and kind of do what they're doing. Maybe if you're using the fisherman analogy, you like to fish alongside expert fishermen and do what they like to do, right? So, and of course, there's always the miscellaneous. Everybody's got their own reasons. Do you mind typing into the chat and letting us know whether you're an A, B, C, or D-er? And that'll help me tune, what I share with you today, because I've got a lot, probably too much, and I might wind up skipping through slides, and I want to skip through the right ones. I also have a lot of examples to show you, so rest assured it's not just going to be a slide presentation. Great. Okay. I always start my presentations with something I'm sure you've seen a bunch of times, which is asking you to understand compounding interest, but also understanding the amount of work that goes into compounding. So I could give you $50,000 right now, or a penny that doubles every day for a month, right? But I want to put a preface on this. Again, people always talk about it and they forget that this part right here, this $50,000 a month, let me go ahead and pull up my pen here. This guy, or this penny that doubles every day for a month, it doesn't just double automatically, right? You have to actually do stuff. You have to be active, right? All right, so let's go ahead and go through, first of all, we'll go through the first week. And after the first week, which is about roughly a fourth of the month, assuming that a month has about 4 weeks in it, that $50,000 sure does look good, especially with the amount of daily effort we had to go into making sure that that penny doubles. It's like, did I make the wrong mistake here? Let's keep going though. I'm still putting in the effort. I'm about a third of the way through a 30-day month. Yeah, I'm still regretting my decision because I've been putting in a lot of effort, and especially with all the people around me and all the presentations around me telling me that I could be doing so much better off, especially with the amount of effort I've been putting into analyzing and things like that. I'm kind of wondering if I made the right decision. $5.12, and I've only got 2/3 of the month left. But let's keep going. All right, 2 weeks in, 15 days in, about a halfway through the month, I'm still regretting my decision, right? I've had to put in consistent, disciplined effort through day 15, still nowhere near that $50,000. All right, I'm 3 weeks in. Things are looking a little bit better, but the month is almost over. I'm up at 10,000, just under $10,500. Once I get to day 24, the month is almost over. There's literally only about 6 or 7 trading days left, doubling days left, I should say. But I did finally get more. But look at all the effort I had to put in and all the days where I had to question myself. But if I keep going, it's that back 9 that really makes all the difference. If I stay consistent, if I stay disciplined, if I stick with it, which is so counterintuitive to like the instant gratification world that we constantly live in. But the key is if you just keep doing it and keep knowing that the payday is down, gosh, at the end of the month, you could be, over $21 million richer. Again, that's a demonstration of compound interest. Not sure if Albert Einstein ever said it, but they keep attributing it to him as it being the most powerful force in the universe. Now, on that same talk of compound interest, I'd like to show you this chart here. Now, I'm going to come back because I'm actually going to show you the trade that backs this chart. But if we look at this, I mean, first of all, there's this line here. This actually is the 0 line, loss below it, gains above it. And there's 2 graphs. They're not linear, they're parabolic. They go up exponentially. And they're labeled range high, range low. And even the range low gets above the break-even point very early on. So I kind of want to imprint this chart onto your mind. We're going to revisit it, but this is how we can make our trades compound as well as make our portfolios compound. We'll come back to it. I just wanted to get that kind of imprinted in your mind. So coming back, I'm not going to be talking to you about how you can double your money overnight, like in the case of the doubling your penny. I mean, there's sometimes we do a trade that can, double our trade amount in just a single day. For me, that's few and far between being an end of day trader. And it's really not something I want because usually when I talk to people who show me some individual trades that do that, when I look at their overall portfolio, I actually see that, yeah, they had these great wins, but they had much more losses that wound up, changing the weight of that scale when you look at the portfolio. So what I've always done is I've looked at my portfolio on an annual basis, and I reverse engineered so I can get some actual real world targets. So my goal is to earn 6% on my money every month, because if I do that, then my money more than doubles every year, right? So if I have a portfolio, and a common starting point for a lot of option traders is $1,000. If I have $1,000, in 12 months, I have 2,000 and change. In 2 years, I have over $4,000, right? 5 years, I have just under $33,000. And after 10 years, I'm a bona fide millionaire. Now, when I was a kid, so I'm 51 years old. Yes, I have a toddler, but I'm 51 years old. But when I was a kid in the 1970s, early 1980s, you'd see on TV, whether you're watching Chips or Miami Vice, that being a millionaire is a big deal. Nowadays, it's actually gone by one decimal point. You need to be a 10 millionaire, right? Everybody's a millionaire. If you want to differentiate yourself, your portfolio needs to grow to 10 million, right? But my point is this is actually the recipe I followed starting in 1997. And I'll be honest, my first few years of trading, I was on a trial and error type learning instead of, finding a good mentor at the time. It took me quite a few years just to get my gears in straight. But once I started to accumulate wealth, and I didn't leave my day job, by the way, so I had to focus on being an end of day trader. I didn't leave my day job until 2005. In 2005, I hit a critical mass, and I was working for Hewlett Packard. Jeff was talking about how we both kind of lived in the Santa Cruz area. I lived in Santa Cruz, California, and would drive over the mountain to get to Silicon Valley so I could spend my days working at Hewlett Packard. And I kept doing that while I traded in the evening as an end of day trader until 2005, when my portfolio hit a critical mass and I was able to then live off of it. And I haven't had a day job since. I've been managing my portfolio and living off of it since 2005. In fact, that's what I'm talking about here. If you grow your portfolio to $100,000, that means if you focus on those doable goals of 6%, you can generate over $100,000 of returns every year. And the beautiful part of that is, if you look at the salaried positions here in the United States, the salaried position is on the median salaried position is $87,000. Now that's for a 60-hour-a-week work week, right? Here we're having our money work for us. I don't nearly put in 60 hours a week, right? So I like the idea of having my money work for me. Makes sense, right? In fact, if you look at your expenses and you look at that critical mass number, you grow your portfolio to a certain critical mass, and the idea is that your expenses are less than the return so that you can continue having your portfolio grow in perpetuity, right? By putting the same amount of effort as you did in day one. So how am I doing these 6% returns? Well, I'm selling theta decay optimized option premium. My goodness, is that a bunch of word salad? Let me break it down. I'm profiting on time passing by. So before I even quiz you on that, the idea here is options. A lot of people think of options as only for their force of leveraging underlying symbol moves. Like if I talk to a person on the street and I mention options, if they even know what I'm talking about, they think about how it's a derivative of a stock and how you can use it to leverage stock or equity in ETF index moves. But there's other components that influence an options price, and one of them is time passing by, right? Options are called wasting assets because they have expiration dates. That's a very reliable influence, right? When you look at what influences prices, I mean, you can analyze stocks all day and all night, whether you use technical analysis, fundamental analysis, whether you use bar patterns, price patterns, quantitative analysis, looking at order flow. it's still ultimately, you could better your probabilities, but it's still a risk and return. But time is going to continue to pass by. So if we capitalize on the component of options that basically changes its value with time, I mean, it becomes kind of a no-brainer, doesn't it? Now, before I go any further, I do like to do kind of a comprehension. Make sure you've been paying attention, for now. And by the way, I'm going to quiz you throughout my presentation, and the questions get harder. So first of all, what do we need to focus on for monthly returns in order to double our portfolio annually? I'll look over here on the chat. 0.5%, 1.5%, 5, 6, 10. What do you think? I'm seeing the answers come in. You guys are right. 6% is what I said. And a lot of my program participants, they're making double-digit returns on their premium selling trades. But we aim for the stars, or we aim for this target, we aim for the moon, and if we get to the stars every once in a while, great. But let's get some actual tangible goals in place. So I talked about options. Aren't these things risky? Well, they were created for the opposite purpose, weren't they? They were created in order to reduce risk, right? Because not only do options profit when, for instance, their underlying symbol goes up, right? When you think about somebody who trades stocks, indexes, ETFs, they only make money if they buy low and sell high. That's one way to make money. If you're elegant and you have a margin account, you could also make money by shorting, right? So you can, sell to open high, buy to close short, make money that way. So you have two strategies. But options trading allows you to make money also when the market goes sideways. It allows you to make money as time passes by. And options are also influenced on whether, when we talked about this a little bit in the beginning, whether there's fear or confidence in the markets. In fact, last time I was reading, I'm kind of a nerd. Last time I was reading some of the papers out of Harvard about options, they've determined that there's 27 different ways to make money using options rather than just one or two ways with the underlying symbol, profiting when the price goes up or down. We can use options pretty much for any other pattern that's out there. So that's why I like options. Because again, when I was looking at myself as a full-time worker, right, and I needed to be an end of day trader, I wouldn't be able to get my timing signals just right. I mean, I tried things like Forex where you had to be up at like midnight, 1 a.m. in the morning and be right there and try to get that signal, that timing signal just right. It wasn't for me. For me, I rather do things offline and simply like my toddler does. She has this toy where she's got holes in like a piece of board, different shaped holes, and then she grabs the shape, the triangle, so I like to identify the market, what patterns are appearing there, and then go into my tool chest and pick from one of the strategies in order to profit most on that pattern. I rather do that all day and all night rather than try to time my signals when I'm not even available. So I keep mentioning options, and I understand some of you may not really grasp them, especially when I said there's more that influences the options price. It's a derivative, right? They're typically bought by the big money traders in order to hedge against risk, right? But what I'm doing is I'm selling their premium. I'm selling to those people in order to generate income for myself. Let me just ask a quick question, because this might be where we have a place where I can save some time. If you could, let me know. Let me see over here. I'm going to look at the attendee list. Let me know with a raise of your virtual hand. You probably have a hand raising button. I might not be able to get to you folks if we're streaming on YouTube, but let me know if you've heard of me before, because if you have, I won't go into as much detail. I'd like you to know a little bit about me, but if you already know me, there's a couple of hands going up. Here, let me just cover a couple things. First of all, you can find me all over the web, right? I've got a YouTube channel. We do a AJ Brown show every Friday morning. We've got podcasts, Facebook. They don't call it Twitter anymore. I think it's called X. We've got our Twitter that we publish to. We've got a bunch of articles that we've put together. I've written so many white papers and have them published. You can reach out to us directly, either through our messaging or even just give us a call. That's my phone number. If you're at any of my channels, like on YouTube or Facebook, do me a favor, give me a like and a subscribe. That way we'll keep the algorithm happy. I founded a company called Trading Trainer back in 2002. They call me the world's most disciplined options trader. I think these are my peers. I think behind my back, they call me the laziest options trader. I think I like to think of myself as the most efficient options trader, right? Because I like my days to myself, right? I'm a big scuba diver. I love doing, in my late 40s, I started to get into trapeze arts. You know how they always say, I want to run away and join the circus? That was me, but now I can do it because I have all this free time during the day. So in the backyard of this home office that I'm broadcasting to you from today, I have a trapeze rig up, right? Where in between trades, I'll go out and do a couple moves on the trapeze, right? I love my personal time. I have a toddler. I mean, who else can spend every minute that the toddler's at home and not in daycare with them? Me, right? Because I do my stuff end of day and I'm very, very efficient. I'm in it for the destination. I'm not one of those people who likes to go to cocktail parties and talk about trading and all that. I care about one thing, and that is growing my portfolio and living a real nice lifestyle and all the time freedom that I get to do whatever I want, because I know every minute, has to be lived to its fullest because you don't get those back. I can make money back on the markets as much as I want, but I'm not going to get my minutes back that I've lost, that have ticked by, right? I've been doing this since 1997. The company I started in 2002. If you go to any successful option trader, more than likely, if you look through their ebooks, they've got one by me called The 7 Strategies of Successful Option Traders. Published that in 2005. Put out a home study course. You'll see that on a bunch of people's shelves. Did that in 2008. And the key is in 1997, well, I've got a bunch of degrees that I never really used. I went right into marketing for companies like Hewlett Packard and such. I have a very strong background in commercial business. And most importantly, in the last 2 decades, I've been focusing on how to teach people. I've been taking every course I can and being quizzed in every way and getting every certification I can to be able to convey the knowledge that's up here to other people. It's called accelerated learning methods, especially for folks that are, not in that, plastic point where our brains are still plastic and sucking in information. Sometimes we get old and we're like, it's hard to learn. Well, I've been working on how to get even the most, stubborn folks to be able to pick up on new techniques. And also know, just like a lot of you, I spent a lot on seminars when I first started, and I gave almost 4 times as much back in making stupid trades. You might want to take some notes on this. If you want to be a successful investor, here's the 4 shortcuts I learned. Number 1, stop chasing shiny objects. In other words, figure out what works for your lifestyle now, like I did. Like I found out I couldn't be an intraday trader. I couldn't be a day trader. I couldn't be a middle of the night foreign exchange currency trader. I had to be something that could work with my lifestyle. I really, until I gave up my job at HP, I really loved my time there. So I wanted to give as much to that time as possible. And as I told you now, I have so many hobbies. I don't want to give any of them up. So find what works for your lifestyle and then focus on it. Don't get distracted. And then find somebody who is currently doing what you want to do and that can also teach. That's called learning from guided discovery. It's proven that guided discovery is just as good as trial and error to learn by, and it's faster and oftentimes cheaper. So do that. Join an investment group, right? Not only because it holds you accountable and it gives you camaraderie, that's always nice, but also because you can look over other people's shoulders. It's called leveraging with pride. And if they're trading something good, there's no reason why you can't trade it as well. So go to it for trade ideas, right? And also, it's a two-way street. Make sure when you're doing a good trade, you let everybody in the investment group know as well. Finally, I want you to surround yourself with like-minded investors, right? You want somebody who will celebrate when you have your wins, but will also pick you up when you have a loss. Because if you get a loss with your portfolio, man, it could feel like the end of the world. But if you're surrounded by like-minded investors, they're like, that's part of the game. It all comes out of the wash at the end. Keep going, right? So this is exactly what I did, and it works. So I know it seems straightforward, but write those 4 down. Okay. Oh, I always like to plug my foundation. I have a foundation where I take inner city kids off the street. These are classically like underserved folks. We started off in 2003 doing this in Denver, where I was based. After that, we've since relocated to the Chicago area. There's a lot of, underserved youth in Chicago. We've partnered with the Chicago Board of Options Exchange, and after a little break because of the pandemic, we're back at it. We just graduated 160 folks last year. So I'm pretty stoked about this program. I mean, it's the same program that I work with even my other clients who are part of Trading Trainer, right? If we can take classically underserved kids who don't have access to even internet and computers and get them working on their financial literacy, working on their trading, and at the end of 6 months have them showing profits, I bet we can do that with anybody, right? So what are we focusing on? 4 simple transactions. We're focusing on covered calls, covered puts, covered calls against leaps. That's, for you academic folks out there, that's bull call diagonal debit spreads, right? And I call it supercharged covered call writing. Basically, we replace the stock with a back month option as our covering position. And it includes a little bit of leverage. It's pretty great. In fact, I try to do all my trades as these diagonal debit spreads. And the other one is the covered puts, right? You can do the covered puts supercharged as well. In fact, there's another benefit of doing that. Think about this. The initial covering position for doing a covered put is shorting a symbol, a stock, an ETF, an index. And in order to short that symbol, you need to be able to do, you have to have a margin account. A lot of the folks I work with do this in their retirement accounts, which are cash accounts. And a lot of folks don't have a margin account. They just have cash accounts. When you substitute that back month, when you substitute that shorted stock with a back month put option, you turn that into a cash trade that can be done in a retirement account. So I really like the bear put diagonal debit spread for a multiple of reasons, right? Here it is right here. So write down these 4 transactions and then mark covered calls and then the covered calls against leaps and the covered puts against leaps. Mark them, put a little mark by them so that you know that those are cash trades. Know that this one, the covered put, requires a margin account. And if you don't have it, then you can simply switch over and get the same effect by using the bear put diagonal debit spread. All right, I keep mentioning this word option premium. Notice that when you look on any big board, right, and you're seeing the option prices go up and down just like the stocks and the ETFs, That option price is made of two components, an in-the-money component and a premium component. When you add those things up, you'll get the option price. Or if you know one of them and you subtract it from the option price, you'll get the other one, right? Just classic, math, arithmetic. It's that premium component, that's the component that we're trying to sell, right? So here's an example, and I used end of day prices from yesterday so that I would have, something up to date to show you. So what if we bought shares of Ford? Yesterday, Ford closed at $10.42. If I bought that share of Ford and then immediately sold the October, it expires the third Friday of the month, the October 18 option at the $10.50 strike price, I would get 60 cents back. That 60 cents back kind of acts like a discount, right? It lowers my break-even price now because I just made some money and it lowers my break-even price. It's also going to act like an expiring coupon because basically this option has a timer on it, and on October 18th, its premium value is going to go to 0, right? So it acts like kind of an expiring coupon. It also, it's not a dividend by the true sense of the word, but it kind of, for me, acts like an instant dividend. The minute I sell it, and you'll see here I'm saying that I'm getting $60. One thing you want to put in your notes is that options are sold in lots of 100. So when I sell a contract of options, I get 100 times the option share price, or $60 in this case. So it acts like all those things, an instant dividend, discount to the underlying symbol purchase, expiring coupon. Let's run through the scenarios. So let's fast forward to the third Friday of October. What happens if Ford closes above that strike price of $10.50? All right, Ford, we bought it for $10.42. We're going to get exercised and basically get $10.50 a share. So I get 8 cents of profit, but don't forget, I already collected 60 cents of profit for a total profit per share of 68 cents, or I'm setting myself up for a nice 6.9% ROI if I get exercised. Not bad. But now what if Ford continues to go sideways? Ford likes to go sideways often. What if it goes sideways by October 18th? Okay, I spent some money on the shares, $10.42. I got 60 cents. That 60 cents is mine to keep after the third Friday. That's a 6.1% ROI so far, and I'm gonna do it again and again and again and again, right? This is actually the ideal case, because if I can do this over and over again, it means I don't have to keep researching new underlying symbols. I just come back once a month, sell premium against Ford, and then at the third Friday of the month, collect my premium, right? It's like a paycheck. Now, of course, what happens if Ford drops by October 18th? Well, I'm going to show you a way that we can reduce the risk on return even further actively, but just know built into this strategy, we have kind of a profit buffer. In other words, we've reduced our break-even price down that the underlying symbol would have to go all the way down below the $9.82 break-even price for us to even be worried about this being in the red. So we create a profit buffer by selling premium against the underlying. And if we do it month in and month out, we keep reducing that profit buffer all the way, it goes lower and lower. Our break-even price, we just keep whittling away at it. So here's another one of our comprehension quizzes. If you were fast, I gave you the answer. What does investing by selling premium create? Does it create an instant dividend, a discount on a security, a profit buffer, an expiring coupon. What do you think? And it could be, in fact, it is, it's more than one answer. You're right. It's all of the above. All right. Now I'm going to get a little bit more. This time I'm going to ask you the questions in advance of me presenting something. By the way, I forgot to show you, I want to show you an actual trade. And this is on Ford. So check this out. We did, as a group, as my program participants did, we bought Ford back in January. We bought 900 shares of this symbol. Spent about $10,000, just over $10,000 on that particular trade. And then we just proceeded to sell premium against it. So February 16th, we sold premium 23 cents. It expired worthless on the third Friday of the March. Did it again in April. This time we got 80 cents, expired worthless. 35 cents, expired worthless. You get the pattern. All the way to the point where we finally got exercised out at $13. Just on this simple strategy, we wound up with 30.4% ROI. And not only that, we got right back in. We bought stock again August 13th. We sold premium on August 28th. That says September 28th, but it's actually September 20th because options expired last Friday. It expired worthless, and now we're looking for the next opportunity to sell premium again. The key here is we're doing one transaction a month. When it expires on the third Friday, that's all automatic. So I'm really only visiting this symbol once a month, seeing what's happening, and then collecting the paycheck every month. You can't get worse than that. Just 30.4% on this trade. That's fantastic, especially when it accounts for like 30% of your portfolio. Not bad. Okay. How can we lower our investment, increase our returns, or even convert a margin trade into a cash trade? I kind of alluded to this earlier, but should we sell out in time options? Should we replace the security with an option trading at parity? Is what I'm talking about just too much? Should we give up, buy mutual funds? Or is what I'm talking about not even possible? What do you think? A, B, C, or D? You got it. We want to replace that underlying symbol, whether it's a stock, an ETF, an index, with something trading at parity. What does that mean? Well, we know that option premium is the most when an option is at the money. That's why we always sell at the money options when we're looking to sell premium. But when we go deep in the money, the option has very little premium. It almost changes its characteristics. It's almost completely in the money or intrinsic value at that point. What the heck is all that word salad mean? Well, let's distill it down. A deep in the money option behaves exactly like the underlying security, right? So if the underlying security moves up $1, so does a deep in the money option. If it moves down $1, same way. But it's going to be at a cheaper price. Now, we are substituting a stock or an ETF or an index that doesn't expire with an option that does expire. So how far should we go? Well, it turns out that most of my program participants and I stay in our positions, if you look at a bell curve, about 5 months. Now, that bell curve's pretty flat. There's some positions that get, either exercised or stopped out in 2 months, and some that go to 8 months. After 8 months, it's rare, right? So we're going to go far enough out in time that the expiring of that option won't interfere with us collecting months and months of premium. And so that magic number is at least 8 months. Now, oftentimes we go right for the leaps. Leaps are options that are expiring every January, and they often go farther out. They've been in existence longer, and they just have liquidity. There's more buying and selling on those options. So for liquidity purposes, we often go to the next leap. We're already oftentimes, unless it's a big name, we're often going to the January 2026 options by this time as our substitute. So let's run through an example. Let's go back to Ford. Last night, Ford closed at $10.42. But the Ford June $7.17 strike price, I know that's the weirdest strike price. Ford had an adjustment of their strike prices because of a one-time dividend they gave. And so some of their strike prices are weird. Usually strike prices are on the dollar or on the 50-cent, $2.50 mark or $5. Rarely do we see this unless there was a dividend type exercise. But there's an option out there, Ford June 2025, $7.17 call. It only costs $3.40. And when you look at the breakdown of premium versus intrinsic value, I mean, the premium is all the way down under 5%. For all intents purposes, this is trading at parity. So if we use that option instead, so I buy that call option and then I sell this near term at the money call option, just like I did when it was a stock, I get my instant dividend. It lowers the cost basis, the break-even price on the back month option. It acts like an expiring, an expiring coupon. What if Ford closes above the front month strike price? I paid $3.40 for the back month option. Now I'm going to get exercised and I get the difference, right? The difference between 10.50 and 7.17. That's why it's called a spread. You get the difference between those two strike prices. So 10.50, 7.17, I get $3.33, which means I lost 7 cents. But I collected 60 cents up front. So my overall profit's 53 cents a share. And remember, I only had to invest $3.40 this time. So I actually wind up with an 18.9% ROI. Wow. Now, what if we're flat? Okay. Back month option. I keep the 60 cents from the front month option. The front month option expires worthless. I made 21.4% ROI so far, and I'm going to do it again and again. This is actually the ideal case that I do this trade over and over. And you can see the power of using the back month option at its leveraged price. And of course, there's the profit buffer built in. This back month option would have to start trading all the way below $2.80 before I'm even in the red. Now, don't worry, I'm going to show you one more tactic in order to increase or decrease the risk on reward. But just know, built into these strategies is that profit buffer. So let me show you really quick one more real life example, because theory is great, but look at this trade on AT&T that we did. So it started last November and it just finished this past June. We bought, instead of buying the AT&T stock itself, we bought the June $10 call. And so we bought 20 contracts, just over $12,000. And then we started that same process. We sold options in December for 13 cents. They expired worthless. We sold options in January, 38 cents. They expired worthless. We sold options in February, 22 cents. They expired worthless. March, expired worthless. June, expired worthless. Wound up getting exercised on the difference between selling the $18 call and our $10 back month call. Got $8. Wound up walking away after all of it with 56% ROI. Again, I don't make these things up. These are actual trades. So I just want to remind you, we focus on 6%. If we do that, we're going to double our money every year. Last piece of our puzzle. Can we, or how can we drastically reduce our risk on return? Should we be selling half as much option premium? Selling out in time options? What if we color the investment with a married protective option? Or is what I'm talking about not even possible? What do you guys think? If you're all for collaring the investment with a protective option, that's exactly what to do, right? That's what we did here. Let me show you the actual trade that came up with this. This was one of my favorite trades to do altogether. This was a trade on Pan American Silver. And what you can see here is we purchased 600 shares of this stock. And then on the days that we sold premium, we would turn around and immediately buy a protective option. The premium we sell is always near term and at the money. The protective option we buy is always 3 to 6 months out and provides protection close to our break-even price. So you can see here the first month we sold premium at $1.76, bought protection at $4.75. Fast forward, the premium expired worthless, and here's the best part. We were able to sell that protection back at a higher price than we paid for it. That's because you only really need the protection when you've sold your premium, right? A lot of people say, well, why don't you put protection on when you first, start the trade? Because I don't need it. I can use, conditional sales orders or stop loss orders. The protection comes in handy when the premium's on it. So I sell my premium and I buy my protection on the same day. The premium expired worthless, and I'm then able to look for the best opportunity to sell back the protection. And it's like frosting on the cake. See, the way that we trade premium and roll in and out of the protection, instead of the protection being a, cost to the economics of our position, it's actually now becoming an added profit center to the economics of percent, right? We get the main premium trade profit, but then we also get a profit by rolling into the next protection. So the second month, we sold our premium, bought our protection, and then after the premium expired worthless and we went to sell our protection back, we made $1.47 on selling the premium. We made an additional 61 cents per share on rolling out of the protection. We did it again. In fact, we did it over and over again, and it created this beautiful picture right here. Basically, let me point out one more thing. And I know I'm getting tight on time here, but I just want to make sure you see these things. Look at this cost basis. This is the break-even price. And notice that I'm using the 34 strike price for my protective option. So notice after the first cycle, the break-even price is below $34. So what does it mean to you when you put a protective trade in place and where it kicks in is above your break-even price? In fact, every month your break-even price keeps getting lower. It means that you're insured for more than your position is worth. It's called making a risk-free trade, right? Think about it. If the trade works against you and you get stopped out, you're going to get $34 for something that you're only in it for, depending on what time, $29.53. You're going to get money even if the trade turns against you, because it's not about whether you have a win or a loss. It's about how much time has passed by on these option positions that really tells you whether you profit. So again, looking at this slide, so we have this break-even line. We have the average time that we're in the trade, right? 5 months. At 5 months, if the trade gets exercised, goes for you, you're going to get 65% ROI. That's what we got on this particular trade. But even if the stock gets stopped out, if our protective option kicks in, we're still going to get 50%. See, again, people come to me and say, can you explain your win-loss ratio? The point is if you're in the position long enough, there is no loss. You're guaranteed because the trade becomes risk-free. In fact, you can see here, I put this little line right down here. This is where the trade, slightly between the first and the second cycle, where the trade became risk-free. So it's about the clock running out, not about whether the position goes against you or for you. Because even if the position goes against you, if enough of the clock is run out, you're still going to make money. You're still going to walk away with 50% versus 65. I'll take 50% all day and have the positions go against me all day, right? That's the beauty of using these option strategies. I'm going to go past these courses because I just want to get to the summary here. There's 3 steps. We didn't even talk about covered puts today, or the covered put, on steroids. I'm going to give that to you. And I'm going to give you some homework. Do research that. Google it, whatever you need to do. Research covered puts, because it looks like, at least from my analysis, that for the rest of 2024 and a good part of 2025, you're going to find having covered puts in your back pocket, that's going to be a good strategy to know about. And I apologize for not having enough time today to be able to go through the same rigmarole with covered puts that we did with covered calls. But step 1, you're either going to buy or short an underlying security, depending on which strategy you're using, or even better, buy a substitute option trading at parity. Then we're going to sell a near-term at-the-money option for its premium value. We're going to get that instant dividend and that profit buffer. And finally, we're going to collar this with a married option that's 3 to 6 months out in expiration to protect your investment. Now, here's where Metastock comes in major handy, right? When you find these symbols, whether you use a screener like I provide, or you just go out looking for sideways moving channel symbols that don't profit in the normal trend following way, what you're going to do is you're going to look for channeling symbols, and there's a bunch of them out there, and you're going to look for some sort of indication of tops and bottoms. And there's so many different ways, and if you look on the Metastock menu, there's so many indicators that help you find tops and bottoms. But basically, if you're in a sideways channeling stock, you'll buy your stock or you'll buy your substitute call option at a bottom. You'll sell the near-term call option and buy that protective put at a top. The near-term call option, that thing expires worthless. Then you sell back the protective option, rinse and repeat, rinse and repeat, rinse and repeat. And I know I said we didn't talk about the covered puts, but basically the covered put is just the covered call in reverse. So you start at the top of the channel and you either short some stock or you buy that substitute put option, which acts like a shorted stock. You sell near-term put options when you're at the bottom of the channel, buy protective calls. The put premium expires worthless. You roll out of the protective call, rinse and repeat, rinse and repeat. Maybe 1 or 2 transactions per month. It's really straightforward, but you do have to be disciplined. So I'm going to take the last 3 minutes. I know we started about 4:15 after all was said and done. I'm going to take 3 minutes here because I'd like to know, How would you like to never miss a pick, minimize the amount of time you spend away from your loved ones or your hobbies, or if you're as dedicated to, I have one program participant who is so into being an emergency room doctor. And he's like, I wouldn't give that up for the world. I get way more out of it than a paycheck. Whatever your loved one is for you, or if there's a combination of things. And also, how would you like to make sure you have the support whenever you need it? Because isn't that what it's all about? It's about saving time. It's about creating clarity, and it's also about getting results. So I'm going to take a few moments to tell you a little bit about my materials, my trainings, my tools, see if they might be right for you. This is for someone who doesn't want to have a bunch of multiple data subscriptions, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things, doesn't want to do this all by themselves, and wants step-by-step instructions. In other words, this is for someone who wants consistent and reliable results. So I'm just going to quickly show you, you get immediate access. Actually, we just started giving our program participants access to this options lookup tool, which we were getting bummed about Charles Schwab and Thinkorswim. Charles Schwab, I don't know if you guys are familiar, but Thinkorswim is a good place to get options data. Their charting is okay. Metastock kicks butt when it comes to the charting part of it, but the options data has been really, useful in Thinkorswim. But Thinkorswim all of a sudden isn't available to our Canadian friends or our Australian friends. It's only here in the States. Also, since Charles Schwab hooked their data up to it, it's come all bunk. The data, the historical lookup tool they offer is usually riddled with really poor data. So we made our own tool, and our tool is accurate. You can see here on our home menu when the marketers just this week asked me, what do you want to put for the tagline? And I said, accurate data, confident moves. So anyway, you get access to this web portal, including tutorials. We have a once a month webinar where we go over, it's like a lecture series, and we have an archive going all the way back to 2010. We've done so many deep dives. Anything you need to know, we've covered, and you can find it. We also once a week have these workshops. We actually had it earlier today. And you bring your candidates, you throw them at us, we evaluate them, we decide if they're any good, we give you feedback so you can get better at picking candidates. We pick one of them and we plan out the whole covered call trade, start to finish, and publish the trade plan for everybody. And we do that week in and week out, and we provide the replays. We've got screener tools, lookup tools. We've got all sorts of downloads. Well, there's the white papers, but the key thing is the premium selling planning tool. All of these tools are available. All of these are part of that program. So the question is let me make sure I covered everything. Also, for the time you're with us, anytime you have a trade that you think you're about to do, you want to do one of these premium selling trades, we ask you to submit it to us, and we'll turn it around and give you feedback, just to make sure that you know what you're doing, and that if we we have a gotcha that we found, we'll give you a heads up on it before you place the trade. So the trade review is part of the program as well. People think that's priceless. So what is that worth to you is my first question. And then, of course, being part of the Metastock event, I have some bonuses. Number one, whatever you spend on my program, if at the end of the program you haven't made it back, I'm going to not only give you what you spent, it's not just a refund, I'm going to double your money back. Now, you can't do crazy stuff. You have to do, what we've taught you. But if you've done it and it's not proving out, I'm going to double your money back guarantee. So that's number one. Number two, I'm going to give you a strategy session with one of my coaches. You're going to talk about where you are and where you want to be by the end of the program, and even where you want to be, in a few years from now. and they're going to tell you exactly how to navigate to get there as fast as possible. It's all about the destination, point A, point B. So I'm going to give you one of those strategy sessions. So what is that worth to you? And then to end it up, if you go on my website, you'll see that the price is $597. It's a 6-month program. There's no other charges. I'm not going to put you on a subscription plan. I'm not going to make you buy all kinds of other stuff. That's it. The 6-month program. It's the same program I put my underserved youth through. And just for this Metastock event, we're going to go ahead and take $100 off. So here's how you get that $100 off. You go to optioninvesting.org/Metastock, and you got to use the promo code 100DISC. In fact, I want to make sure the programmers did it right. So here I am at optioninvesting.org/Metastock. And I'm going to go over here to promo code 100, capital D, capital I, capital S, capital C. I'm going to hit apply and cross my fingers. Yep, the price has been reduced by $100, and you can totally have at it. Now you might say, what is it going to take me 6 months to learn how to do this? I doubt it. I think it's probably going to take you more like 2 weeks at the most. And if you've got any sort of background, maybe to pick up on the nuances you don't already know. And if you're starting from fresh, I still think you could pick it up. It's not rocket science. So then why do I want you for 6 months? Well, number one, I want you for the workshops. If you come every Thursday or watch the replay, you're going to get a symbol handed to you along with a trade plan that you can paper trade or real money trade, right? So I want you to get those symbols for the next 6 months, every Thursday, get a trade plan. Number two, I want you to use the trade review because I want to hold your hand for the next 6 months through these premium selling trades till you get it right. I don't want to just cut you loose. So that's why I make it a 6-month program, because most of it is actually learn while you earn, right? And that's all I've got. If you have any problems with the ordering, you can't get that discount thing to work, just give us a call. We'll process the order over the phone. And that's all I got. Jeff, you still out there?
Yeah, thank you, AJ. We put that in the chat, and we put in the promo code. So thank you very much for joining us today.
Thank you for having me, and thanks for dealing with the raspy voice.
All right. Well, at least it was for a good cause.
Right.
Thanks, AJ.
Take care.
All right, let's do this. Okay, let me go ahead and make me the presenter. We're going to show my screen. And all right, I'm going to do a prize real quick. I mean, I know we're a little bit behind schedule, but I got all these prizes, and they're not going to give away themselves. So what I'm going to do this time is, hello, Mr. Lewis. Yeah, I'm actually just going to, for one of the people that are still in attendance, I'm going to randomly pick one of those guys.
Oh, okay.
So, actually, do you know how to do that? Maybe you could pick it out.
On GoToWebinar or on YouTube?
In GoToWebinar, because that gives you a nice little attendance.
GoToWebinar, I'm going to say, how about spinning the wheel? How about, dang it, just a second. I do know how to do it, but I'm not doing it very well. How about Terry Williams? Oh, I'm not supposed to say the full name.
Oh, yeah. Hope Kelly's not listening. All right.
Yeah, Terry W.
Yeah.
And I can give you the email address offline.
Yeah. I've copied it.
Email address.
I see her. Okay. We'll tell you what you want, Terry W.
There, W could stand for so many things. I don't even remember what I said a second ago.
I do. All right, Terry. We're going to give you 1 month of Melissa Armo's market report. This letter includes a list of economic reports for the week. The letter is where the market is gapping up to begin the week and the market outlook from there. So we're going to go ahead and give that to you as a prize. Congratulations. Thanks for being here. Terry W. All right.
Would you like me to get you another completely anonymous member of the audience?
Sure, we'll do this. Let me actually. Here, let me make sure that I paste this over here where I can use it later. Control V.
There's a Greg L.
Oh, I see what you're doing. I'm on to you. I see you, man. Okay, let's get on. What we're going to do, Anne-Marie has joined us. We're not sure. We're going to give it a go. We're going to give it a Boy Scout try. So let's go ahead and kind of get her started. And
I'll let y'all at it. Excuse me, and I'll bow out.
She's on backup power right now. And she's in, I think she's in Southern Florida, so it's very wavy and that kind of stuff. We're going to bring her on here. She says she's tested her internet. We're going to give it a go. She says she can broadcast charts. I can show charts. We're just going to see how it goes because we love Anne-Marie. She does a really, really good job. The biggest thing we want her to do, though, is say save. So let me go ahead and kind of make you the presenter right now, Anne-Marie. And I'll let you know if we can see your screener. Let's see. Okay, I can see your screen. we're getting somewhere.
Can you see my screen? I just wanted to show you where I was.
Oh.
Right here, we've got 65-mile-an-hour gusts, and the water is up over. All the boats are, I live at a marina, all the boats are just floating on their tethers. The docks are completely underwater. The trees are blowing sideways. It's insane. So
what we're seeing right now is a picture of a parrot, and I think it's your desktop.
Oh, let's try that again.
But more seriously, do you need to evacuate?
No.
Okay.
We are fine.
Okay.
Here we go.
Okay, yeah, we can see that now.
Can you see us now?
Yeah.
Yeah, so pretty excited that I'm here. I am hot spotting, and so hopefully it works really well. And I know we're probably got a little bit of brain bleed going, so I'm gonna go fast and try to give out tons of information. And again, sorry that my face is not on there. I don't want things to crash. And I did a test run earlier, and not so good in terms of holding it. All right. So for those of you that know me or don't know me, I've been trading I have a very strange last name. It's Latvian, and but it sounds like rubber band, marching band, nice and easy. You can forget all of those crazy vowels that are sitting in there. And I've been trading for about 20 years, and Jeff and I have known each other probably, I don't know, I'm guessing easily over a decade we've known each other. And so I have loved being part of the Metastock family, and I'm excited to show you how you can think about what we're looking at in the market where we've got all kinds of cross currents. A lot of us get a little overwhelmed by what we hear and where we think our political affiliations sit and that sort of thing. And so one of the cleanest things we can do is watch the chart. And so I'm going to go through the main chart, and then I'm going to talk to you a little bit about some key things that I am seeing, places where opportunities can occur. And you can use, of course, something like AJ System that we just heard earlier, or any of the other folks that we've been so honored to hear through the day. And you can use that sort of giant framework to help you, but I'll be focusing, of course, on target-rich trades, which I have loved and which is very, very good to me. And so here we go. We're going to start with SPY, and we can see that we had the Fed come in and give us 50 basis points. And since then, the market's been a little bit rocky. So the beautiful thing that we can see here is that we are clearly still in a major uptrend. Here is our stochastic momentum index. It's still very high. Notice when it gets this high, you want to start watching for places that stall out. And the target rich system tells you, hey, listen, where you've got resistance areas, you want to take profit and then pay attention to the last support area that will tell you, I need to pay attention to see if I drop there, because it might be a good time for me to have more dry powder. So if one of the greatest investors of a couple of generations, Warren Buffett, is now sitting on more cash than he's been sitting on since 2014, I think, he's really saying, hey, opportunities need to be selective. And when I step into a position, I want to be thinking about how long I want to hold it for, what my risk is, and don't be afraid to add into a position if you've got trend in your favor and you're pulling back into support areas that you could see. Now, I'm an active trader. I trade options and I trade futures, and that is a very big part of my overall look at the market. So I'm very, very active. For those of us that are not quite as active, I might say, hey, listen, look at a weekly chart. But for many of us here in the metastock space, we really are looking at tighter time frames. We want to see where the quick strikes are and that sort of thing. So what the SPY has been telling us for a couple of days is that whenever we see a brand new high, we need to take a little bit of profit and make sure that our stops are rising up. Okay, the one thing that I'd love to share with you about what's happening in the market is something called liquidity breaks. And what happens during these liquidity breaks, it'll stop us out of trades, but then the market will turn right around and move in the direction of trend. And so with SPY, you can see that that's been happening quite a bit, even all the way in mid-July, where we had that deep fade, and it brings our systems in to say, hey, listen, that could be a short, but as soon as you get back up in the space and it changes around within a day or within 2 or 3 days, as long as you start making these higher lows again after a liquidity break, it's telling you you can jump right back in. And a lot of us are sized so big that we spend time busy licking our wounds without going, wait a second, was this a liquidity break? And can I get right back into the market and get back to trading? So as we're looking at the SPY, what we're seeing is we've got very nice uptrend, very strong stochastics, but the system is saying, listen, you've got to take some profit. I know it looks good, but it could end up looking like this. We could have ourselves another deep liquidity break. And then if you're paying attention to that and you go, listen, I'm going to get dry powder, that's going to get you to the next step. Now, here's something funny. If a lot of us are traders, patience is like number 0 on our charts mentally, right? Very few of us that are active traders have a lot of patience, and that is super important. That's really what I wanted to share with you. Now, what I did was take a look at a couple of screeners, and we're just going to go, whoa, let's, oops, that's not, is that it? Yeah, here we go. So I did a couple of screeners, and I don't know if any of us know this because we've been actively looking at this position during the day, and we've been in this Metastock conference all day, but Hindenburg Research came out and said, listen, SMCI has got some accounting incongruencies that we need to take a look at, and it's completely fallen out of this range where we can see we've stopped heading higher. You could see it sort of happening, still uptrend, not strong. But what's happening is every time we get high and we think about moving to the upside, the price action collides and collapses. And so one of the things that happens with systems that are automated, you'll get triggers that say, hey, listen, you've got a short, and it bounces high, and then it tells you to get out. Now notice this is again one of those things that says, hey, wait a second, here is my last support zone. Here's a brand new resistance zone. It touched just above it. Liquidity break to the upside. And then the very next day, it has a day where it can't break higher and it can't break lower. And so this area says, you better wait for a second. Let the chart come in and do what it is that you think that it's going to do. Now, if you'd stayed short and you said, hey, listen, I'm getting back in short, and it gave you a buy zone, remember, these buy zones have support edges on them. And so you can always go, you know, I've got kind of a flat stochastic. This says a buy zone. So I'm going to come down here and wait until it gets to this area, and then and then I have my buy zone. And this is printed out for us well in advance. You can see that sort of thing. If perhaps you stayed with that short because you could see double topping, low, lower high, lower low, that's the definition of trend from Dow, and then another lower high, you're saying to yourself, all right, if I'm going to buy, it needs to be a double bottom. So you're in the green today if you bought at this level, but it's got to rise back above that moving average for you to stay long. For those of us that were in a short, because we saw this trend and we said, all right, here's my short setup. I've got a low stochastic reading. It's not up at 60 where these things normally sit. It's low. So I'm going to stay in the short setup, and I'm going to go ahead and take some profit at the edge of that support. We are sitting in very volatile markets. That is our takeaway. And when we are sitting in volatile markets, we've got to assess the big picture, and that means moving out and staring down trend. I believe SMCI is probably one of the only ones I have with negative trend, because many of us are thinking about things from a bullish environment, saying, wow, I don't want to miss any kind of upward pressure. But my takeaway for you is, listen, upward pressure is going to come, but what you want to do is look at supports to anchor your positions. And if it comes in tomorrow and it gaps down below this low, you immediately have your stop out engaged. If you stayed short and you run into a lot of profit, this gave us, I mean, I think this thing was down 14% just today. Tomorrow, if it gaps down, the short setup will be fully engaged as the stochastic moves negative. All right. Nope. Let's look at the next one. So a lot of us are listening to everything going on in the China stimulus package. And so this created a couple of very big opportunities. And we're sitting around thinking to ourselves, oh my goodness, I really want to get involved. So here's the thing about the China stimulus. Yes, it's going to have some effect, but when a chart is overheated like this, don't let the fear of missing out, which we call FOMO, don't let it get you involved in a trade that is incredibly extended, or you're going to find yourself underwater in no time flat. So here's what we're looking at for BABA. If you're saying to yourself, wow, why are you even showing me this? I want you to set an alert. And the alerts are really going to be all the way down here at 90. If you're interested in BABA as a long, there's a lot of risk associated here. Almost 15% of the current price action could be attached to risk. But Anne-Marie, trend is up. I've got this. I've got these very huge movements on my stochastic. Well, here's the thing about a stochastic. If you don't have it up on your Metastock charts, I'd say, hey, pop one up. 8338 is what I use for mine. Every time it gets this high, people start to take some gains. So this is an absolute savage move to the upside, but I would say to you, pump the brakes, take some profit if you've been long, and if you haven't been long, then you might think to yourself, well, maybe I can short it. So here's something that you can do on this. I always have my fingers crossed, hoping that these things go. So here's what happened today. Today, we have this big gap up. We had a higher high, but it can't hold. Now, this is just a 30-minute chart. So what you want to do is look for this to collapse. Here's what's happening. We're underneath the hull. And so as we bounce into the hull, as long as we reject it, we've got ourselves a short. And that is what the system is telling us on a 30-minute chart. This morning, it said, hey, buy the dip, right? Buy that dip. And as it moves up, it's now telling you probably ought to take some profit. And if you're so inclined, you might need to look at selling short here with the very high of the prior day, and then just put about 50 cents above the highest high of today, and that will be your total stop. What you can do is the first place it's going to come into support is an old buy zone, and if you manage it aggressively, we will fill these gaps eventually, folks. We absolutely will. There's a lot that could be going on in China right now, but I would say this is an enthusiastic move of a lot of money being pushed into the market very quickly because we're still the cleanest shirt in the dirty laundry. All right, let's hop to the next one. Here is PDD. So Pinduoduo is the it's what would we compare it to? Amazon. It's the Amazon, well, I don't even know. I wouldn't say that. It's a grouping of all kinds of retail investments that sit underneath this body. And this is also China related, but it looks absolutely terrible in terms of framework. You can see it's in a range. So this is a perfect space for one of AJ's positioning that he's talking about, because you can see the chart is essentially landlocked. Again, it's got this candlestick it came down into this prior support. Notice this has been printed here for a long time. And look at where it came into, right on the tick. And it held it, bounced up, but did not close near the high. All right. So this is something else that says, hey, maybe I like this chart in the longer term to try to take it long to the top of the range, or at least to this monster congestion here. But right now, it's triggering on those tight time frames a 30-minute chart opportunity that says, hey, we got a short setting up. Where is your stop? It's going to be above that highest high. How do you know you've got a shot? Okay, one, it's underneath the hull. The hull does not print like a regular moving average. So I love using it because once I get under it, it tells me, hey, look for the bounces to take short action. And where is your profit? Well, the first profit area is really going to be sitting underneath, so it's very close. What you want to see is have it lose that support zone, bounce, and then give you another short. And again, the stop would be just a few pennies over this highest high. And if you get some kind of liquidity event like this that says, okay, I'm going to run all the stops out of this trade like this did, you're going to have an ideal spot to jump back in. So that you don't get death by 1,000 cuts, what you want to do is make sure that you add into the position a small sized, maybe half or quarter sized. And when it bounces and collapses again, and you have confidence in the trend, you can move downward because you can see this is still very high. So you need to wait for this pattern to break down before you engage in any kind of short continuation. And it could be a minute. I do believe that the markets are going to give us a blow off top because there's a lot of tremendous negative delta showing. And that negative delta is telling us that people are shorting the tops and not really wanting to stay in that position. So next one, Micron Technologies. Of course, you know, there are people saying, oh, the AI trade is over, and then Micron blows it out of the water. And Micron produces things that are used by folks like NVIDIA and all kinds of other spaces. But they reported, look at the volume today on this candlestick. Now, it's a red candlestick, but it gapped into, wouldn't you know it, the last shorting event that we see on the chart. And so many times, let's say you went long and you took this buy setup here, days and days into earnings, and you're like, oh my goodness, how long am I going to have to hold this? And it bounces up into this resistance zone. It's a place that says to you, listen, I got to take some profit here. Don't let greed or the notion that you're going to bag an elephant be something that you think about when you're working with this kind of stuff. And so from this formation, we can see, hey, listen, this thing gapped up huge. I can't remember the last time it gapped up like this without having itself a nice move to the upside and then pulling back. So right now, all this says is, listen, take some profit and raise your stop. You can always get back in, folks. But if you're upside down in a trade, it's going to make it super difficult to position and have a good sense of calm about what you're doing. But this move upward here on this kind of volume is really significant. It's way more volume than they had in March, and it had the same sort of pattern, right? It bounced up over earnings, pulled back to retest the following day, and then went off to the running. And I suspect if it does that this time, the next thing we'll see is 120. So that's a really nice trade right there that you can look at. All right, the next one we want to look at is Amazon. A lot of folks are saying, hey, you know, what's going on with Amazon? Amazon just triggered a short setup today, right? We've been in a long for quite a while, right? Since early September. And now it's saying, hey, time to think about a short setup here. But notice, what is the trend? The trend is up. So the first time we see a short setup, we must think about, you know, maybe I set an alert and take this trade at this high area near 195 rather than this low area near 189, right? And so take a look at this. This one's going to set up in the next couple of days, a bounce action into this area. Watch for the stochastic to come down. I am planning, full disclosure, I am planning a short in this tomorrow. If it bounces back up into the 195 area, I'm super excited about that. And certainly I hope I have power and internet to be able to do that. And so that is going to give you an opportunity for a short, and that fade could really bring you into, I don't know, it looks like maybe about 180. So there's a pretty nice opportunity sitting there as well. There were so many charts to look at. My goal was to say, hey, could I find something really close to execution so that when you're watching and listening, you can take away and say, all right, I know what's going on here. All right, so now we're going to look at a few REITs. Now, why am I suggesting REITs? Okay, so first of all, we've got real estate prices getting a little softer. We have the Fed agreeing to lower interest rates. We went by 50. We might have another 50 before the end of the year. We might have another 75 before the end of the year. Whichever the case is, it's going to help commercial real estate as well as investment real estate that might be in the housing space. So what are we looking at? Here we have this chart. Here's the buy zone. It's set up for us. Take a look. Always look to the left if you're thinking about where might I need to take a little profit. You watch that area. It's pulled into the zone. Up here, it's closed. Take a look. Patterns are very important. High, retest of the high, but closes lower. Lower high, and then another lower high. So what you want to see here, ideally, in this buy zone event, is to say, you know, if I had the choice, I'd like to get in at about 34. My stop would be about 32, so $2 of a stop, and then I want to see it move back up into these very big zones and try to recover from last year's price, because we want to see real estate hold. Now, what could put a spanner in the works there would be if we get another soft jobs number. But I do like what's going on in the REITs. A lot of them are coming off of these regions. Notice low, high, higher low, higher high. So old resistance as new support is going to give you your test of those higher levels. So this one also looks really, really nice. Let's take a look at another one. 15 minutes to go. Here, look at this beast. All right, so you might look at something like this and go, holy cow, how do I get involved there? Well, notice it's got a buy zone set up all the way here at these highs. So when a stock is in full bore, this is a healthcare REIT, when it's in full bore acceleration, what you want to look for is how steep is my curve, right? Do I have volume coming in these key areas? And where these key volume zones are, they're going to end up being ideal support areas. Or you could look at them as stops that will give you an opportunity to position yourself. So in a space like this, where a buy zone has triggered, you can say to yourself, all right, I'm going to go in quarter size. If it comes down here to my, what is this one? If it comes into about 24.60, I'm going to go ahead and I'm going to add my full position, and I'm going to be able to look at it and go, all right, I'm going to manage it to the base of this congestion, which is about 24. All right. And so if it does fade on you, what you want to look for is any bounce that starts not giving you a new high. That's going to tell you, all right, I need to pay attention to this. Maybe I drop back to half size. Maybe I take on a position that has a covered call element to it. All kinds of things you can do here, but don't be afraid to buy pullbacks when a chart looks like this. It is in absolute full bore acceleration. You might say, but Anne-Marie, don't all things have to come back? Yeah, they do, but they aren't doing it now. And so why worry about something that's not happening? Look at what happens here. Fades, momentum starts to drop off. You can say to yourself, all right, going to trim my gains. I'm underneath this hull. Once it gets back above my hull, I'm going to be in good shape to take this trade. Here it says, ooh, I slipped under my hull, but I am holding the support is way down here. You should be moving up into the last few areas of support and say, you know, I'm going to move my stop up to 19 if I haven't yet. And as long as it sits sideways, it's going to break in the direction of the original trend. This is what I'm expecting here at this time. And of course, anything can happen in the market. So size accordingly in these kinds of spaces. You don't want to bet the farm on anything, especially if you're in the markets. And this is certainly one of those things, but it's been an absolute powerhouse. So here's another one. This is also a REIT, and this one is actually coming back into its support floor, right? It just turned red. It says, all right, taking some profit. Notice what happens. It slips off this edge. It fades into the prior area of support, and then it begins a bounce again. So where are these old support areas? The old buy zone is $20.70. So that's a space where you go, wait, my trend is up. So I wanted to come back into old support, and I'm going to try a bounce here. The thing about charts and using technical analysis to take trades is the following. It gives you a way to manage risk appropriately and work like a professional investor. Being a professional investor or professional trader, somebody that trades for their main income, somebody like me, I'm always concerned about, okay, if I take this trade and the wheels come off the bus, am I going to get a hatchet wound to the chest, or is it going to be a paper cut? And that's really what we want. We want the paper cut. We don't want any hatchet wounds. They take a lot longer to recover from. But also, I do like what's going on with these guys. We could have ourselves a pretty good dip because it's an investment REIT. And so wait for it to come into these areas and then say to yourself, all right, old support, old buy setup zones, those are going to be the ones that I can use as my formation continues to the upside. Notice this is turning slightly negative. So we expect price action to fade here a little bit because it's already told us, listen, I got to take some profit. But here's the beautiful thing. If you're watching your charts every day, notice if you hit a new high and you fade, and then you hit another new high and you fade, and you hit somewhere that's not a new high and you fade, that means take profit. What it's telling you is there's no demand for price above this zone. Super important for you to think through in terms of taking a position. All right, so here's the FXI. It is the China ETF. Look at it. it is a house of fire. And this here tells us all kinds of decision. They bought the dip, but now it's sitting way at the top here. And this is as high as it gets at its peak. So it's telling you that a pullback is on the horizon. So if we peek at the 30-minute chart, we can see that it's telling us, listen, you might be able to buy here, but when we've got brand new highs, you need to take some profit if it's not heading higher. That's what it's telling you. And of course, it does tell you that exactly. So tomorrow, what do we want to see? If the FXI holds above this zone, it's got more price action, but this is what you're going to watch for. Do I move to a new high and do I stay there? That's going to be critical. As a trader, you're using these technicals to keep you in line, but how traders behave at price points is supremely important. It's absolutely supremely important. Okay, so you could have a long setting up here overall that might run for, I don't know, maybe 5-6%. But I don't like longs when I'm sitting underneath the hull. I would rather see it bounce super high, begin to fade, and then I take a short. All right, zooming through these. I'm so sorry my face isn't here, but I'm really glad the charts are holding. Now, materials. Why are materials spiking? Same reason, folks. Same reason. People are hoping that this reduction in rates is going to boost stimulus. So they bought the rumor and they started selling the news. Now notice, high couldn't hold, collides right into this hull. If you're thinking to yourself, well, what hull is that? Let me see if I can remember. It's a 20. And it's the standard one that I use with target rich trades, still bouncing very nicely, still high. Listen, in a buy the dip formation where you've got 3 or 4 candles up, 1 candle sharply down, 3 or 4 candles up, but negative, and comes into support and bounces again, you're likely to see the same sort of thing, but they are going to go after the big fat round number of 100. It's a psychological number, so those dips tell you that you've got an opportunity for upside pressure. So the dip for support is all the way down here at 90 to 92. So the question is, what size position would I want to take there? Now, here's the thing about trading. If the trade is going well, you feel like you never are big enough in the size. If the trade is going poorly, you always wish you had less on. And so that's very important. If you think on the side of risk, you are going to have longevity in your trading career, in your investment career. So think on the side of risk and say, all right, I'm going to see if this thing can come into 95. And then I'm going to see if it holds that big fat round number. I'm going to try 95. Maybe a small position, quarter size, realizing it could get down to 93. And then you've got yourself an opportunity to add a little bit more, and you want your stop right underneath there. Listen, if you get in here and you hold it and it gaps down and you get stopped out and it collapses into your old buy zone, guess what that's going to be? It's going to be another buy zone, because the trend of the overall chart is starting to move to the upside. How do you know that? Simple. Low, high, higher low, higher high, higher low, higher high. All right, so it is 5:57. And if I were you guys, I would be pretty close to brain dead. And so what I want to do is be respectful of your time, not jam up some more. Jeff and I are putting together a number of spaces where we can do Zoom and go through target rich trades and talk about charts. And so that'll be coming up some other time, and we'll be able to talk then if you're interested. I love talking about chart mechanics. I love helping folks see the market with more clarity that has a visual instead of just saying, okay, it touched this line, I got to buy it. Or it just told me to short, I got to sell it. It's about becoming more aware of how market participants are viewing price, what they're thinking about it in general, and what's making them go, you know what, I'm going to press, or I'm going to not press, and I'm going to take it kind of slow. So I'm going to turn it back over to you, Jeff. I hate keeping people past time. If there are any questions, I don't think I saw any questions.
We have one. I answered it.
Yeah.
The question was
fantastic.
what moving average, what whole moving average periodicity are you using? Or how many
Yeah.
periods are going into the calculation?
Yeah,
And I said 20.
absolutely.
So in any case, but yeah, thank you very much, Emery. I'm actually very surprised with how well that worked.
I know. I got my fingers crossed. The lights have been flickering here, but everything else has gone pretty good. So
Yeah.
I was holding my breath a little.
Yeah. We had a backup plan. If it didn't work, we were just gonna do a demo of target restraints for you.
Yeah, there you go.
You stay safe, stay dry.
Yeah, well, staying dry is not. Listen, I took a walk because I love extreme weather, and I almost got blown to the ground because I did not realize the gusts were up past 40, and so we haven't been out since they've been up above 50.
Okay.
So
yeah, that makes sense. Okay. Well, thank you very much. I appreciate it, and always good to have you.
Thank you so much.
All right. Cool. We do have, I'm going to go ahead and wrap up a little bit today, but we do have, of course, all of the stuff you're showing in the add-on, the support and resistance levels, the commentary, the setups, the scanning, all that's available. And I really like, one of the things that's pretty cool about the way we put together the Anne-Marie target rich trades is we've kind of done a couple of pretty major revisions to it, and we've never charged an upgrade fee. In fact, I would tell you, if you have bought target rich trades and you haven't installed it in the last couple of weeks, make sure to go up to the Metastock downloads page and download it again, because we've made some very significant kind of upgrades, improvements and stuff. If you don't have it yet, and we've done it for free every single time, so that's really cool. If you haven't got it yet, you'll notice it with what she's talking about. It's automatically identifying the support and resistance areas. It gives you bullish and bearish trend identification, setup and trigger warnings, all that kind of stuff available. Also a very detailed commentary. We've talked all day long about how much I like the commentary and how well it works. And it's going to give you the trend notifications, the signals, the breakdowns, all that kind of stuff. Of course, it's going to have explorations because why not take advantage of one of Metastock's most powerful features? So that's going to be included in there. It does include a system tester. We did do, just recently, August 16th, we sat down and did a training class for all users. It was free. And if you purchase it, it'll be available on your downloads page immediately with purchase. So, and she did a great job. It was a 2-part session. Anne-Marie sat down and kind of just went very thoroughly through charts. I think she spent like a couple hours doing it. And then I did a part on here's how you run your scans, here's how you set up your charts, all that kind of stuff. What we wanted to do with that was make it something that if you're brand new to Metastock, that's helpful. And if you have had Metastock for a while, listen to Anne-Marie's part. Mine was just about how do you run the charts. So anyway, normally this is $4.99 as part of the conference special. What we're going to do is $247 for the price. If you haven't tried Metastock, we'll give you a 30-day free trial as part of that. We'll give you a 30-day money-back guarantee. You'll get that boot camp, the training class, unlimited technical support if you need it. You can do that at metastock.com/saleschat. You can give us a call, 800-882-3040. And you can go to metastock.com/conf promo. You can also go to this link if you want, but conf promo will take you to a page where you can order it. Very, very well received add-on. People absolutely love it. And again, if you've had it for a while, just go download the new version, because we did update it right after that webinar about, I guess it's just over a month ago, we did another update to include the new template with the whole moving average with it. John says, thank you. I learned with this presentation. Great. I always hope you go away with something. You know, we've put a lot of time putting these together, and I'm glad. John, thank you for coming. So with that being said, again, we're Metastock. I'll come back to this in a second. I want to thank all of our presenters. My slides got a little bit out of order with the removing of things and stuff like that. Wanted to say thank you again to CMT Association, AAII, the Traders Forum. Have you joined the Traders Forum yet? You can just go up to thetradersforum.com, click on the join button on the upper left-hand corner, and you'll be in. You can chat with other traders, learn about the markets, learn about patterns. We do really cool events up there. It's a partner site, a community of traders helping traders. So, and then, of course, we are Metastock. Greg, let's do one last prize. Let's take it home with a prize, if you're still available.
I am, of course I am.
And you know these prizes are not going to give away themselves.
Apparently not.
All right. So I'm going to go ahead. The prize that we're going to give away to kind of close up today. Let's see, Zahir came in and he opened up, I think it was on Tuesday, but the days are blurring together for me.
Yeah.
He's got a prize package that includes a portfolio accelerator call, a stock market blueprint, a methodology user's manual, and in addition to that, a recording, a bonus recording. It's a value of $297. And I have a new number for you, Greg. I did update our list. The number that you need to go between is 1 and 8,021.
Okay. That would be 5718. 5718.
Okay. And that would match to Stephen L. in the USA with a Comcast account. So if you have a Comcast account, Steve, it's probably you. You probably just won. And again, we'll send you information on collecting your prize next week when we're cleaning up. There's all kinds of confetti everywhere. There's like so much to do.
The wrap party is a doozy.
Okay. We had a great day today. A lot of good speakers. We talked about Anne Marie's Target Rich Trades. We talked about getting an extended trial on Metastock. What other Metastock products did we talk about? Do you remember offhand?
Oh, you're catching me off guard.
I'm pulling the list, actually.
Well, normally I have that right at my fingertips, but I don't have it right here.
Well, let me pull up the Traders Conference.
Well, I can tell you right now, if you go to metastock.com/comp promo, there is an exhausted list of everything we've talked about. Also, you'll be getting an email if you're on our list. You'll be getting an email shortly, if you haven't already received it, showing exactly the products that were discussed today and how you can get them yourself at a discounted rate.
Right, yeah. So today we talked about 3S code. A great pattern. I love that, the 3-point pattern that he looks for. We also talked about the Ichimoku in the Metastock 19.
You did splendid.
Value charts and Anne Marie's Target Rich Trades. So all of those are great. Tomorrow we have another great day. All of those are very, very big discounts as well. If you want to do that, you can give us a call, 800-882-3040, metastock.com/conf promo, or if you have more questions, metastock.com/sales-chat. Tomorrow we're going to start with Dan Passerelli, a little bit of a shorter day. He's going to do his, I call it a momentum resumption strategy. It looks for kind of, well, I'll let him talk about it tomorrow. Really, really cool strategy. After that, we're going to have Rahul Mohindar. He's going to come and talk about his methods and how he uses. If you're in the U.S., if you're out of the U.S., this speaker won't be too valuable for you. But Jerry Allison comes in and he's going to talk about trader tax strategies and how to run those and whether or not it makes sense for you to be trading as a business. So you want to tune in for that if that's something you're interested in. Price Headley, a top market timer, is going to be in here. Mark Leibovit, Kevin Nelson, the guy that hired me, Alex Cole is coming back with Tyler Wood. So another great day tomorrow. We're going to basically be running till about 3 o'clock Eastern time. And I hope you come. I hope you can make it. And I hope you learn something again, John. So with all that being said, great day. Thanks for being here. Thanks for coming. I hope it's been worthwhile. I'll see you again in the morning.
Bye-bye.
Bye. Oh, you've been live on camera this whole time. All right. Goodbye, everybody.